Hey guys, welcome to this part 2 of the CA Final AFM expected questions marathon. In the previous part, we covered equity valuation, bond valuation, and futures and options. In this part, we are going to cover advanced capital budgeting, Forex chapter, and international financial management. Comprehensively, we are going to cover. Okay, without skipping the concepts, please go through the entire video. Okay, I can assure you that this video is going to add a lot of value to your preparation. Okay, without wasting any time, let's get started with advanced capital budgeting. Let us take this question number 35. Through this question, we will understand the basics of the NPV computation or capital budgeting. This is advanced capital budgeting is nothing but an extension of the intermediate syllabus. Okay, you have capital budgeting in intermediate now. The extension of this is advanced capital budgeting. Here we have all the topics which are there for intermediate will also be applicable here. But questions may not be generally asked from those areas, but still they are there in the syllabus. We'll discuss some more areas which are relevant for this attempt alone. Okay, see. First, basic NPV computation question. This was asked in, I think, in the May 2025 attempt, but still, okay, it can be tested anytime. Also, you need to understand the basics. So I will discuss this question. Okay, see. SS company is considering the replacement of its existing machine with a new machine. The purchase price of the new machine is rupees 26 lakhs and its expected life is 8 years. The company follows straight line method of depreciation on the original investment. Sorry, the scrap value is not considered for the purpose of depreciation. The other expenses to be incurred for the new machine are as under: installation charges 9,000, fees paid to the consultant for his advice to buy new machine is 6,000, additional working capital requirement is 17,000, will be released after 8 years. The written down value of the existing machine is 76,000 and its cash salvage value is 12,500. The dismantling cost of this machine would be rupees 4,500. The annual earnings before tax but after depreciation from the new machine would amount to 3,15,000. Income tax rate is given as 35%. The company's required rate of return is 13%. Okay, company's required rate of the cost of capital, which should be used for discounting the cash flows. Are you all understanding? You are required to advise the validity of the proportion. Okay, present value cash inflow is given, present value factor is given, present value annuity factor is also given for 13% for 8 years. Are you all listening? Now, see, before going for further discussion, see what I will explain is the basics of NPV computation. We have some basics here. Okay, you might have studied in intermediate itself. Here I will try to explain it summarily so that you can understand the entire question easily. See, now in the capital budgeting question, I'll briefly explain here. See what happens. You have, okay, what is NPV? NPV means, okay, net present value, which is discounted cash inflow, which is discounted cash inflow minus discounted cash outflow. This is what I call it as NPV. Okay, the net benefit in terms of present value derived from the project after deducting the outflow, after deducting the discounted cash outflow. Now, very simple. You are undertaking a project. Say the project cost is 8 lakh rupees. You want a new, open a new factory, or you want to open a, buy a new plant and machinery, something. Okay, this is the cost of the machine. Okay, this assume the cost of the machine. This is what initially you will pay to acquire the machine. Are you understanding? I call it as initial cash flow. Initial cash flow. See, based on the time frame, I divide the entire cash flow of the project into 3. Very simple. This I call it as initial cash flow. Initial cash flow is a cash flow which I spend. Okay, initially to undertake the project. So, for example, if I buy a plant and machinery, I buy it for 8 lakhs. Now, in this 8 lakhs, I will include some, if there is any installation charges. Suppose there is any installation charges. As per the PPE standard, you need to capitalize it. That I will include. For example, installation charges comes to 15,000. This I will add. Assume, okay, I incurred some legal expenses, I incurred some consultancy expenses, which are wholly and exclusively incurred for the purpose of buying this plant and machinery. So I will add it, say 30,000 is the amount. Are you all understanding? The total cash outflow will come to, okay, 8,45,000. This I call it as initial cash outflow. Agreed up. So this is, okay, regarding the cost of the machine. Apart from this, you see, I invest in the machine. That is not sufficient. Suppose the machine has to run for 8 years. The machine has a life of 8 years. The project will go on for 8 years. Now, to run a project, I just require the capital. I require something called as working capital. This is long-term capital. I need to invest. Fine. But apart from this, I will require some working capital. I require some working capital to smoothly run the operations, to okay, get the ultimate benefit from the project. So working capital, assume I will incur some 2 lakh rupees as working capital. What is the treatment of this working capital? Very simple. Working capital, okay, you will add to the initial cash outflow. You will add to the initial cash outflow, which means 8,45,000 you require. Apart from that, to run the operation, you also require 2 lakh. To run the project, you require 2 lakh. So total comes to 10,45,000. This is what I call it as initial cash outflow. I pay 10,45,000, 8,45,000 for the machine and allied expenses, and then working capital 2 lakh I will expend. Are you all understanding? Now, this working capital will be recovered at the end of the project, life of the project. Anyway, I will explain. See, very simple. This is called as initial cash outflow. This is stage number 1. Stage 1. Next stage. Now you expended 10,45,000. I spent 10,45,000. Stage 2, what happens? There is annual cash flow. Thereafter, every year there will be some cash flow. That is what is benefit. Okay, this I call it as CFAT, cash flow after tax. You will compute. Okay, this is nothing but the benefit derived from the project, recurring benefit, which means every year the project will give you some some cash flow. This I call it as annual cash flow. This might be same. Okay, it might be something different also. First year 100 rupees, second year 150, third year 250. It will be given in the question whether assume the project life is 8 years. For entire 8 years, you will get the same cash flow every year or different cash flow. You will see the question will be giving you. Are you all understanding? So this I call it as annual cash flow here. While computing annual cash flow, what is the adjustment you need to do? See, in the capital budgeting question, cash flow is superior. Accounting number you should not take. You should take the cash flow. Are you agreeing? Now, cash flow in the sense, what you have to do there also, if you see in the question, okay, they might be giving you EBAT. They might be giving you EBAT or they might be giving you PAT. Agreed? Now, what you need to do is that you need to compute something called as NOPAT, net operating profit after tax. Net operating profit after tax. Then you add back the non-cash item, okay, like depreciation, other expenses. Are you all understanding? Depreciation. Depreciation is one of the main adjustments. So, NOPAT you need to compute, then add back depreciation. Sir, what is this NOPAT? It can be computed in 2 ways. It can be computed in 2 ways. Very simple. EBAT given. How to compute net operating profit after tax? EBAT into 1 minus T. EBAT into 1 minus T. This is one way of computing. Answer will be same. Don't worry. Or interest is given in the question. I need to exclude interest. So interest is given in the question and they have given income statement. EBAT given minus interest. Then you will get EBT. Okay, minus tax. Then you will get PAT, profit after tax. Like this, they have given the entire income statement. PAT they have given. So from PAT, how to compute profit after tax plus add back the interest. But post-tax only you need to add 1 minus T. This will give you no PAT. Are you all understanding? So EBAT into 1 minus T or PAT plus interest into 1 minus T, the number will be same. Believe me, the number will be same. For example, okay, here assume, okay, EBAT is 100 rupees. EBAT 100 minus interest is, say, interest expenses comes to 20. Up the EBT is 80. EBT earnings before tax is 80 minus tax at 30%. Assume tax at 30%, which is 24. PAT comes to 56 rupees. Do you agree? PAT comes to 50. Now, what they say, EBAT into 1 minus T. What is the no PAT here? Net operating profit you need to compute now. So, EBAT into 1 minus T. How much is that? 100 into, okay, 0.7. 1 minus T now, 1 minus 0.3 is equal to 70 rupees. This 70 will be same. This is EBAT into 1 minus T. Yeah. This 70 will be same if you compute PAT plus interest into 1 minus T. Let us verify that. PAT is how much? 56 plus what is the interest cost? 20 rupees. 20 into 1 minus T means 0.7. Okay, 28.7, 14. 56 plus 14. How much is that? 70 rupees. Are you all understanding? So this no PAT is only called as, okay, from EBAT also you can compute no PAT just to reduce the tax without reducing the interest. To put it simply, the project is undertaken, okay, this is the profit which is derived from the project. Okay, I will take the no PAT and I will add back the depreciation to arrive at the cash flow after tax. From the no PAT after tax, I'll arrive at the cash flow after tax by adding back the depreciation. This I call it as CPAT, cash flow after tax. Now, in question, they sometimes will give you interest adjustment. Sometimes they may not give anything about interest. In that case, what you should do, you should ignore the interest portion. Are you understanding? Which means PAT would be directly given, but interest amount would not be given. So nothing to be added back. You cannot add back. Number is not given. So what do you do? Simply add the depreciation to the PAT. Are you listening? This is how you need to compute. Now, For computing, sir, what is the use of adding back depreciation? Now, very simple. What is the depreciation treatment here in capital budgeting? Very simple. For computing the tax for computing the tax, you need depreciation, which means depreciation would be considered for computing tax, but will be added back since it is a non-cash item. Are you listening? So you will arrive at cash flow after tax. We will see in the question. This is how you will compute the annual cash flow. This is how you will compute the annual cash flow. Stage number 2. This is stage number 2. Next, last stage, what I call it as terminal cash flow. What is the last stage? Terminal cash flow. Here I am putting stage 3, terminal cash flow. Tell me, children, what is this terminal cash flow? Very simple. At the end of the project, say project life is 8 years. Life of the project is 8 years. Now, initial project, now year 0, you spend how much, this will come under initial cash flow. Annual cash flow, every year how much you will gain. This is the inflows. Now, the last year, what will happen? Now, 2 things will predominantly happen. One is that working capital recovery. I call it as working capital recovery. Recovery of the working capital, which means the 2 lakh rupees which you spend in year 0 or present terms, at that 2 lakh rupees you will recover. That 2 lakh rupees you will get to recover. This is inflow. At that time you will consider it as outflow. You spent it. Now after the period of 8 years, your working capital was locked up in the project for 8 years. After the end of the project, that working capital will be received. It will be recovered. The working capital recovery, I'll treat it as inflow in the final year, at the end of the project. Are you all understanding? So recovery of the working capital is one of the adjustment. What you should do at the end of the life, 8 years project, 8th year, that will be inflow. From it should be treated on par with inflow. Now, second adjustment, salvage value after tax. This is very, very important adjustment. What is this adjustment? Salvage value after tax. Very simple. I have a machine. Assume I have a machine which I bought it for 1,50,000. Assume I have a machine which I bought it for 1,50,000. And the salvage value from the machine is 30,000. Assume the salvage value from the machine is 30,000. So depreciable amount is 1,20,000. 1,20,000. Are you listening? This amount is the total depreciable amount. Now assume you have used it entirely, but assume you have used the WDV method. In that case, entire 1,20,000 will not be depreciated most probably. So what will happen? You will have one closing WDV. What is the salvage value here? This is the salvage value. This is salvage value. Now, how to find the tax adjustment for the salvage value is what I am discussing. Very simple. What is the salvage value? Sale value. Sale value you have as how much? 30,000. Okay. Now, how to find out tax from this? Very simple. Minus closing WDV. WDV as on that date, which means whenever you are selling at the end of the 5 years or 8 years, on that date in your books of account, there will be closing WDV. Are you listening? If tax detail given, that you will consider. If not, you will take the books value, accounting number. So closing WDV on that date, assume is 20,000. On that date, assume is 20,000 is the closing WDV. Agreed? So sale value is 30,000. Closing WDV 20,000. Profit on sale, loss on sale. You tell me, children. Profit on sale. Profit on sale, how much is that? 10,000 rupees is profit on sale. Assume tax is 30%. Tax at 30%. 3,000 is the tax. Agreed? So this will be tax. Are you listening? So 3,000 will be the tax. Now, if it is profit on sale, 3,000 will be, you have to pay tax. If it is loss on sale, this is case number 1, where there is profit on sale. Agreed? So there will be tax of 3,000. What is the salvage value? Now, salvage value for computing tax, you need to compute all this. For salvage value after tax, you have salvage value. How much is the salvage value? In this question, 30,000. In the example, 30,000 minus tax is how much? 3,000. 3,000. Hence, salvage value after tax comes to 27,000. SVAT. Salvage value after tax comes to 27,000. This is case number 1. When the closing WDV is 20,000. Are you all understanding? Assume case 2. The salvage value or sale value is how much of the machine is, say, 30,000. Same 30,000. But the closing WDV as on that date, closing WDV is how much? It comes to 40,000. It is 40,000, which means 40,000 is the WDV value. You are selling it for lower rate of 30,000. You tell me loss on sale, profit on sale, loss on sale of 10,000 rupees. Loss on sale. Now, if it is loss on sale, you will have corresponding tax refund, benefit or cost benefit, which means add tax at 30%. Are you understanding what is the tax? If you pay 10,000, if you pay the loss, if you have loss of 10,000, there will be corresponding tax benefit of 3,000. Okay, minus 10,000 plus 3,000 minus 7,000 will be there. Are you understanding? This is there. This is the net benefit. But what is the tax inflow, outflow? This is inflow. This is inflow. In that case, in the previous case, it was outflow. You reduce. This is outflow. Okay, bracket la, that is why I put. Okay, this is inflow. Now tell me, what is the salvage value after tax? Salvage value is equal to 30,000. Tax is inflow, outflow. Inflow, tax also inflow na. So 3,000. Total salvage value after tax comes to how much? 33,000 in this case. Are you all understanding the treatment? This salvage value after tax, okay, I will add it to the terminal cash flow, last year cash flow. Are you all understanding? So two things, working capital recovery. In this question, working capital was 2 lakh. That will be my inflow at the end of the, suppose project is 8 year, at the end of 8 year, I will recover the working capital. Salvage value after tax, say 33,000. Okay, total 2,33,000 will be my last year inflow. Last year inflow. This also, along with the last year annual cash flow, I will discount and bring it to present value terms. The total will become my discounted cash inflow minus discounted cash outflow. Initial cash outflow will give me the NPV. Are you all understanding the structure of the discussion? Now we'll move on to the question, specific question. Quickly we can discuss. Okay, you will easily understand everything I was explained related to basics. Even if you are not thorough with the intermediate syllabus, now I have refreshed everything. See, SS company is considering the replacement. Now you tell me, the purchase price of the machine is how much? 26 lakhs. Now, life is 8 years, straight line method of depreciation, and scrap value is not considered for purpose of depreciation. No issue. Now, installation charges 9,000 and fees paid to consultant, for only for the machine, which means 6,000 you will capitalize. So 9,000 plus 6,000 plus cost of the machine, 26,000. You tell me, children, this is the solution. I will compute annual depreciation. You leave it. I'll come back to depreciation. First, initial cash outflow is there. Initial cash. Where is the initial cash outflow? Here it is not given. Anyway, I will compute it. Don't worry. Now, see, what is the initial cash outlay? Now, 26 lakhs you have. Okay, this 26 lakhs you are considered plus 9,000 plus 6,000. What is that? For total cost 26. 15 years, 26 lakhs. So total comes to 2615. Now, tell me, children, is there any working capital in this question? Is there any working capital? Yes, additional working capital, 17,000 is required. So 17,000 is the requirement. What is the total initial cash outlay? 2632. Keep in mind, the presentation might be different. I'll tell you what is happening. So this is 26 lakhs 32,000. This I called as first stage initial cash outlay, including the working capital. Agreed? Now compute the computation of depreciation. I need to compute annual depreciation before, because I need to compute annual cash flow after tax. For that, I need to adjust taxation. For tax purpose, you need to have the depreciation. Are you understanding? So depreciation, I will calculate. Purchase price is there. I will capitalize this. This is the total capitalized amount, 26 lakhs. 15,000. Salvage value, I will consider, I will not consider because they've given specifically, the depreciable amount. Normally, you will remove the depreciable amount and consider the salvage value. Agreed. Salvage value will reduce, then only you will find out the depreciable amount. Here, they are specific that, salvage value should not consider. So, total 2615 divided by straight line method, 8 years, 3,26,875 is the annual depreciation. Agreed. Now, come to the annual cash flow after tax, cash inflow. Now, EBAT given, annual earnings given as 3 lakh. What is the number? 3 lakh 15,000. Can you see this 3 lakh 15,000? Because they say the annual earnings before tax but after depreciation, which means this is, see, you have sales minus cost of goods sold. You will get the gross profit, which is then operating expenses. You will get operating profit. Then depreciation will reduce. EBITDA you will get, then you will reduce the depreciation, you will get EBIT. EBIT means already depreciation is considered, will be reduced. Correct? Now you have EBIT, this is what they're saying. The annual earnings is before tax, which means earnings before tax, but after depreciation, which means EBIT they are made. From the new machine would amount to 3,15,000. See, generally, sometimes they may also ask before depreciation EBITDA number, then you have to, whatever you calculate depreciation you will reduce, then you will find cash flow after tax. Now what they are given, depreciation already considered, they have straight away given the EBIT number. Correct. What you should do next to what? EBIT given, directly reduce the tax. EBIT into 1 minus T, you will get the no PAT, earnings after tax. Okay, net operating profit after tax, 2,04,750. Add back depreciation, non-cash item, I will add back. How much is the value? Ski fat is how much? 5,31,675, 625. Okay, is cash flow after tax. Now, computation of salvage value after tax. Okay, now computation of salvage value. Now tell me children, what is happening? Salvage value, you have sale proceeds of 12,500. Next, cost of removal. See, question sometimes will mention something called as cost of removal. What you should do? You should remove from the sale proceeds, which means you sold for 12,500, but out of it 4,500, okay, it is gone for the removal expenses. It is gone. So what is balance? Only 8,000. I call it as net sale proceeds. How much is the net sale proceeds? 8,000. Okay, this is the sale proceed minus WDV, closing WDV 76,000, which means 76,000 worth asset. Okay, you are selling it for how much? You are selling it for how much? Only 8,000, which means loss on sale 68,000. Loss on sale means, okay, profit will be, the tax will be tax outflow. There will be tax inflow, tax outflow. Okay, tax inflow, tax outflow, tax inflow. Because this loss on sale, you will have tax benefit. How much is that? 23,800. This, what is the treatment of this tax? Sorry, cold issue. Okay, what is the tax benefit from this? Okay, loss 23,800. What is the treatment? Okay, you should add. So 20. So 23,800. And you will add, okay, the salvage value after tax. Now, very simple. What is the salvage value? What is the net sale proceeds? 8,000 is the sale proceeds. Agreed? This you add the tax benefit. Okay, tax inflow. How much is that? 23,800. What is the total salvage value after tax? How much is that? 31,800. Are you all clear with this? This is 31,800 salvage value after tax. Now, we will move on to NPV computation now. Very simple. Year 1 to 8. See, NPV is nothing but discounted cash inflow minus discounted cash outflow, which means total discounted cash inflow first you will consider, the cash flow inflow you will consider, discount it and then find out the discounted cash inflow minus reduce the discounted cash outflow, you will get the NPV. Here, year 1 to 8 annual cash flow, how much is that? 5,31,625. I'll get 5,31,625 and the present value annuity factor for 8 years at 13% is this much. How much is that? 25,51,800 total. Okay, this into 4.8 will give you 25,51,800. This annual cash inflow, total annual cash inflow. Now, from this, okay, you see, yes, one more inflow is there. At the end of 8th year, recovery of working capital is there. Recovery of working capital recovery. How much is that? 17,000. Okay, when it will be happening? Terminal cash flow. At the end of 8th year, you will have working capital recovery. Are you listening? No. One adjustment is there in this case. See what happened in this question. What they mentioned was the sale proceeds. Sir, here you told that at the end of 8th year, the salvage value after tax will be recovered. Yes, generally 8th year only it will happen. If it is existing machine, if it is like the new machine, if it is new machine, which means you are investing in the project and buying a new machine, and that machine after 8 years it is getting recovered. This is the case now. Okay, it will be at the end of 8th year. But in this question, what happened? You are taking the salvage value of the existing machine. This is not new machine. Okay, this is existing machine. Are you all understanding? Here, I have you see here what happens. The written down value of the existing machine is 76,000 and its cash salvage value is 12,500. Are you all agreeing? What they say is that, okay, the written down value of the existing machine, which is not new machine, but already existing machine, that machine, okay, will have a written down value of 76 and the cash value of 12,500, which means when you are purchasing a new machine, you see the timeline and decide. When you are purchasing the new machine, you are selling the existing machine and purchasing the new machine. Are you all understanding? A sale proceeds of the existing machine will happen in year 0, at the end of the year, end of the period, year 0 itself. Today itself it will happen. Are you all understanding? When you are purchasing new plant, okay, you will replace. Ideally, you are trying to replace now. You will purchase a new machine and sell the old machine. Old machine, what happens? Existing machine is the 76,000 is the WDV. Cash salvage value 12,500. Okay, then salvage value after tax for the existing machine is how much? 31,800, which will happen in year 0. So this I will consider, this is the inflow, but the time frame you need to, very important, the time frame is year 0. So salvage value after tax generally will be terminal value. The terminal, this is the terminal cash flow, but the terminal cash flow of the existing machine, now the terminal year will be today itself. See, for existing machine, this is the last year. When you replace new with new machine, this will be its last machine, year. Same way, if you are buying the new machine for the new machine, last year will be the last year of the project. Are you understanding? So terminal cash flow means here, year 0, the last year of this existing machine. So 31,800 is salvage value after tax. Okay, present value factor is 1 because this happens today itself. This is the inflow today. This also I will add. So 25,51,800 plus 1692 plus 31,800 will give you a total of 25,89,992. Are you all understanding? Minus discounted cash outflow. In the discounted cash outflow, okay, you will consider 26,32,000. See, suddenly, first they have given the cash outflow where you found out here only 26,15,000. Where 2632 came? Working capital they have added. Are you all understanding? This initial cash outlay is nothing but, okay, the purchase cost, arrayed cost. Then apart from that, working capital will be, okay, outflow in the year 1. I told you now, this 2632 only they have considered the initial cash outlay. This they have reduced and found out the NPV. NPV is negative. Okay, hence it is not recommended to buy the new machine. Okay, with this we are through with the introduction part of the capital budgeting chapter. Shall we move on to the next stage? Okay, take question number 36, very interesting. NPV and standard deviation. NPV and standard deviation. Okay, a company is considering projects X and Y with following information. Project is given, expected NPV, mean NPV, okay, average NPV. I call it as expected NPV or X bar, mean NPV. Okay, now, which means various scenarios would be given, probability based NPV or simple average or weighted average. They would have already computed. Don't worry about that. This is mean NPV. On an average, this is the NPV. Now, next to standard deviation. See, this is mean. This is expected. 1,22,000 is average. But whether it can deviate, yes, it can deviate. It can deviate 90,000. 90,000 is the standard deviation. The deviation around the mean, I call it as standard deviation, 90,000. Next, for project Y, the NPV is 2,25,000. Is it certain or uncertain? Uncertain. I don't know what will happen. It may deviate 1,20,000. So project X, I expect the NPV to be 1,22,000. I expect that the deviation may be 90,000. For project Y, it is 2,25,000 and 1,20,000 as deviation. Now, which project you will recommend based on the above data? Very simple. NPV, okay, is the is the representation of the return from the project. Is the representation of the net present value, net benefit, discounted cash inflow minus outflow, net inflow, which represents the return from the project. Return, how much you are earning from the project. Agree? Now, what do you mean by standard deviation? Standard deviation is a measure of risk of the project. We already discussed in a portfolio. So very simple. This shows the return of the project. This shows the risk of the project. What they ask, which project will you recommend based on the above data? If I am risk-averse person, if I see the risk angle, okay, I feel project Y is more risky because it has a higher standard deviation. It has 1,20,000 as standard deviation, higher risk. So project Y is higher risk. Okay, if I'm a risk-averse person, I will select project X because project X is having lower risk. Based on risk, I will select project X. But based on return, if you see the return alone, I don't risk. Okay, risk is nothing for me. Okay, I don't consider risk a factor at all. I will only consider return. If that is the case, what will be the return? 2,25,000. I see higher return, so I will select the project Y. Are you all understanding? Based on risk, I will select project X because it is having less risk. Based on return, I will select project Y because it is having higher return. Agreed? This is the solution for question number part number A. Next, to explain whether your opinion will change if you use coefficient of variation. Coefficient of variation as a measure of risk. What is this coefficient of variation? I'll discuss this briefly and then elaborate. See what happens. This is a part A given here on the basis of standard deviation. Project X to be chosen because it is less risky than project Y. On the basis of return, project Y should be selected because it has a higher return. Now, coefficient of variation. What this is, I'll briefly explain here itself. Very simple. Okay. Assume, okay, there are two persons coming out of AFM examination. Assume this is A, this is B. Two, okay, student are written the examination, come out of the exam hall. I ask, see, what is the expected marks? How many, or no, I will not ask NPV. I will rather ask first, you, okay, calculated some marks. How much is the expected deviation? I ask the question, how much is the expected deviation? Which means, see, I ask the question, how much is the standard deviation? This is, okay, sigma is the denotation of standard deviation. Now I ask him, how much you think you will get? I don't care how much you will get. First tell me how certain you are to get your target number. Okay, assume suppose I'm thinking of getting 60. And I think that every time after coming home, I check the marks. Okay, every time there is no variation, I believe that I will get the marks. So I will say that my expected deviation is only, say the A person say the expected deviation is say 15 marks, which means I expect some number, but deviation around that number, expected number is 15. So if I expect 60 marks now, it can also be 45, it can also be 75, 60 plus 15 or 60 minus 15. This is what A said. Then I go to ask B. He says, what is the expected marks? What is the deviation around the expected mark? He says only 3 marks. I calculate always perfectly. Okay, whatever is the number, I only expect the deviation around the mean as 3 marks. Next, all this is good. What is your mean? Expected, I write it as X bar. I denote it as X bar. What is your mean? What do you expect? First, you told a deviation, fine. How much you are expecting? I ask A, he says 65 marks I am expecting, which means he may get either 80 or he may get either 50. Agreed? Now, the point number 1. Okay, first tell me children, based on risk alone, which person is best? You will select B. Okay, B is less risky, you will assume. B is less risky. Why? He has a lower standard deviation. Only 3 marks is deviating. Prediction always comes good. This is the selection. Are you all understanding? Based on risk, you will select B. Based on, now I'll come back to the expected. Now, B, I go and ask, what is your expected marks? What is your expected mark? What he says now? He says, 20 marks I expect. I expect 20 marks, which means, see my dear friends, now, it is irrelevant. If you see the deviation alone, you might think, B is the better option. But the problem with B is, see, you may either get 17 or you may get 23. Both are irrelevant. Are you all understanding? You will never clear if 17 or 23 is the marks. Agreed? So standard deviation on a standalone basis is not sufficient. We should see that, for every return earned, every 1 rupee return earned, what is the standard deviation? The standardized measure you need to, that is what is called as coefficient of variation. For every 1 rupee NPV earned, how much is the standard deviation is what coefficient of variation. Very simple. Now see, A is risky based on standard deviation alone, but since its NPV is higher, the NPV is higher now. So the coefficient of variation will be lower. Are you all understanding? So coefficient of variation, what is the formula? Standard deviation divided by NPV or expected. This is not NPV is not even here mean. Standard deviation divided by mean or expected value. Standard deviation minus expected value. Here mean, which mean we are finding? NPV is mean. So we will take this. Are you all listening? So standard deviation is 90,000 in case A. And the NPV is 1,20,000. I get coefficient of variation 0.738. Coefficient of variation of Y I get as 0.533, which means based on coefficient of variation, Y is more risky. Project Y is more risky. Project Y I will select, which is less risky. What is that? Yes, 0.533, which is less risky. Hence, I will select project Y based on coefficient of variation. Are you all having the clarity? Now, on the basis of coefficient of variation, project X appears to be riskier and hence Y should be selected. However, what they're asking in the C part, what is the last part? Which measure is more appropriate in this situation and why? See, this is what they have given. Now, in this situation, what is appropriate? Where only standard deviation or coefficient of variation is what they are asking. See, you have to measure based on risk alone. Standard deviation or coefficient of variation will be a better measurement. They are asking. The solution is on this method. If you see on a standalone basis, NPV is superior. Why? Because our NPV is best because of the conflicting situation. Why? Because NPV in the project X is higher, project Y is higher, project Y is higher. It is expected to give a higher NPV, even though it has marginally higher risk. I agree that risk is there. NPV should be selected. In this case, a project having a higher NPV should be selected. But in this case, ideally, the coefficient of variation is also lower in this case. So both are same. NPV will also be higher. Coefficient of variation will also be more in this case. So anyway, I should select what? Project Y. Are you understanding? Now, next question number 37, sensitivity analysis. This is a question based on sensitivity analysis. See, what is this sensitivity analysis? I explain the concept briefly before going to question. See, very simple. Now, what they say, you have computed NPV, discounted cash inflow minus discounted cash outflow. This NPV is affected by various factors. NPV is what? Discounted cash inflow minus discounted cash outflow. This you agree? Now, for computing discounted cash inflow, there are various things here. One is that this is nothing but discounted cash inflow means all the series of cash flow you will consider, then discount it. Correct? You will multiply it with present value factor. Now, the cash flows is there. To arrive at the cash flow, okay, every year I will have some selling price. Okay, assume I'm a manufacturing company. I will have selling price per unit. Okay, yes, selling price per unit. Okay, then I will have cost per unit. Then I will have profit per unit. Agreed up. Then I will have number of units. Sales is nothing but number of units into selling price per unit. So there is selling price. Okay, cost is there, which means selling price will also affect the discounted cash inflow. Cost also affect the disky. Okay, then the life of the project. Okay, assume how many years you are doing the project. That will also affect the discounted cash inflow. Number of units, volume of the business will also affect the discounted cash inflow. Like this, various factors will affect my discounted cash inflow. Are you all understanding? Which means discounted cash inflow, it will affect, ultimately it will affect the NPV of the project. So NPV of the project is sensitive to various factors. It's sensitive to various factors. What they say, okay, how does these factors influence the NPV? How does these factors affect the NPV is called as sensitivity analysis. What I will discuss, the sensitivity analysis. Okay, there are two approaches. I'll tell you what it is. Okay, I have shown you both the ways of computing. Institute has taken a stand. Sir, what happens now? They will give you selling price per unit. They will give you cost per unit. They will give you, okay, volume, which means number of units sold. Like this, they have given various factors. This I call it as affecting factors. This is affected number. NPV will get affected, influenced by these factors. Agreed? So these factors, what Institute has taken now, if there is a 10% change in, suppose, selling price per unit, or there is 10% change in cost per unit, or there is 10% change in volume, 10% change in life of the project. Like this, they have taken some number, 10% they have taken, and they have tried to find out what is the impact, percentage change in the NPV. What is the impact in NPV? How the NPV will behave, negative NPV or positive NPV, or how much is the percentage change in NPV? So percentage, 10% for every 10% change in the influencing factor, what is the percentage change in NPV? This is what Institute has done. Okay, but actually speaking, sensitivity analysis also can be done. There are other methods also. Now, I say that the selling price per unit is 10 per unit, assume. Correct? I am saying, okay, tell me a number. This is 10 rupees per unit at present. Tell me at what selling price per unit the NPV will be 0. The NPV will be 0, which means I will indifferent between the projects. So undertaking the project or accepting the project or rejecting the project, I will be indifferent. When, at what selling price, okay, when I will be indifferent, when NPV is 0. When NPV is 0, I will never undertake the project. Are you all understanding? Break even point, na? So what they say, at this is 10 rupees per unit selling price, at what price per unit, okay, your NPV will be 0. Life of the project will impact at how many years? For how many years the NPV will be 0? If the project, assume the project life is 8 years. For 8 years, there is an NPV of 2 lakh rupees. Positive NPV of 2 lakh rupees. Okay, for how many years it will be 0? At exactly how many years it will be 0? Like this, we can find out. Are you all understanding? Two ways of presentation is there. Anyway, the summary is that what is the impact of these factors to the NPV is what we are going to compute. Are you all comfortable? Okay. XYZ Limited is considering the project for which the following estimates are available. Initial cost of the project is 10 lakhs. Selling price per unit is 60. Cost per unit is 40. Sales volume given 20, 30 and 30. Okay. 3 years project, 20, 30 and 30. Discount rate is 10% per annum. Okay, for discounting the cash inflows and outflows. Anyway, you are required to measure the sensitivity of the project in relation to each of the following parameters. So 4 parameters are there. You have to find the sensitivity of the project, how NPV will get impacted, how NPV will get affected. So selling price per unit, okay, how it will impact. Then unit cost is there, cost per unit. Then sales volume, number of units sold. Then initial cash outlay, that also is a factor. Initial cash outlay, because I told you now, disky minus disco, discounted cash inflow minus discounted cash outflow. Discounted cash outflow is called as initial cash outlay. Initial cash outlay. This also will be influencing the NPV. Project lifetime. Project lifetime. Taxation may be ignored. Shall we compute? Okay. Calculation of the base NPV. Now, at present, there is value given. At present, we will find out what is the current NPV. Then we will use each and every factor. Then we will find out what is the impact of these factors to the NPV. See. Now, calculation of the base NPV. NPV is equal to minus 10 lakhs, which is, okay, this discounted cash inflow minus 10 lakhs is the discounted cash outflow. This is what they are doing. Discounted cash inflow, first year, how many units sold? 20,000 units sold. Okay, selling price per unit is 60. minus cost is 40, profit per unit is how much? 20. So 20,000 into 20. Correct? This is cash flow. Why? Because taxation is ignored in this question. Hence, okay, you don't consider any depreciation also ignored, taxation is also ignored. What you should do? 20,000 into 20 is there. Divide, this is the first year cash flow, and 30,000 number of units sold into 20 is the profit, second year cash flow. Third year cash flow, 30,000 number of units sold into 20. Are you all comfortable? This is how you will find out. Okay, this 3-year cash flow. First year cash flow discount using 1.1. Okay, 1 divided by 1.1. Then second year cash flow 1.1 the whole square. Third year cash flow 1.1 the whole cube. Are you all understanding? Like those 3-year discounting cash inflow, you will get total minus discounted cash outflow. They have done like this, no issue. Okay, you will get NPV as 3,10,293. This is the base NPV. At present, what is NPV? 3,10,293. Measurement of sensitivity is as follows. Sales price. For sales price, what you should do? Let the sale price per unit be S, so that the project would break even with 0 NPV. See, I will tell you one method. You can solve on your own. The remaining you can try on your own. Very simple and straightforward. See what happens. NPV 0. Now, what should be? See, at NPV 0 means what? Discounted cash inflow equal to discounted cash outflow. Are you all understanding? Which means discounted cash inflow comes to 40. Discounted cash outflow also comes to 40. Then what will be the NPV? NPV will be 0. 40 minus 40, it will be 0. Agreed? At NPV, okay, discounted cash inflow will be equal to discounted cash outflow. This you are agreeing, huh? Not agreeing, huh? Okay, you are agreeing, huh? Now, you tell me what happens. This discounted cash inflow is there, na? I will change the number. What is the selling price? Earlier, selling price was 60 rupees. Now, my target NPV is 0. I know that I will equate it to 0. Are you all understanding? So, 0 is equal to, okay, discounted cash inflow minus discounted cash outflow. Inflow, what I do? 20,000 into selling price. This is SP per unit. I don't know. 60 earlier I took and minus 40 I did and I got 20. I took it as 20. Are you all understanding? Here, I don't know what is the selling price. So, I let a selling price be X or simply S. In this case, I assume to be S. So 20,000 into selling price minus 40 divided by 1.1 plus 30,000 into selling price minus 40 divided by 1.21 plus 30,000 into selling price minus 40 divided by 1.331. Okay, minus 10 lakh. This minus here I have put, no issue. Here you can put minus 10 lakh. Should give you how much? It will equate it to 0. If you equate it to 0, if you solve this, you will get S value as how much? S is equal to 55.26. What is the understanding? At present, the selling price is 60 rupees per unit. Okay, when the selling price per unit becomes how much? When the selling price per unit becomes how much? Okay, 55.26, you will be having 0 NPV. You will be having 0 NPV. At present, the NPV is 3,10,293. Okay, at 60 rupees NPV, 60 rupees selling price. Now, selling price, if it is 55.26 per NPV, will be 0. Are you all understanding? Now, this is one way of understanding. Now, after this, you will decrease in selling price. Now, how much percentage decrease I should decrease to make the NPV 0? How much is the percentage to make the NPV decrease to 0? Now, earlier it was 60. At present, how much is there? 55.26. 60 minus 55.26. First, to find out the difference. First, find out the difference, my dear friends. What is the difference? 60 minus 5. The difference 4.74, which means selling price dropped to 4.74 in terms of real rupee terms. Now, in percentage terms, how to compute? 4.74 divided by, from where it has dropped? From 60 rupees. 4.74 divided by 60 comes to how much? 7.9%. That is what is given. 60 minus 55 divided by 60. Okay, which means, what is the interpretation I'll tell you? If my selling price per unit drops by 7.9% from the existing 60 rupees, my NPV will become 0, or my existing NPV of 3,10,293 will be wiped away, will be washed away. Are you all understanding? Okay, this is what is, okay, this sensitivity. Now, selling price sensitivity we have computed. Okay, alternative solution. This is ICA solution. I have also given the ICA solution. What they have done now, very simple. Okay, sale price decreased by say 10%. If the selling price is decreased by 10%, then NPV will be what you need to compute. So selling price decreased by 10%. 60 rupees was the selling price. What is the revised selling price? 54. Now, taking 54 as the selling price, what you will do? Selling price is 54 minus cost is how much? 40. So 14 rupees is the profit. So 20,000 into 14, 30,000 into 14, third year cash flow 30,000 into 14 divided by appropriate discounting rate. Okay, divided by first year discounting rate, second year discounting rate, third year discounting rate. This will give you total discounted cash inflow minus 10 lakhs will give you how much? Negative NPV of 82,796. This also you can show, which means if my selling price drops by 10%, if my selling price drops by 10%, my NPV will decrease, okay, to how much? Minus 82,796. My NPV will become minus 82,796. Okay, up a total decrease in the NPV from 3,10,293. Very simple. From 3,10,293, it will become how much? Minus 82. Now you add it. 82,796. 3,93,089. My NPV will be dropped by 3,93,089. This is a beautiful question. Okay, this is a decrease in NPV. How much is that? 126.68%. Okay, this is a total drop from 3,10,293 minus 8,073. In terms of percentage, okay, it will be 126.8%. Anyway, this is what they have given. Okay, next question and all I will discuss based on ICA solution. Okay, this you can go through. Okay, now alternative solution I will discuss because ICA have given that solution. I want you to get comfortable with the ICA way of solving the question. No issue. Unit cost increase by 10%. See, very simple. In first case, we see that selling price was 60. Correct? What is the adverse impact if the selling price dropped by 10%? Means the adverse impact is drop in selling price. Are you listening? Now we are discussing in part B cost. Cost in previous question, how much of the cost? 40 rupees. What is the adverse impact if cost drops by 10%? If cost drops by 10%, you will have positive impact. Are you understanding? Your profit will jump. But what is the adverse impact if cost increases by 10%? 40 rupees become 44. If 40 rupees become cost 44, now what will be the profit? Profit per unit. 60 was the selling price minus 44. 16 rupees is the profit per unit into 20,000 units. 30,000 into 16. 30,000 into 16. Like this, you will compute for all these different years. You are comfortable. Okay, so this is what this total of discounted cash inflow minus 10 lakhs. If you do here, I have put it 10 minus 10 lakh upfront. You will get NPV as 48,234. From the original NPV of 3,10,293, it has dropped to 48,234. You are understanding percentage decrease you can calculate or you can leave as such, no issue. Institute will award marks. You don't need to calculate the last step, no issue. You will be awarded the marks. No problem. Okay, last C is there, sales volume. Now, sales volume, now how will you compute volume? Very simple. Volume means selling. See, sales is what you compute. This is profit. It's nothing but selling price per unit into volumes, or volume into selling price per unit, number of units sold. Volume is number of units sold into selling price per unit will give you total sales minus, okay, volume into cost will give you total cost. If you reduct this, you will get profit. Are you all understanding? Profit in the sense here cash flow, since other adjustments are not there. First year volume into selling price 60 minus 40. And one more important thing I forgot to tell you, very simple. See, what they say is that when you are computing one the affecting factor, if you are trying to find out what is the impact of the sales volume to the NPV, you are calculating volume impact now. Now you will assume that all the remaining numbers will be same. For example, you are computing what is the impact of sales volume. Agreed? Now selling price or cost, both this will be same 60 and 40. Same original 60 and 40, it will remain same. Project life, okay, what is the year? Project life will remain the same, 3 years. Like this, you will assume that all other factors will be same. Original factors will be continued. Only the factor which you are taking for finding the influence, that only should be altered. Okay, you should not say volume I will take here, the 60, can I take 54? Okay, in the previous question I took it 54, now can I take 54? Or cost 40 rupees was there, 44, adverse cost, can I take 44? No. All the remaining should be same. Then only you can find the perfect impact of this factor. Are you understanding now? So volume into 60 minus 40, volume into 20, 20 into V, into 1.5 V into 60 minus 40. Why? Because originally you had 20k units, 20,000 units, then there is 30,000 units, then there is 30,000 units. So 20,000 units, the appreciation, the number of units sold, the growth in number of units will be remaining same, is the assumption, which means you have to keep it same now. So 2030 now, it is a 150% growth. Here also that will be same. So 1V if you consider now into 150%, how much? 1.5V. That is what they have taken here. 1.5V, 1.5 volume. Agreed? This if you discount using present value term, the total discounted cash inflow minus the discounted cash outflow. Okay, the NPV, if you equate it to zero, you will get the volume. Very simple. Volume is how much? 15,263.76. 15,263. At 15,263 units. Very simple. At present, what is the unit? First year unit. At present, what is the unit? 20,000 units. If 20,000 units drops to 15,263 units, my entire NPV will be wiped out and the NPV will become zero. Understand? Now, alternative solution again, institute taken exhaust from volume decreased by 10%. Sales volume, existing sales volume 20,000. 30,000 and 30,000, which means decreased by 10% na. Okay, 20 decreased by 10% na, it will become how much? 18,000 units. Here it will be 30 decreased by 10% at 27k units and 27k units. Are you all comfortable? This is what they have done. So 18,000 into 20, 27,020. Other things remain same. 60 minus 40 will be same. 27 minus 20. Discount these cash inflows. Okay, minus 10 lakh discounted cash outflow. You will get NPV as 1,79,300. Getting 10% increase in sales volume. What is the impact in NPV? Like this initial cash outlay. Okay, I will show you the alternative solution alone. This solution you don't need to worry. Anyway, alternative solution. What is the alternative solution? Very simple. Initial cash outlay increase by say 10%. Adverse effect. See, initial cash outlay. Adverse effect is what? Increase or decrease or increase. Which means increase means how much? Okay, at present, what is the 10 lakh is the discounted cash outflow. If it is increased by 10%, 11 lakh will be the discount. Understanding. So 11 lakhs will be there, discounted cash outflow, all the remaining things will be same. NPV will be 2,10,293. Are you all understanding? Percentage decrease, you need not also compute. This is what institute follows, you can do. Which means if my initial cash outlay increased by 10%, NPV will be dropping from 3 lakh, some number 3,10,293 to 2,10,293. Some number. First original number was what? Yes, 3,10,293 to 2,10,293. 32% is a decrease. Now, project lifetime, very important adjustment. Very simple. What they've done. Okay, see here also you have alternative presentation. Okay, no issue. Here we will see that what they say, the present value of cash flow for first 2 years. You see find out the NPV, which means you need to do interpolation here. Why? Because it will be, if to make the NPV 0, the project life may be something in between 2 or 3 years or 1 or 2 years. Agreed? So 2 or 3 years or more than 3 years, we have to see. So what you have to do? Okay, you need to compute NPV. Okay, assuming the present value of cash flows for first 2 years. So assume the project is for 2 years. First 2 years, 20,000. Units will be 20,000 and 30,000 into profit 20. Okay, discounted using first year rate and second year rate minus discounted cash outflow of 10 lakhs. How much is the NPV? NPV minus 1,40,496. Are you all understanding? Now, so you see, present value of the cash flow for year 3 is how much? 30,000 into 20 divided by 1.33. Now, how much? 4,50,799. Are you all listening? So, what they say? Okay, for year 3 alone, what happens? 1,40,000, you increase. How much you need to increase? See, very simple. Your NPV, if you want to bring down your NPV to 0. If you want to bring down your NPV to 0, it will come in between 2 to 3 years. It will be something in between 2 to 3 years. This is what I have done. This is how I have done the interpolation. Very simple. Okay, very simple. If you run the project for third year alone, project's NPV, how much is the cash flow, present value of cash inflow of the third year? 30,000 into 20, 6 lakhs. The 6 lakhs divided by third year rate. So present value of the third year cash flow alone is how much? 4,50,789. Present value of the first 2 year cash flow alone is how much? 1,40,496. To put it simply, if you run the project for 2 years, you will earn an NPV of minus 1,40,496. If you run a project for third year, this last 1 year will give you increase of 4,50,789. Are you all understanding? Very simple terms. I'll tell you what happens here. See, first 2 years, you earn a NPV, total NPV of how much? Minus 140,496. 140,496. For the third year alone, what is the NPV? 450,789. 450,789. Now, if you total this two number, you will get 3,10,293 some number. Are you all understanding? That is the original NPV number. Agreed? I'll just check it, cross verify. 4,50,789 minus 144,96. How much is that? 3,10,293. Agreed? 3,10,002. This is the original NPV. This first year discounting cash flow plus second year discounted cash flow. Okay, this you will get. Now, the point is, what they say is that this is the total discounted cash. What is that? Yes, info. This is the total NPV. Now, what they say, if you run the project for first 2 years, you will get the negative NPV. If you run for the 1 more year, you will get the 4,50,000. Okay, NPV will become 3,10,293. Agreed? The increase will be 4,78,008. I will show you here what happens. You have to do the interpolation. Okay, nothing great. Okay, intermediate. The payback period you will compute now, something similar to that. Here, NPV impact. You see what happens here. If you increase the project life by 1 year, what will be increase in NPV? NPV increases or decreases? Increases. From NPV of minus 1,40,496, NPV will become 3,10,293 if you run the project for the third year. For one particular year, how much is the net NPV added? 4,50,789. Are you understanding what I'm trying to say? If you add one more year to the project, this is year. If you run the project for one more year, NPV will increase by 4,70,789. Hence, minus 1,40,496 became 3,10,293. Now, what I say, you should make the NPV zero. At what project life, NPV becomes zero. That is what you are computing now. See what you do. You should make NPV zero. Now, what you should be adding? Minus 1,40,496. Now you should be increasing the NPV from minus 1,40,000 zero. To make it zero, how much you need to add? Simply 1,40,496 minus 1,40,496 plus 1,40,496 will make you zero. NPV will be zero. Now if I run for one full year the project, I will make 4,50,789, but I only want 1,40,496 from the project. What is the amount? Very simple. 1,40,496 divided by 450,789 into 1 year is equal to, in terms of years, tell me how much is in terms of year? 1,40,496 divided by 4,50,789. Okay, 0.31, which means 0.311 years or 0.32 years, 0.32 years, which means originally you had how many years project? 2 years project plus 0.32 years. How much is the total value? 2.32 years, which means if you run the project for 2.32 years, your NPV will be zero. If you run the project for 3 years, NPV will become 3,10,293. If you run the project only for 2 years, it will be minus 1,40,000. 40,000. What is that? 496. Are you all comfortable? Note, in this question we solve sensitivity as percentage change just to make the NPV as zero, but ICA as discussed in the lecture as discussed in the lecture assumes 10% change to see the change in NPV. Any alternative method we can also use solve the 10% ad hoc amount. You can also solve by 5 or 20%. Institute has taken a stand of taking 10%. You also better to follow the same. Now, can we discuss the base case NPV and adjusted NPV? Very, very important concept. Okay, question number 38. Through this question, I'll try to explain the base case NPV and adjusted NPV. The management of a multinational company, TL Limited, is engaged in construction of infrastructure project. A proposal to construct a toll road in Nepal is under consideration for the management. The following information is available. The initial investment in purchase of equipment costing USD 50 lakhs. The economic life of the equipment is 10 years. The depreciation on the equipment will be charged on a straight line method. EBITDA to be collected from the toll road is projected to be USD 33 lakhs per annum for a period of 20 years. Now, to encourage investment, Nepalese government is offering a 15-year term loan of USD 15 lakhs at an interest rate of 6% per annum. The interest is to be paid annually. The loan will be repaid at the end of the 15 years in one tranche. Bullet repayment, one shortly they are paying. The required rate of return for the project under all equity financing is 12% per annum. This is KE. Okay, this is nothing but K. Now, post-tax cost of debt is 5.6% per annum. Corporate tax rate is 30% per annum. All cash flows will be in USD. Ignore inflation. Okay, what they was asked us to compute, you are required to advise the management of the viability of the project using adjusted net present value method, which means base case NPV and adjusted NPV. But concept called as adjusted NPV. Present value factors, all the annuity factors given. Now, see, I'll just explain briefly what is this base case NPV and adjusted NPV. Then we will on to the solving the question. See, very simple. What they say, when you are trying to compute the net present value of the capital value, see, very simple. You have assumed you have taken 150 crore project, a project which is available for 150 crore, out of which what you do, okay, you put 100 crore of your own money, I call it as equity, and for the purpose of undertaking the project, you borrow 50 crores. Are you listening? This I call it as debt. See, the project is being undertaken, right? okay, by equity funds as well as by debt capital. Agreed? Now the 150 crores is funded by both equity and debt. Now, from the project, this is what is initial cash outlay. This I called as initial cash outlay. I spend 150 crore and undertake the project. From the project, what I earn, assume I get some EBAT. This EBAT, what is the peculiarity of this EBAT? This EBAT belongs to 4%. One is the, okay, debt providers. Okay, debt holders will take interest from it. Are you listening? Next, government is there. Government will take tax from it. Okay, the T means tax. Next, there is preference shareholders, if any. If there is any preference shareholder, he will take preference dividend, and balance left out, okay, will be provided to the equity, which will be shared amongst the equity shareholders. Are you all understanding? Now, this is EBAT. So, very simple terms. EBAT is the, okay, earning which is available for all the fund providers, and say the PAT, if I am taking the profit after tax or earnings available for equity holders, okay, earnings available for EAT, earnings available for equity shareholders, EA as such, earnings available for equity holders is what? Is the earnings, okay, which is attributable only to the equity shareholder. Are you all understanding? When I say EBAT, the project will earn me EBAT. Okay, there are two approaches for it. I say V approach and I approach. There are two ways to find, okay, two ways to do the capital budgeting, find out the NPV. Are you understanding? Okay, now very simple. Here, I can say this approach. If I calculate the total amount, okay, the outlay, I take it as 150, which includes the 100 equity and debt. And then, okay, this through investing this 150, I get this EBAT. Okay, thereafter, what I will do, I'll take the EBAT number, okay, which is profit available for all the fund providers. Then I will, okay, remove the taxation, EBAT into 1 minus T. I'll get the notepad, then add back cash flow after tax. Okay, this is one way of doing it. This total approach, okay, equity shareholders approach. There are two approaches to find out the NPV. Agreed? Now, this you keep in mind. Why I'm saying, I'll link it to the current concept. Very simple. Now, you have EBAT under total approach. You have EBAT. Yeah. Generally, for NP, what is NPV? I'll just briefly tell you. NPV is what? Discounted cash inflow minus discounted cash outflow. If you see, the outflow also you consider this 150, and discounted cash inflow also, okay, the no PAT, you EBAT into 1 minus T, you will take EBAT into 1 minus T, then add back non-cash item depreciation, you will get something called a CFAT. I explained in the first question itself, you can go through. This PAT is a cash flow available to all the fund providers, which means the cash flow which is generated totally by the project, which will include the interest portion also. Are you all understanding what I'm trying to say? Now you tell me, okay, the CFAT you computed, I will get the NPV. So CFAT, I'll take the discounted cash inflows, then minus discounted cash outflow, I'll get the NPV, correct? You have computed net present value, it is nothing but net benefit from the project. The problem here is, this is the way you computed NPV. Now what is the, okay, concept? I'll discuss the base case NPV, adjusted NPV. Why this concept came, I'll tell you. Very simple. Okay, see, you have told that you will take V approach. You told the debt providers also you will consider as yourself, okay, which means capital providers. You included them in the outflow amount, and then inflow also, this cash flow available to all the capital providers, correct? Fine. There is a problem. What is that? If you undertake this project, really speaking, what is the risk of the project? Variability in return of the project is risk of the project. You tell me. The debt holder, okay, yes, he will give you the money, but when he takes back your money, you will pay him interest. You will pay the debt holder's interest. This will be fixed in nature. Which means the debt providers will never participate, okay, or never undertake the risk of the project, Really speaking, yes, you use debt providers fund and you use your own fund to undertake the project. But if the project is successful, anyway, that is not an issue. If project is unsuccessful, debt holders will never bear the risk. Are you all understanding? So they will still demand the interest from their capital, and they will not undertake any kind of risk. So which means the project cash flows which you used, you would have studied in the NPV, discounted cash inflow minus discounted cash outflow. We use WACC for discounting. You would have studied in intermediate itself. WACC, I also discussed in the first question itself. WACC you will use for discounting. Weighted average cost of capital or overall cost of capital. I call it as KO. This you use KO for discounting the cash flow after tax. what they say, really speaking, this is discounting factor represents risk. You are trying to, okay, because of risk only, you are trying to discount the cash flows to bring it to present value terms. Agreed? Now what they say, if you discount using KO these cash flows, which are risky in nature, and this only equity shareholders are bearing. So you should never use KO. If you use KO, very simple, you tell me children, KE, assume is 15%. KD, always we have studied in intermediate itself, KD will be always lesser than KE. K, cost of equity is the highest. Okay, what is that? Cost. Okay, KD, KP, anything you take, KE will be the highest. Even though explicitly that may not be mentioned, but still KE will be highest. So debt providers assume KD is 8%. So KE is 15%, KD is 8%. You tell me, what will be the KO weighted average cost? Say some proportion 40 is to 60. Okay, 60 debt, 40 is equity. Now tell me, KO will be more than KE, less than KE? Always less than KE. Why? Because KD is less than KE. Are you all understanding? So KO, if you calculate, I don't know what is the exact KO, no issues, but I know that the KO will be more than KD, but less than KE. Are you all understanding? So the KO will be in between KD and KE. And a weighted average cost of capital, KD element will also be there, KE elements will also be there. I compute the weighted average capital, which will come in between. Now, what is the point? This CFAT, this cash flow after tax annual cash flow, if you discount these cash flows using KO, it is really that you are undermining the risk. Really speaking, this cash flow, okay, is risky cash flow, belongs to only equity holders. You should use KE to discount and not KO to discount. If you use KO to discount, see how much higher the discounting rate, that much you are taking the risk. For example, I say Reliance Limited shares is there. You will use, okay, the RF risk-free rate of interest to discount the Reliance Limited cash flows or no. Risky rate you should use to discount the Reliance Limited capital cash flows. Why I'm saying is, more the risk, higher the discounting rate you should use for discounting the cash flows. Agreed? Now, instead of KO, you should really use the KE because, okay, if you use KO, which means you are undermining the risk, you are under calculating the risk. That should not happen. You should take the real risk. KE should be taken for discounting. Why? Equity holders only undertake the risk of the project. Are you all understanding now what they say? Even though you would have taken debt for the project. Now, I'm just no space here. I will just put this, what they say, conclusion. Okay, yes, even though you, what do you do? Okay, now see, even though you take KO for discounting, really speaking, you should take only KE for discounting. Agreed? First point number one. Next point, sir, this company, I have KD, I have debt in my capital structure. I have taken debt or not? See the question. Okay, carefully. In this question, the loan is taken here. The loan is taken. Debt is there in the capital structure. To undertake the project, I take loan. Sir, really speaking, I take the loan. So how can I use the KE to discount? Question arises what they say. Even though you have taken the risk, okay, even though you take WACC for computing NPV, first what you do, compute the WACC, or compute the NPV by taking KE as the discounting rate first. If I discount the CFAT annual cash flows, okay, all the cash flows using KE at KE, discount the cash flows using KE, I'll get some discounted cash inflow, then reduce the discounted cash outflow, I'll get some NPV. This NPV I call it as base case NPV. What is this NPV? Base case NPV. Okay, I'll use all equity KE to discount all these cash flows and find out the NPV. This I call it as base case NPV. And I adjust the tax effect. Okay, the tax benefit arrives from the debt in the capital structure. Are you understanding? I've taken a debt. Now, the debt will give me the interest portion, right? I will have interest expense. This interest expense will give me tax benefit, corresponding tax shield. What I will do, okay, I will find out this tax benefit will be there only for 1 year over a period of your interest payment. Okay, whatever is the interest payment period for 20 years if you have taken loan. For all these 20 years, you will have interest. If 20 years you will have interest, corresponding tax benefit you will have for 20 years. Agreed? Now, the 20 years tax benefit will be there now. So discount the tax benefit. Find out the present value of tax benefit. Arising out of this interest cost. Are you understanding? So adjusted NPV. This is called as adjusted NPV. Adjusted NPV is equal to nothing but base case NPV. BC NPV base case NPV plus present value of tax benefits or tax shield, present value of tax shield or tax benefit of the interest. Are you all understanding? Now, computation is 1 minute issue. No, conceptually, if you understood computation, you can easily understand. Shall we move on to solving the question? Okay, now one by one, tell me, children, what they say. Computation of CFAT, cash flow after tax, just like we did the question number, same process. Now, starting point, EBITDA. Why they have told that for 20 years you will generate the total, okay, collection will be EBITDA. How much? 33 every year, 33 lakhs. Yes, 33 lakhs USD per annum. So 33 lakhs. Here 0 to 1 to 10, 11 to 20. Why I have taken separately? Depreciation will be changing. Why? Because if you see, the project life is only 10 years, but the benefit derived from the project is 20 years. This is a unique question. Generally, what we have seen in capital budgeting, how many years cash flows will be there? The benefit, okay, the life of the project, the benefit will accrue over a period of the life of the project. But in this case, what happens? Okay, the life of the project is only 10 years. So depreciation you will, okay, adjust for only for 10 years. Balancing years, 20, benefit will be, okay, therefore, even 20 years, which means balance 10 years, you will have no depreciation, but you will have the corresponding benefit. Are you all understanding? See here. They have given, yes. Where is the depreciation adjustment? Yes, the initial investment will be the purchase of equipment, 250 lakhs it cost, and economic life is only 10 years. So depreciation will be provided on a straight line basis for 10 years. But the benefit derived from this, okay, is for 20 years. EBITDA to be collected for toll road project is for 20 years. Now, that is why they have separately shown calculation of depreciation only the only issue. Now, see. So EBITDA value is there, less depreciation. How much is the depreciation? Straight line basis, 250 lakh cost of equipment divided by 10. 10 years is the life, 25 is the depreciation. For this period, balance 10 years period, no depreciation. Just you will get the, okay, EBITDA. Now, EBITDA minus depreciation will give you what? EBIT. EBIT is 8 in this case. Here entire, okay, the EBITDA will become EBIT. Next, tax is 30%, reduce the tax amount. You will get earnings available for tax holders, EAT or PAT. Okay, add back depreciation. Okay, see, very simple. What is the, I told you now what you should do. EBIT into 1 minus T plus depreciation will give you CFAT, cash flow after tax. That's what they have done. EBIT minus T, into 1 minus T is as good as minus T. Okay, will give you EAT. Add back depreciation. You will get the cash flow after tax. Now, this is the first 10 years cash flow. This is the balance 10 years cash flow. First 10 years cash flow, question like given, you tell me, children, what is the 10 years cash flow present value discount? Which rate you will take for discounting? Present value annuity factor for 10 years, 5.650. You multiply the 30.6 into, okay, 5.65. You will get the 172.89. Now comes to the balance 10 to 20 years cash flow. What is the annuity factor? Cash flow is 23.1. What is the annuity factor now? See, you should not make the mistake of taking this number. Present value annuity factor for 20 years is 7.469. For 20 years is 7.469. Okay, I have uploaded the time value of money. There itself you can see the comprehensive revision series. I have uploaded time value of money there. Okay, I might have covered, maybe I might have skipped also. Very simple. I'll explain here briefly. This is mid annuity factor. This is called as mid annuity factor. See what they say. For 20 years, year 1 to 20, if total annuity factor, if you want to compute, it will be around, it will be 7.469. But you want annuity factor from 11th year to 20th year, which means I call it as mid annuity factor. So what is the formula for mid annuity factor? Formula is, what is the understanding? Mid annuity factor is nothing but okay, is nothing but total periods annuity factor. What is that? 20 years annuity factor in this case. You take 20 years annuity factor. From there, you reduce the first 10 years annuity factor. First 10 years annuity factor. How much is that? See, this is 7.469 minus 5.65. You will get 1 point. How much is the value? Here you have given 1.819. Can you see this? This is called as annuity factor for from 11th to 20th year, second 10 years period. Okay, that is what is there. So multiply 23.1 into 1.819, you will get 42.019. Are you all understanding? So PV of cash flows, I have 2 PV present value. I just to simply add it. Total present value of cash inflow comes to this much minus outflow. You will get the NPV as this much, 35.0911. Now the important point. Sir, you told that you should be this NPV, this cash inflows is there, cash outflow is there. You need to discount now. The cash outflow you leave it because initially you will find out the cash outflow. So discounting factor will be 1, no issue. this present value of cash inflow, what rate you have used to discount? Here, question given, that is fine. But if you notice carefully, 12% is the rate given for 10 years and 12%. What is this 12%? This 12% is KE. This 12% is KE. That is what I am told, which means for project cash flow, you should not use WACC to discount to find out base case NPV. You should use KE. Okay, just like assuming the company to be all equity company and discount using KE, find out the base case NPV, then adjust the tax benefit, present value of the tax benefit to it, and find out the adjusted NPV. Now, why we need to segregate base case NPV into adjusted NPV? That is a separate concept. I don't want to go deep into it. I've discussed it in regular lecture. Very simple. I'll tell you briefly what happens. See, the adjusted NPV is to the base case NPV and the adjusted NPV. The segregation is required to show the management the source of the NPV, from where the NPV arises. Are you understanding? In some cases, where in case of listed company, there might be some flotation cost, some other cost involved. Okay, from there, how much NPV is generated? From this, the tax shield, how much is the NPV generated? This, if we can segregate, it will give a more informed decision to make. It will give you more data for management. That is why we do it. Okay, we have one good comprehensive question which to have in its we have separately in our regular lecture, we cover that, but no issue, not needed. Hence, I'm not going that deep here. Okay, see, now to put it simply, here we have computed base case NPV as how much? 35.0911. 35.0911. Now, base case NPV, adjusted NPV, we need to find out. What is question asking? Adjusted NPV. Now, adjusted NPV is equal to base case NPV plus PV of tax benefit of the interest. Tax benefit. Are you understanding? So, PV of tax benefit on interest, we need to compute how much is the loan amount. 150 lakhs is the loan amount. Okay, interest cost how much? 150 into 6% every year. So, 9 lakhs is the annual interest rate. Okay, tax benefit is how much? Into 30% is 9 into 30%. You will get 2.7 as tax benefit. This tax benefit will be for how many years? This will be repaid at the end of 15th year. So, loan, okay, will be repaid at the end of 15th year. Now, there will be no interest from the 16th year. So, for 15 years, 8% cost of debt. Sir, one important adjustment is there. Okay. Sir, in here, we have taken pre-tax cost of debt. Pre-tax cost of debt should be taken for discounting. For discounting, okay, here we need to take for discounting the tax benefit of the interest. For discounting tax benefit of the interest, carefully listen, very, very important adjustment. To discount the cash tax benefit of the interest, you need to take pre-tax interest or post-tax interest or pre-tax interest to discount. Are you all understanding why I am saying this? WACC computation, you will use post-tax cost of debt. Post-tax cost of debt. Okay, post-tax KD, you would have remembered post-tax KD while computing WACC. Okay, in the intermediate also you would have seen post-tax cost of debt. There we will consider. Okay, for computing the tax benefit of the interest, we will use pre-tax cost of debt. Why? Because very simple. See, the interest is a number which is pre-tax or post-tax or pre-tax cash flow. Very simple. Pre-tax cash flows. Okay, one line summary. Pre-tax cash flows to be discounted using pre-tax cost of debt. Okay, post-tax cash flows should be discounted using post-tax rate. In this case, the interest, you are trying to find out the tax benefit. Therefore, you should not adjust the tax and then find out the present value of tax. Are you all understanding? We are only finding present value of tax. Correct? It is nothing but the present value of tax benefit. For that, you should not again consider tax or for discounting. So, you will use pre-tax cost of debt. Okay, to discount this. This is very, very important. So, 8 into 1 minus 0.3, you should not commit that mistake. That's why I'm stressing that. Okay, present value annuity factor given in the question 8.559. Interestingly, if I was here, okay, I would have coined one more data here. 8 into 1 minus 3, 8 into 0.7, let's say 5.6. I would have put here to confuse present value. Okay, present value factor. What is that? 5.6% and 15 years. This I would have given as some number. Are you all understanding? To confuse? Anyway. Now, 8% only rate given, so you'll take, but there is a logic, you should take pre-tax cost of debt. Next, present value of tax benefit on interest is 23.109. So, pre-tax KD is given as 8%. Okay, question, see here, they have given the 5.6 in the question and 8% present value annuity factor. Anyway, 5.6, if you want to convert a pre-tax number to post-tax number, what you should do? Okay, pre-tax number to post-tax number. Now, you should multiply it with 1 minus T. If you want to convert a post-tax, if you want to convert a post-tax number, right? This is pre-tax number. 8 into 1 minus t, if you do, you will get 5.6. If you want to convert a post-tax number given in this question, post-tax cost of debt to pre-tax, divided by 1 minus t, you will get 8%. Are you all understanding? This is very simple. No, so adjusted NPV is equal to base case NPV plus present value of tax savings on the interest. Okay, so present value of tax savings from the interest is 23.109. Okay, base case NPV is negative 35. Yeah, first, what is that? Base case NPV here, total inflow minus, okay, I have missed the minus here, negative NPV. This is correct, negative NPV, because inflows is less than outflows. So negative minus 35.091 plus 23.109 minus 11.982 lakhs. Okay, advice, since the adjusted NPV is negative, you will not invest in the project. But ideal, this conclusion is not, okay, the reason for which we are computing the base case NPV and adjusted NPV. Really speaking, what they say, if you tell, okay, the NPV is 11.982 lakhs, the NPV of 11.982 lakhs, what they say, the minus 11.982 lakhs, assume NPV is negative. NPV is negative. How much is the total NPV now? Minus 11.982 lakhs. This, we know that. But if management asks, so tell me what is the source of this NPV? Negative NPV, but what are the source of the NPV now? You will say, okay, the base case NPV is actually negative 35.091, and okay, I get some tax benefit out of the interest. The present value of tax benefit is how much? 23.109. Are you all understanding? Now, if you take more debt, so if you take more debt and, okay, lessen the equity exposure, maybe this amount, okay, present value of tax benefit may increase. Okay, say let's say present value of tax benefit becomes 35 lakhs, and this reduces to how much? Minus, okay, minus say some 23 lakhs. Are you all understanding? Okay, the ulta, that became negative 23 and this became positive 35. Now, if you took more debt, it might be possible. We have to verify. But if this is the case, okay, this, okay, base case NPV and adjusted NPV, the segregation of base case NPV, adjusted NPV will give you an important detail that you may undertake the same project, which may give you overall negative NPV. But if you, okay, undertake the project by taking more debt, it may be even viable. Okay, an unviable project may be even turned viable through this process. Are you all understanding? So these are all the issue. That is why we try to segregate this. Anyway, this is the concept. See, in this question, note also given, you can go through in this question, why pre-tax KD has been considered for discounting instead of post-tax. If you are finding tax savings, which is effectively the tax amount and not the interest amount, after-tax cash flows only should be discounted using tax discounting rate. Tax cash flows should not be discounted using after-tax rate. Anyway, given this, we will discuss in lectures also. Okay, next. We will discuss the replacement decision. Very, very important concept. Replacement decision. Every alternative attempt they used to ask. See. Now, what is this concept? Again, I'll briefly explain. Advanced capital budgeting. I'm taking a little bit more time to elaborate because sometimes I feel these questions are very important. Without understanding the concept, why I'm explaining this replacement decision. There are so many methods of presenting the same answer. Okay, but presentation differs. Students get confused. I'm seeing that every attempt, okay, they get confused with this replacement question. These are all the few questions, okay, and the initial cash outlay, the discounted NPV also, they're getting confused because of different presentation method. So I'm trying to tell the underlying concept. I'm trying to explain the underlying concept. Thereafter, you can see any question and be comfortable what they are doing. Shall we? Okay. What happens? See, I'll take separate page and then briefly explain and then come back. See. Here. We have various techniques. Okay, NPV and IRR predominantly, okay, the technique to evaluate the project. NPV and IRR, most of the technique. Okay, the important technique I'll tell you, NPV and IRR. Now, NPV, IRR, if you are, see, as per NPV, what is the decision making as PV? If NPV is more than 0 or NPV is positive, accept the project. Agreed? If NPV is less than 0, reject the project. This is what you will decide based on NPV. IRR, now what you will do? Decision making using IRR means if IRR more than cost of capital, okay, accept the project. IRR less than cost of capital, reject the project. Are you all understanding? This is what you used to do. Now, if you find generally what happens, NPV, okay, well, if IRR is more than cost of capital, if IRR is more than cost of capital, generally NPV will also be positive, which means the project, okay, both the NPV as well as IRR will, okay, hint you to select the project, accept the project and undertake the project. The problem is, sometimes what happens, there may exist, Okay, NPV IRR conflict, NPV IRR conflict, which means NPV, okay, there are two projects, assume A and B are two projects. Okay, the initial cash outlay, both the project you spent 50 lakhs and 50 lakhs, agreed? Now, this is discounted cash outflow, discounted cash outflow. Next, the project A, assume the project A, okay, life is 2 years. The project A's life is 2 years. This is a 1 year project, assume. The 2 years, now first year, the cash flow, okay, assume the first year cash flow, this is second year cash flow, assume first year cash flow, some number, say 30 and let's say 60, 30 and 60. Here, when it comes to project B, first year cash flow 90, second year nothing, because this is just a 1 year project. Are you all understanding? Now what they say, if you compute NPV, okay, I don't know what is the exact NPV, but believe me, NPV will be more. In which case NPV will be more? See, 30, 90 I'll take. To remove the doubt, I'll clearly mention here 90. So 30 and 90, 2 years cash flow was present. The inflows are 30 and 90. Are you all understanding? So NPV is what? Present value of this 30 and present value of this 90. Okay, minus 50, you will get some NPV. Okay, shall we do it? Very simple. At 10% is the cost of capital. Assume 10% is the cost of capital. Okay, the NPV, what will happen? See, 30% of 1 divided by 1.1 is equal to how much? 0.909 into 30 into 0.909. Here 90 into 864 into 0.864. So 90 into 0.864, how much is that? 77.76 plus, okay, you have 30 into 0.909. How? 30 into 0.909. 27.27. Okay, if I add these two, 77.7. Okay, I'll get some 105. Assume the total discounted cash outflow comes to 105. Okay, some decimal number, leave it. Discounted cash inflow comes to 105. Minus discounted cash outflow, how much is the NPV? 105 minus 50. Okay, 55, yeah. Yes, 55 is the NPV. Are you all understanding? This NPV is 55. Okay, believe me, this NPV will be less or more 90. Okay, 90 into 0.909. 1 year cash flow, 81.81 minus 50. How much is that? 31.81. NPV, which project NPV will select? If you use NPV project, which project NPV we select? This project. Project A will be selected by the NPV method. Are you all understanding? Now, where you have so many projects, you can select any projects. Now, there is no issue. But where mutually exclusive projects comes into picture, which means either you can select B or you can select A. Only two, allow either of these two projects only you can do. You cannot undertake both the projects. Okay. NPV is positive in case of both the project. IRR may be both the project. IRR may be more than cost of capital. Can I do more than both of the project? No. Because, okay, this is mutually exclusive project. When it comes to mutually exclusive project, either I can select A or B. Upon which project I will select? I will select that project which is giving me highest NPV. I will select that project which is giving me highest IRR. Correct? But in this case, what happens? Highest NPV, A, project A. Okay, NPV selects project A to be undertaken. But if you notice the IRR, I don't know what is the exact IRR. IRR, do the interpolation method. Discounted cash IRR is the rate at which discounted cash inflow will be equal to discounted cash outflow, or NPV will be 0. At IRR, NPV will be 0. Okay, now at IRR, what happens? IRR, believe me, project B will be selected. Here IRR will be more. I don't know exact IRR, but IRR will be more in this case, project B, and IRR will be less. Why? I'll tell you. Because IRR, okay, NPV sees the quantum of the return. NPV method sees the amount of return you generate from the project, whereas IRR, okay, sees the recovery of the amount, okay, the timing, or I should say the rate of return generated by the inflows. Are you all understanding? So 90 rupees is generated from project B in one single year, whereas for project A, 120 is generated, but generated over a period of 2 years. Are you all understanding? So there exists NPV IRR conflict. This I call it as NPV IRR conflict, which means NPV selects one project, IRR select another project. What is to be done? This is the question that is to be answered. Are you all understanding? Now, this NPV IRR conflict, okay, it is solved under two methods. Okay, life disparity, timing disparity. Life disparity is what I'm going to discuss. Timing disparity, I'm not going to discuss here. Are you all understanding? Okay, anyway, life disparity. Now, see, so, okay, there is conflict. What is the reason for the conflict? We need to understand. The reason is, project A is a 2-year life project. Okay, it is wrong to compare a 2-year project with a 1-year project. Project B is undertaken only for 1 year, whereas project A is undertaken for a period of 2 years. Life of project A is 2 years, life of project B is only 1 year, which means, okay, you cannot do this method. What you should do, okay, to bring in a parity, you should find out something called as EAB or EAC. See, EAB or EAC. What you should do, a 2-year project is there, you should, okay, equate it, find out the equivalent annual benefit or equivalent annual cost. That is called as equivalent annual benefit or equated annual cost. EAB or EAC method you should apply. Okay, the 2-year project is there. Similarly, okay, project A might be 7 years, project B will be maybe for 9 years, assume. How will you do? Okay, 7-year project, okay, you should find out the equated annual benefit from it or equated annual cost from it. And the 9-year project, you should find out the equated annual cost or benefit. Are you all understanding? Both the years are different, na? Life is different. Equate it, make it annual. Okay, in annual terms, like you compare, you bring in a comparability, then you will find out, okay, whichever is giving me the equated annual benefit, na? Whichever project is having EAB, okay, highest EAB, you will select the project. Or if the question is predominantly cost oriented question, you will select that project whichever is giving you lowest EAC. Are you all understanding? Now we need to see whether the question is cost oriented, predominantly cost oriented question or predominantly benefit oriented question. Very simple. Yeah, NPV is what? See, NPV is what? Discounted cash inflow minus discounted cash outflow. If outflow is more, okay, the NPV will be negative, minus NPV will be negative, NPV will be there, which means negative NPV will be more, discounted cash outflow will be more, which will be the cost will be more. Are you all understanding? In this case, if cost is more than the benefit, it will be predominantly cost oriented question. Minus NPV will be there, negative NPV anyway will be there. You will select that project whichever is having a lowest NPV, whichever is having lowest negative NPV. That is the understanding. Now if it is a benefit oriented question, okay, you will select that project whichever is giving you highest positive NPV, highest positive NPV. All this fine, sir. What is this EAB, EAC? What is the formula? Very simple. Normally you compute the NPV. Normally you compute the NPV, which means net benefit you compute. It may be positive or it may be net cost also. This is net benefit or net cost. Are you all understanding? Normally you find the NPV. NPV is nothing but present value of all the future benefits. Correct? You find out, normally discount it and find out the NPV, net benefit or cost, divided by annuity factor, respective annuity factor, which means, see, very simple. If this is the 7 years project, if this is a project of 7 years, what you should do? Okay, NPV you will find out, normally you will find out the NPV taking 7 years life, divided by annuity factor for 7 years at the cost of capital. Whatever 10% discounting rate is given now. 7 years, 10 years, 10%, 7 years, 10% discount rate. Okay, you will take the annuity factor, present value annuity factor, and you will get the EAB or EAC. Are you all understanding? Okay, same way 9 years project, you will discount using, divide it using 9 years annuity factor. You will annualize it and then compare it. Decision you can take. Are you all comfortable? Now shall we do the replacement cycle? See. Can you see this? Right. Now, a machine, take this question. Now we can simply understand a machine used on production line must be replaced at least every 4 years. Cost incurred to run the machine according to its age are, age of the machine given. Okay, year 0, 1, 2, 3, 4. Okay. Now, what they say, this machine has to be replaced compulsorily at least every 4 years, which means you can replace, okay, at the end of first year, at the end of second year, at the end of third year, even at the end of fourth year, which means between the 1 to 4 years, you have to compulsorily replace. What could be the replacement cycle that you decide? What, as per the cost benefit analysis, you do the cost benefit analysis, you decide whether to replace. That is what is the question asking, whether to replace the machine at the end of 1 year, 2 year, 3 year or 4 year. But it should be compulsorily replaced within first 4 years. Agreed? So purchase price of the machine is 60,000. I purchase the price machine for 60,000. Maintenance cost 16,000 for first year. Second year, this is the maintenance cost. Third year, fourth year. Repair cost given for all the 4 years. Scrap value given for all the 4 years. Now, very, very important interpretation. I'll tell you what is happening. If you buy the machine today by pay year 0, now what is the understanding? Today, now itself you will, okay, initial cash outlay, you pay 60,000. To tell me children, if you pay 60,000 today, okay, you will have to incur, if you pay 60,000, buy the machine and run for 1 year and sell the machine for 1 year. Sell the machine at the end of first year. What you will do? You will purchase the machine for 60,000. Cash flow will be there. Correct? This will be outflow. Apart from that, you have to maintain. First year, what is the maintenance charge? 16,000. Anyway, you have to incur the maintenance charge. Agreed? Next, repair will be there for the first year. No repairs will be there. There will be some maintenance charges, but repair charges will be on the fault. Okay, the fault may arise only after first year. So first year, there is no repairs. Now, scrap value 32,000 will be incurred only if you sell at the end of first year. Are you all understanding? If you notice, the scrap value keeps on reducing. What is the issue? Because as and when you keep on use the machine, slowly the scrap value will get reduced. Okay, it will fetch only lower amount in the further years. Agreed? So what is the understanding? If you use the machine for 1 year and sell the machine at the end of first year, what are all the cash flows? First, you have to pay 60,000 to acquire the machine. Maintenance charge will be 16,000. Okay, and repair cost will be 0 and the scrap value will be 32,000. Fine. Now, if you use the machine for 2 years, this is option 1 we discussed. Option 2, use the machine for 2 years, sell the machine at the end of second year. Are you all understanding? So, I purchased the machine for 60,000. I use the machine by paying a maintenance charge of 16,000 the first year, 0 for repair, but scrap value will be there, will not be there, will not be there. Why you are not selling it at the end of first year? So, forget the scrap value. Next year, second year, 18,000 again maintenance charge will be incurred, 4,000 repairs will be incurred, and 24,000 I'll sell, I'll get the scrap value. Are you all understanding? Again, one more thing. Third year end you are selling. What are all the cash flow? Just to make you comfortable with the question. First you purchase the machine, year 0 60,000. Year 1 cash flow will be 16,000 maintenance cost. Repair cost will be 0. Year 2 18 and 4,000 will be incurred. 24,000 you will not get because you are not selling at the end of year 2. What you will do? Continue for year 3. You will again incur 20 more thousand. Okay, and 8 more thousand for repairs and maintenance. Okay, thereafter sell it. You will get the scrap value of 16,000. Are you all understanding clearly the cash flows? Now, what they say, future replacement will be with identical machine with same cost. Revenue is unaffected by the age of the machine. Revenue is unaffected, which means there is only cost involved in the question. Okay, NPV is discounted cash inflow minus discounted cash outflow. Discounted cash inflow is same, uniform in all the cases. So that is irrelevant. Okay, incremental cost only should be considered for capital budgeting decision. So, okay, that is not at all relevant. I only consider the cost portion. Don't think NPV, net benefit here. Revenue is not given, cost is given. Don't think, okay, that is not, this is cost oriented question. We want to compute EAC. We will be computing EAC and find out whichever is having the least EAC, we will select that replacement cycle. Now, ignoring inflation and tax, determine the optimum replacement cycle. Present value factors of cost of capital is 15% for the respective 4 years. Okay, present value factor for 15 years given because 15 years is the cost of capital. Now, shall we move on to solving the question now? Here, important adjustment. How to solve the question now? I told you 4 different projects. Life of the project, I told you in the example now, life of the project, assume it to be 4 years, 2 years. Okay, then present value annuity factor will discount. Here, what I do, there is no life of the project, you will not assume. What is the thinking now? Every replacement cycle, you will take it as the life of the project. Are you understanding? Which means if you, if you run the project for 1 year, replace the machine at the end of first year, this will be taken as 1 year project. This will be considered as 1 year project. Are you understanding? Now, 2 years you will run the machine and then at the end of second year you will sell the machine. Okay, replace the machine. This I call it as 2 year project. This I will take as consider as 2 year project. Like this. Okay, I will consider this 1 year project, 1 year replacement cycle to be 1 year project, 2 year replacement cycle to be 2 year project, 3 year replacement cycle to be 3 years project, 4 years replacement cycle to be 4 years, and then compare the EAC. Shall we? Okay, see. Part 1, taking 1 year replacement cycle. Okay, assume it to be 1 year project now. Now, see, year 0, what are the cash flow? Replacement amount 60,000 will be there. Net discounted cash outflow will be 60,000. Present value 1, outflow will be there. See, the presentation, they have given outflow, then inflow. Okay, it is also advisable to do inflow and outflow. It's your choice. Okay, if you are conceptually thorough, there is no issue. Next, year 1, maintenance repair will be there 16,000. It will be outflow. Cost na. Here also residual value. Yes, I will get the 32,000. Repairs will not be there. So residual value 30,000. That will be inflow. So this will be net inflow. This is first year end inflow. So I will discount and bring it to present value sum. This is the discounted cash inflow minus discounted cash outflow. My net inflow, my net benefit cost, net cost comes to 46,086. Negative NPV comes to minus 46,086. 86.4. Are you all comfortable? This is the NPV for how many years? 1 year. This is normally NPV you compute. We have computed the NPV. If we need to compute equated annual cost. Now this is 1 year NPV divided by what? 1 year annuity factor. 1 year present value annuity factor is same as 1 year present value factor, which is okay 0.8696. Are you all comfortable? Okay, how much is that? 46,086. Here you have to divide, not multiply that. Okay, I saw few papers where they have multiplied wrongly, students. So here you will divide it. 46,086. Yeah, formula by EAC or EAB is equal to NPV divided by annuity factor, respective annuity factor. 0.8696. The number will be higher. Minus 52,997.24. This is the, okay, if you replace at the end of year 1, this will be the EAC. But now 2 years replacement cycle. Again, 60,000 you will spend. So total outflow comes to 60,000. Year 1 inflow 16,000. Inflow in the sense out the charges, maintenance and repairs charges 16 and 16. 16 into 0.8696. I'll discount and bring it to present value terms. Present value of the cost, year 1 cost. Next year 2, you have cost of 22,000 and you have residual value of 24,000. Okay, net cash flow is 2,000 inflow. 2,000 inflow. Okay, the sign is very important. Now, present value discount using 2 year, second year cash flow, second year present value factor 1 divided by 1.1 is equal to plus 2 times, you will get 0.7561. Okay, you will get 1,512.2, the discounted value. Now, discounted cash inflow minus this amount outflow. Okay, negative NPV of how much? Outflow, both are outflow. Na? So minus this amount. How much is that? Minus 72,401. Okay, this is the negative NPV divided by present value annuity factor for 2 years. Present value factor for how to find present value factor annuity factor for 2 years? Calculator given. Even if not given, what you should do? 1 divided by 1.15, 15% rate. Okay, is equal to press 2 times. Then press GT, grand total, you will get 1.6257. That you should divide and find out the EAC for the 2 year replacement cycle. Then 3 years replacement cycle, again same drill. Replacement cost will be 60,000. Then you have maintenance repair for first year, okay, second year, third year. Okay, this is the maintenance and repair. If you see the maintenance and repair, they have combined. They have not shown separately. No, you can combine. Both are cost now, so you can combine. You can combine and find out the total. Then residual value you need to remove for the third year alone. Third year you will have the maintenance repair expenses. Apart from that, you will have the salvage value also 16,000. Net cash flow is 12,000. That you discount using third year discounting rate. You will find the present value. Then compute the net present value minus entire thing minus 98,437. But this is for 4 years. This is for 3 years divided by 3 year annuity factor at 15% divided by 2.823 will give you. Okay, EAC minus 43,113.96. 4 year replacement cycle also will solve. Again, you will get the EAC as how much? Minus 43,771. Now, you tell me something. We have got 4 different EACs. Now it is comparable or not comparable? Comparable. Why? Because we have turned everything into annualized numbers. We have turned anything into annualized number. Okay, now the life disparity issue is not there. We have resolved the life disparity. Are you all comfortable? Now tell me. This is EAC, cost-oriented question, benefit-oriented question, cost-oriented question. So EAC you have found out which project you will select, which replacement cycle you will select, that replacement cycle which is having the least EAC, which is having the lowest EAC. What is that? Okay, see, since EAC is the least in case of replacement cycle of 3 years, hence machine should be replaced after every 3 years. Okay, this is what you should do with respect to EAC question. Very, very important. There are so many questions given in the study mat. Please go through. I cannot discuss all the question, but every question they have done, okay, they have presented each and every question in different manner. Okay, and I don't know what to say. Students get confused. But if you are thorough with the cash flows, if you are thorough with the underlying concept, I don't think there will be any problem. If you are comfortable how to solve the EAB, EAC, okay, you can take any method and solve. I don't think they would be deducting marks for if your last answer is tallying. Anyway, this is, I cannot help in this regard. Okay, you can select whichever is comfortable, you select that method and follow that, okay, uniform. Now, take for question number 40 for discussion, decision tree. Shall we? Okay, this is a very good quality question. Mark it as important. Okay, decision tree also important. See, a firm has an investment proposal requiring an outlay of 80,000. The investment proposal is expected to have 2 years economic life with no salvage value. In year 1, there is a 0.4 probability that cash inflow after tax will be rupees 50,000 and 0.6 probability that cash inflow after tax will be 50,000, 60,000. Yes, this is 50,000 and the cash inflow after tax will be 60,000. Next, the probability assigned to cash inflow after tax for the year 2 is as follows. The cash flow in year, if the cash flow in year 1 is 50,000, the probability is 24, 32, 44 is 0.2, 0.3 and 0.5. The total will be 1. Okay, next. First year cash flow 60,000. What is the second year cash flow probability? 40,000, 50,000, 60,000. All this probability details given. Next, the firm uses a 10% discounting rate for this type of investment. Required, construct a decision tree for the proposed investment project and calculate the expected NPV. Expected NPV is nothing but mean NPV or average NPV. Okay, NPV. Now you assume that there will be one NPV. There are so many NPVs, because so many different scenarios given. This I call it as capital budgeting under uncertainty. Okay, these areas comes under capital budgeting under uncertainty, which means you don't know what should be done. Normal distribution table, that is also probability. Here also is probability. Okay, all these are capital budgeting when you are uncertain about the future cash flows. You assign some probability, okay, and try to find out the average NPV. You don't know what would be the realistic NPV, what would be the correct NPV. You try to project the average NPV. Okay, you calculate the best case and worst case, everything you put into, okay, calculation. See, now, what net present value will the project yield if worst outcome is realized? What is the probability of occurrence of this NPV? What will be the best outcome? What is it? Okay, see, what is the best outcome and the probability of that occurrence? So these two are worst and best outcome, and respective NPV for that, probability of that occurrence. Okay, probability and the outcome. Last, will the project be accepted? Will the project be accepted? 10-year discounting factor, all these data given. Now, can we solve this question? Okay. Now, we need to find out average NPV. But various probability given. Now, what I will do, I will just introduce you to this small concept here. Then we will be very comfortable with the question. See what they say. I have 2-year cash flow. Year 1, year 2. The life of the project is 2 years. I think it is a 2 years project. Yes, it is expected to have 2 years economic life. The life of the project is 2 years. What they say, first year cash flow 50,000, I predict in 60,000, and I assign probability of 0.4 and 0.6. Are you all understanding? Which means first year I predict that the cash flow might be 50,000 or 60,000. I think that there is a 40% probability. There is a 40% probability to cash flow to become 50,000, and there is a 60% probability, 60% chance for the, okay, the project benefit to be 60,000, cash flow to be 60,000 in year 2. Year 1, both are year 1, not year 2. Year 1, both are year 1. Okay, this is first year project. So first year, I may get 50,000 inflow, I may get 60,000 inflow. Are you all listening? Now, what I say, the second year cash flow is dependent on the first year cash flow. The question is all about dependent cash flows, independent cash flows. The question is all about dependent cash flows versus independent cash flows. I will tell you how to find out. Very simple. What they say, I have to find 2-year cash flow now, because 2 years is the life of the project. First year cash flow, only two possibility. One is 50,000, another is 60,000. Fine. Second year cash flow is dependent on the first year cash flow. What they are saying? Dependent on the second year cash flow, which means year 2, what happens? See, year 2. Here I am putting, okay, year 2, what happens? If my cash flow is 50,000, I have three possibility. Okay, for second year, 24, 32 and 44. 24, 42, 30, what is that? 1 second. 32 and 44. 24, 32,000 and 44,000. Are you all understanding? Which means that this second year cash flows outcome is that this is dependent on the first year cash flow. If my cash flow really becomes, I don't know what will be the first year cash flow. It may be 50,000, 60,000. But if my first year cash flow becomes 50,000, my second year cash flow may become 24, may become 32, may become 42. First year also uncertain, second year also uncertain. But I am certain that these three may occur, only one out of these three may occur if my first year cash flow is 50,000. Right. If my first year cash flow is 60,000, my year 2 cash flow may be 40, 50 and 60. 40,000, 50,000 and 60,000. Okay. I know that, okay, I know that if the first year cash flow is 60,000, my second year cash flow may be 40, 50 and 60. Respective probability also I have attached, which means second year there is a 0.4, 0.5 and 0.1. 0.4, 0.5 and 0.1. See here, this is 0.4. There is a 40% chance for the second year cash flow to become 40,000. there is a 50% chance for second year cash flow to become 50,000. There is a 10% chance for my second year cash flow to become 60,000. Like this, I need to understand. Are you all understanding? Here also probability is there. What is the probability? 2.2, 0.3 and 0.5. 0.2, 0.3, 0.2, 0.3 and 0.5. Are you all understanding the question? I'm just explaining the question because you need to know there is a concept called as joint probability which you are going to apply here. Are you all understanding? Which means second year cash flows are dependent on the first year cash flow. Second year outcome is totally dependent on the first year outcome. If first year is 50,000 cash flow, this will be the set of cash flows I will receive in the second year. If 60,000 is the cash flow, this will be the set of cash flow. Two different sets is there. Two different sets are there. Are you all comfortable? Okay, this I put it like this. Okay. Next, shall I proceed? Okay, 24,000. Okay. Now, what they say? You have to find out NPV under all the different scenarios. Now, how many situations possible? You tell me broadly. First year cash flow may be 50,000. Second year cash flow may be 24,000. One combination. First year cash flow may be 50,000. Second year cash flow may be 32,000. First year cash flow 50,000. Second year cash flow may be 44,000. Three possibility. Yeah. Next to here. So first year cash flow may be 60,000. Are you all understanding? Second year cash flow may be 40,000. First year cash flow 60. Second year cash flow 50. First year cash flow 60 now. Second year cash flow 60. All the possible scenarios are there now. Now, how many scenarios we have? 6 different scenarios are there. This is what you need to build a tree. This is called a decision tree. And under all the scenario, we'll compute the expected NPV. Expected NPV. Shall we? Okay, I'll explain the table now. It will be very comfortable. Now, initial cash outlay is 80,000. You spend the 80,000 and there is two possibility for year 1. This is year 1. This is year 1. This is for year 2. Are you all comfortable? Now you will be very comfortable. See. Year 1, I have a chance, 50%. Okay, I have, how much is the probability for this? 0.4. There is a 40% chance for my cash flow to become 50,000. It may be 50,000. It may also be 60,000. Okay, 0.6. Are you all listening? Extra. Here, 24,000. What are all the probability assigned to this? 24,000. Tell me, children, what is the probability for 24,000 year 2? If my first year cash flow is 50,000, year 2 cash flow will become 24,000. What is the probability? 0.2. So here I write 0.2 probability. 0.2. First, 50,000. What is the probability? 0.4. Correct. 0.4. We have correct. 60,000. 0.6. No issue. Now, tell me, second year, what is the probability? 0.3 and 0.5. Here I write it 0.3 and 0.5. Are you all comfortable? Yeah, I in the classroom, I also write the probability so that, okay, they will have absolute clarity. Here also, 40, 50,000, 60,000, you can write the probability. What is the probability for that? 0.4, 0.5 and 0.1. 0.4, 0.5 and 0.1. Agreed? Now tell me, what is happening? Now, see. First year cash flow 50,000, second year cash flow 24,000. In order to have this, this to be happening, what is to be done? Very simple. The probability you will take 0.4 or 0.2. For this to happen, you will take 0.4 as probability, 0.2. You will take the joint probability. You will take the joint probability. Two events are to be happening. Two events should be happening together. First year cash flow should be 50,000. Second year cash flow should be 24,000. Then only this will happen. What is the joint probability then? 0.4 into 0.2. 0.4 into 0.2, which is 0.08. 0.08. Are you all comfortable? Like this. First year 50,000. Second year 32,000. What is the joint probability? 0.4 into 0.3. How much is that? 0.12. Are you all comfortable? Third, what is that? 0.4 into 0.5. How much is that? 0.2. Like this. Okay, in case of 60,000, 0.6 into 0.4. 0.6 into 0.4. Okay, we'll give you 0.24. Next, 0.6 into 0.5. 0.6 into 0.5. How much is that? 0.3. Next, 0.6 into 0.1. Okay, 0.6 into 0.1 will give you 0.06. Total comes to 1. Okay, I've distributed all the scenarios I've considered. Okay, my probability will be 100% or 1. Correct? Now, I need to find out respective NPV at the end of year. NPV I need to find first. What I will do? First option. Okay, I have to find 6 NPVs here. I have to find 6 NPVs. Why? 6 different cash flows possibilities are there. Are you understanding? So 6 NPVs. Now what I do? Okay, first year 50,000 inflow. Second year inflow 24,000. Okay, this I will compute by applying the respective probability expected NPV. Are you all understanding? And reduce the discounted cash outflow of 80,000 and find out the NPV. So to put it simply, first path 1, 50,000 into 0.909, 45,450. The first year discounting rate, 10% I will discount. Second year 0.826, 10% for 2 years. I discount the second year cash flow. This much I will get. So total cash inflow in a 19 plus 45,450, 19,824 plus 45,450. Total present value comes to 60%. Value of cash inflows comes to 65,274 minus cash outflow. First branch, okay, gives me how much? 14,726 minus negative NPV. This branch minus 14,726. Like this, you will put a separate, okay, NPV column also. Okay, will be easier. In the branch itself, if space is there, you can utilize it. Okay, next. 45,450. Okay, this I get the same number now. I can take first year cash flow 50,000 now, 45,450. Next 32,000 into second year cash flow into second year discounting rate. I'll get 26,434. Total this, you will get the total discounted cash inflow minus 80,000 initial outlay, discounted cash outflow. NPV comes to minus 8118. Are you all comfortable? Next, third, same 50,000 present value will give you 45,450. Okay, because this is uniform now. First year 50,000 is uniform. Next it will change. 60,000 it will change anyway. Now 44,000 into 0.826. How much is that? 36,344 plus 45,450 will give you 81,794 minus 80,000 plus 1,794. Are you all understanding? Like this, you will find the NPV at 6 different points. Okay, each and every computation you can simply go through. So we have 6 NPVs now. This I will put it here. This I will put it here. Every NPV, next NPV na minus 8118 minus 8118. Okay, 17, what is that? Minus again, okay, 1794, positive 1794. Like this 8 NPV I will put in this. Not visible, 1 second. Is it visible? Like this, I'll put 8 NPVs here. Okay, agreed. I will multiply this NPV into respective probability, and total it. I'll add it. Okay, the NPV for respective node into probability for the respective possibility. I'll get the average NPV. Like this, I'll find out the total. Okay, average NPV, weighted average NPV. Are you all understanding what I'm doing now? Okay, here. Statement showing expected net present value. See here what happens. 8 different cash flows are given. Probability assigned respective probability. This is joint probability. Joint probability, which means probability first probability into second probability. Multiplication is to be done for finding joint probability. And the total expected NPV comes to how much? 6,223.76. Expected NPV positive or negative? Positive. Accept the project. Overall expected NPV is positive. Accept the project. But the question we will see that the conclusion we will see before that. Okay, see here 1 second. Can you see the question properly? Now see what they say in the second. This is what they have asked here. First part of the solution. See, construct a decision tree done for the proposed investment project and calculate the expected NPV. That you have got it. How much is that? That is 6,000 positive NPV. Some number you got now. That is the expected NPV. Considering joint probability, we'll find out. Next step, what net present value will the project yield if worst outcome is realized? What is the probability of occurrence of this NPV? Very simple. What they say. What is the worst outcome to be realized? Now, very simple. You see the question itself. You don't need to go to the decision tree itself. Worst outcome, now you will select the least cash flow in each and every project. So 50,000 first year project is lower, 60,000 lower, 50,000 is lower. Take that route, 50,000 route. 50,000 first year, second year least outcome is what? 24,000. Worst probability, worst outcome is first year earning 50,000 cash flow, second year earning 24,000 will give you the worst NPV or least NPV. Are you all understanding? This I call it as worst case NPV. Now what is worst case NPV? 50,000 plus 24,000, okay, minus 14,000. This is the most, which means the least NPV or highest negative NPV is how much? 14,726. Now, this is the worst outcome. For this, what is the joint probability? Sorry, probability 0.08. Are you listening? So, if the worst outcome is realized, the project will yield a negative NPV of minus 14,726. The probability of the occurrence is 8% or 0.08. It is nothing but percentage terms. We have written as 8%. The best outcome. Now you tell me, children. Best outcome is first year 60,000. Second year highest 20. Okay, that is what is that? 60,000. Second year also 60,000. Yes, 60,000. First year also 60,000. Second year also 16,000. Discounted find out NPV 24,100 will be the best outcome. Okay, that is what they have given. And the probability will be 6%. Probability will be 6%. The best outcome will be path 6 when the NPV is 2400. The probability of the occurrence is 6%. The project should be accepted because the expected NPV, this is best and worst. See, the part B and C, they've asked extreme position, best and worst. But for NPV expected, now what is the expected? That is why I told you it is mean NPV, average NPV. When you try to predict the future, okay, you should avoid the extremes. You should find out the average. Mean is the superior data. Hence, average NPV is positive. Hence, I go with the project. 6223 is the average NPV. It is positive. Okay, then accepted. It should be accepted. This is all about question number 40. Shall I move on? This is all about decision tree. Next, decision tree with real option. This is question based on real option. Now we are moving on to real option. Very, very important segment. Last attempt, they have not tested. I think 2 or 3 attempts back, they tested real option. This attempt, there is a high possibility. The last attempt, the Jan 26, they've tested abandonment option. So I think real option may be tested. Okay, could be tested in this attempt. That's why I'm discussing. Okay, shall I discuss the real option? See, now what is this real option? I'll give you a brief introduction. Okay. Real option means, okay, option, you also already know that it is an instrument contract based on asset. Okay, underlying asset will be there. We saw the equity option, currency option, interest rate option, all these we saw. Where underlying asset is shares, debentures, it could be anything and everything, weather derivative, electricity derivative, instrument. It's just a derivative instrument. Real option, what is the word real mean? Real asset, Okay, there, financial asset option we learned. There, we learned option regarding financial asset, where the underlying asset, what financial asset? Shares, debentures, interest rates, or okay, the MIBAR, like this. We learned the financial asset aspect. Here we are learning real asset, okay, land, building, okay, plant and machinery, patent, okay, intangible asset. Like this, there are real. This is called as real asset based on real asset, which means where the options or the contract is based on the underlying asset, the real asset as underlying asset. Okay, the option is called as real option. Now, see what happens in this case of real option. All the option valuation procedure we learned in the risk neutral method and the Black-Scholes method. Forget about the riskless hedge portfolio method. Their shares were there, we could hedge it. Here there is no concept of riskless hedge portfolio. But risk neutral method, option valuation, if you are not thorough with the risk neutral method and Black-Scholes model, okay, get clarity there. I have put comprehensive revision series. I have covered everything there. It's freely available in my playlist. I have put a playlist called as comprehensive revision series. There, options and futures I've covered comprehensively. There you can go through. Okay, because option valuation model I've taken around 2.5 hours lectures, right? You can go through. Now what I'm saying, risk neutral formula, I will assume that here you know that risk neutral probability formula. Okay, P is equal to E to the power TRF or R. If normal compounding is used, they will use the R formula, or if continuous compounding is used, E to the power TRF minus D divided by U minus D. This I will assume that you know that. Okay, this real option and Black-Scholes model formula also, I'll assume you know that. I'm going to solve next 2 questions. We are going to solve real options, wherein this question we are going to solve using risk neutral model, risk neutral option valuation model. Next question we are going to solve using Black-Scholes model. Both methods are possible. Okay, now the firm is considering, you will see the data and understand which model is to be used. Very simple, no issue. A firm is considering a proposal to set up a cement manufacturing plant with an initial investment of 150 crore. The firm has the option to abandon the project after 1 year by selling it to a competitor of 100 crores. Now, if the market conditions are unfavorable and the demand is low, the project's value will decline by 60%. However, if the market conditions turn out to be favorable and the demand for cement is high, okay, the value of the project at the end of year 1 will be increased by 50%. Given that the risk-free rate of interest rate is 8%, risk neutral method, that's why they've given that. What will be the value of the abandonment option and the value of the project with abandonment option? See, this is also effectively abandonment option only, but okay, this is more or like a real option. This abandonment is a put option. That is the understanding. Right to sell will be there, because abandonment, you have a right option to abandon. Okay, you will have option to abandon. Now you can anytime, okay, discontinue the project. So you have right to sell the project as such. Are you understanding? If you don't see viability in the project, just sell it. Okay, you can abandon it in between the life of the project itself. That is what they put option in bracket also they have given. Shall we solve the question? Very simple. First, make the decision tree using payoff. Okay, nothing new. Option valuation, we solved the same way. The 2-period binomial model. So if you are not brush through that question, please go through that question. I have uploaded in the part 1 of this marathon. Okay, there you can go through. Timestamp is also given. Now, construct a decision tree first. What is this 150? 150 is the cash outlay you need to pay for undertaking the project. Very simple, yeah. Initial investment. This is nothing but initial investment. You pay 150 crores and undertake the project. Now, after undertaking the project, what will be my cash flow in the year one? Next year, what might be the project cash flows? Very simple. They have given what they say. Okay. If the condition is favorable, the cement and all they have given, if the to put it simply, if the condition is favorable, okay, it will be increased by 50%. It will be, cash flow will be increased by 50%. You tell me, children, how much is the 150 you have paid into 150%? 50% it will increase now. 150% or 1.5 is equal to 225. So the cash flow, if situation is favorable, will be 225. If it is unfavorable, tell me 150 is the amount you invested. What will be the decline? The cash flow will project value will decline by 60%. Which means the balance only will be 60%. So 60% will decline. Now balance only 40%. 150 into 40%. What is the value? 60 lakhs. So 60 lakhs of crore, 60 crores. Okay, 60 crores will be the value of the project. Are you all understanding the 225 and 60? This is favorable situation. This is unfavorable situation. Okay, you have 225 and 60. This is the two different cash flows which may arise in the future. Agreed? Now what is it? Okay, very simple. You need to find out the payoff. The payoff in the sense, very simple. Payoff now, this is the outcome. This is the possible outcome. Year 1, 225, or it may become 60. But I have an option to sell. I have an option to sell in the sense I have an option to abandon the project. I'll tell you what happens. I undertake the project. At the end of year one, what will happen? If the project outcome is 60 lakhs, if the project value only 60 lakhs, because of the increasing cost, cement cost extra increased, so project outcome only 60 lakhs. Now, the project needs asset. Okay, the asset will fetch me only 60 lakhs. These assets, okay, cumulatively will only fetch me 60 lakhs. But I can sell these group of assets by at 100 crore. Okay, it will only fetch me 60 crores. Sorry, it was in crores. I can sell it for 100 crore. Why? I have a right to sell at 100 crore. That is what is abandonment option. I have an option. I have choice. This is what I've given. It is not an obligation, but this is a choice. Can you see this? Okay, see, the firm has an option to abandon the project after 1 year by selling it to competitor for 100 crore. Whatever might be the situation, I can sell it for 100 crore tomorrow. What I will do? I have option now. There is no obligation. What I will do? When I will exercise the option, when situation is favorable. When situation is favorable, see, I undertake the project by paying 150. If the value of the project increased and it became 225, will I sell the project for, what is that? How much? 100 crore. Project value 225. Will I sell it? Okay, I have a right to sell it. What is that? 100 crore. Will I sell? I will never sell. Are you all understanding? So the payoff will be nil. I will never exercise my put option. I will never exercise my abandonment option. Abandonment should be treated as put option. Next, if my value from 150 becomes 60, okay, the project value, okay, nearly dropped by this much percentage. What I will do, even though the value is only 60, but I have a right to sell to my competitor, what I will do? I will give this, throw in his face, okay, for 100 crore, and I will give the project and I will receive 100 crore. Are you all understanding? In this case, what will be the payoff? 100 crore I will receive from my competitor. 60 crores, okay, is the value of the project. So that is the outflow. I give the value, I receive the 100 crore. I give 60 crore worth of project, I receive 100 crore. Net profit is 40 in this case. Payoff is net profit. Are you all understanding? If you remember, this payoff is nothing but FSP minus X. Are you all understanding, my dear friends? This is nothing but FSP minus X in the option chapter. Say, now, calculate the probability of high demand or upper FSP. Calculate the probability of upper FSP. How to compute it? Very simple. Using risk neutral formula also you can compute, or this method you can use and compute. The same as risk neutral formula. I will show you. Very simple. See, in this case, what you have to do? You will take, okay, e to the power R minus D. What is the formula? R minus D divided by U minus D, or e to the power TR minus D divided by U minus D. This you will use in case when continuous compounding is given. Normally, continuous compounding question, they will mention the continuous compounding rate. If nothing given, you will assume it to be normal simple compounding. Okay, so that is there. Here, this will be used when there is no continuous compounding details given. You will use this for simple compounding. So R means nothing but 1 plus R raised to the power n. 1 plus R raised to the power n minus D divided by U minus D. Okay, substitute it, very simple. 1 plus R, na, rate of interest, risk-free rate of interest given as 8%, 1.08. 1.08, okay, minus D. What is the D here? Very simple. D is downward FSP divided by spot. Spot price is how much? Very simple. Spot price is how much? 150, yeah. What is the downward FSP? 60 is the downward FSP. 60 divided by 150. What is that? 0.4. 0.4. It is the downward FSP. So what is the D? D is equal to downward FSP, future spot price divided by spot. Spot na current. Okay, value of investment is a spot. Here, what is spot? Value of investment today. What is the value today? 150. What is the value if the downtrend continues? 60. Na? What is the downward FSP? 60 divided by 150 is 0.4. Are you understanding? Upper FSP is how much? Upper FSP 225 divided by spot is 150. 225 divided by 150. How much is that? 1.5. So 1.5 minus 0.5. So for 4. Solve it, you will get the P value. This is nothing but P value. Probability of upper FSP to prevail. Please tell me something. What is that? 1.08 minus 0.4. How much is that? 0.68. 0.68 divided by 0.1. Right? 1.1 is equal to 61.182 percentage. 61.182 percentage or 61.82. Oh yeah, 61 point. So this is 61.82 percentage. 61.82 percentage I'm getting. Are you all understanding? So 61.82. This they have equated and solved. Same answer you will get. Okay, this I have solved 2 questions in the derivative chapter itself, option chapter itself. You can go through. So this is what probability for upper FSP to prevail. Probability for upper FSP to prevail. Probability for the lower FSP to prevail, how much? 1 minus P, 38.18. If you apply the payoff, if you apply the probability to respective payoff, very simple. What is the value of abandonment option? 61.82% into 0 plus, okay, 40. What is the payoff at the lower side? 40 into 38.18 percentage. This you do. Okay, this will be 0, I know. Anyway, this value 40 into 38.18%. 15.27. 15.27. This is the value on the date of maturity. I will discount again using present value, other discount using risk-free rate of interest of 1.08 for 1 year. What is the period? 1 year. What is the period? Year 0, year 1. This is 1 year, end of 1 year. So maturity period is 1 year. So discount using 1 year rate, same way, 15.27 divided by 1.08. What is the value? 14.14. 14.14. Where it is? Are you giving solution given? Yes, 14.14. Rounding off issue, no problem. Okay, present value of expected payoff is how? Okay, divided by 1.08. P into 0, this 0. 40 into 1 minus P, just now we computed. Okay, 15.27 or something. Divided by 1.08, you will get 14.139. What is the understanding ultimate? Conclusion. See what happened. This is the value of the option. In this case, what happened? You tell me. Originally, the value of option is today. I told you the value of put. This is value of put option is equal to how much we got? 14.14 crore. This value is option today. This is the value option today. Now, today, what is the spot price? How much investment you make? 150 crore. What they say? If you invest the project, or if the project doesn't have any option to abandon, 150 crore will be the value of the project today. I don't know what will be the value of the project tomorrow. That is another thing. Spot, what is the value of the project? 150 crore. What is the abandonment option attached to it? 14. What is the value of abandonment option attached to it? 14.14 crore, which means with option, the project worth, this project contains inherent option. So the project worth total 50 crore plus 14.14 crore total comes to 164.20. Okay, what is that? Yes, 164.2019 crore. This ideally should be 164.14. Rounding off because the 61.82 they have taken. Okay, it is nothing but rounding off issue. Are you all having the clarity? This is 164.2019. Are you all understanding? This is the value of the project with abandonment. So without abandonment, the value of the project is 150 crore. Value of only option is option only. In an isolated manner is 14.14. Value of the project with the option is together 164.2019. Beautiful question. Go through. Okay, now shall we move on to next question? Okay, question number 42. Okay, question number 42. Real options. This is based on Black-Scholes model. ABC Limited is a pharmaceutical company possessing a plant of a drug called 8 drugs, a machine for 8 patients. Being an approach drug, ABC Limited holds the right of production of drugs and its marketing. The period of patent is 15 years, after which any other pharmaceutical company produce the drug with the same formula. It is estimated that the company shall require to incur, $12.5 million for development and market of the drug. As per a survey conducted, the expected present value of cash flows from the sale of a drug during the period of 15 years shall be 16.7 million. Cash flow from the previous similar type of drug have exhibited a variance of 26.8% of the present value of cash flows. The current yield on treasury bonds, the risk-free rate, for 15 years period is 7.8%. Determine the value of the patent. See, very simple. For any Black-scholes model, this is Black-scholes based question. For any Black-scholes based question, you have to have 5 data. You would have studied in the option. I already told you, you have to have spot price. This is spot price. Then you have to have an exercise price. Then you have interest rate or RF, risk-free rate of interest. Then you have time period, which is time, till the maturity of the option. Then you have to have variance or standard deviation. Then you have to have standard deviation. Then you have to have standard deviation. Standard deviation means variability in the return. Now you have standard deviation. All these are required. Now see the various data given, log normal value given, and this given. Right. So I say solution. This is study mat question only. See, spot price is the present value of the cash flows. At present, what is the cash flows I can generate? This is the spot. The spot value is nothing but present value of the benefit. The 16.7 million. This is the present value of future benefits. I get it as spot price. This is spot price. Then there is exercise price. What is that? Cost of development formula, 12.5 million. Very simple. See, this why this becomes spot and exercise price, I'll tell you. The 16.7 million is the present value of the benefit, but that benefit you will only derive when you expend 12.5 million. Are you understanding? See, at present, that the drug is not developed. You need to develop the drug, then you can sell the drug. The present value of all the benefits will be 16.7 million. Are you all understanding? So first, this is exercise price. This is the spot price. Are you all understanding? So exercise price is 12.5 million, which means you pay this much. See, exercise price, the option chapter also, you remember, the exercise price will be the amount of outflow you need to pay. When you decide to exercise, how much you need to pay. That much you will pay and get this benefit. Are you listening? That is what is happening here. Next, variance of the cash flow, 26.8%. This is given as variance. So standard deviation is square root of 26.5 or 0.268. Are you understanding? Square root of 0.268 is called as standard deviation. Next, risk-free rate of return given as 7.8%. Now, in this question, one unique adjustment is there. Real option question based on Black-scholes model will have expected cost of delay. This is on nothing but dividend yield. This is to be regarded just like dividend yield. What is this? I'll tell you. Very simple. See, in the Black-scholes model, suppose the share is giving dividend during the maturity period, which means this is the maturity period of the option. Say this is year 0, this is year 3 months, year 0, and this is 3 months. Now this is the option maturity period. What happens is, at the end of the second year, this is 1, 2, and a second month. At the end of the second month, the share is giving you dividend. Now you are holding option. Assume you are holding a call option, and the underlying asset is share, and the share, Reliance Limited share, is giving you dividend. What is the treatment of this? Very simple. See, you are holding option. Option is a contract on asset. And the Reliance Limited share is the underlying asset. Are you all understanding? The derivative name itself suggests derivative instrument means contract on asset, which means if you hold a call option, you tell me, friends, you are holding contract on asset. Asset itself holding a contract of assets, which means you are holding contract of assets, not asset. If you held the asset, you would have received the dividend. Are you all understanding? Since you don't hold the asset, only holding the contract on asset, you will not receive the dividend. Are you all understanding? A dividend becomes the opportunity cost for your holding of option. You have not held the asset, hence dividend you are losing. That becomes an opportunity cost. So when dividend adjustment given in the Black-scholes model, you can go through in the first part. There also I discussed, if dividend adjustment given, what is the treatment of it? Wherever spot price is coming, this spot price is today's price, correct? this spot price would have been cum dividend price, which includes the dividend portion. What you should do? Okay, you should remove the dividend. Now, dividend is being paid after 2 months. You want to remove the dividend. Now, what you should do? You should remove the present value of dividend. I already told you in the Black-scholes question also we did. There also we did the 10 rupee dividend or 9 rupee dividend. We discounted. Bring it to present value term. Discount means, okay, dividend divided by e to the power TR. Bring it to present value terms, reduce it from spot price, and the spot price becomes revised spot price. Spot price becomes revised spot price, which means spot price without having the present value of the dividend. Remove the present value of dividend. This spot price only I will use wherever is required. Are you all understanding? So put it simply, dividend if given in amount terms, what will you do? Okay, you will remove the present value of dividend. First, you will find the present value of dividend, remove it from the spot price. So, spot price minus present value of dividend. Wherever the formula comes, okay, spot price comes, replace it with revise the spot price, which means reduce the present value of dividend. Now, this is the treatment. Now, what is the treatment if dividend yield is given? Okay, we did not solve that kind of question, but there in the regular batch I used to discuss, if dividend yield is given, what will be the treatment? Very simple. The spot price is given wherever RF comes. The risk-free rate of return is there. Now, for the formula, say suppose this is the Black-scholes formula, D1 formula, ln of S by X plus, okay, RF plus, you have half into sigma square into T. This is the formula divided by sigma root of T. This is the Black-scholes model formula. Now, wherever RF is coming, from this RF, this question RF is 7.8%. From 7.8%, remove the yield because dividend is also yield, risk-free rate of return, which means what you do, treatment number 1. What do? You don't do anything to spot price. You don't change anything with regards to spot price. Just to reduce the yield from RF, risk-free rate of return. Are you all understanding? So what is the formula? Ln of spot by strike price, S by X, okay, plus, what do you do? In the bracket, RF, earlier you had just RF plus sigma square by 2 or half into sigma square. Instead of that, what you should do? You should write RF minus dividend yield. RF minus this yield. The yield will be in percentage terms, annualized percentage term. Okay, you can remove it. Then RF plus dividend yield plus sigma square by 2. Okay, the whole divided by T, the whole multiplied by T into sigma root of T. Are you all understanding? The first one, ln of S by X will remain same. Are you all listening what I am trying to say? This is one way of understanding. Okay, the second method is that spot price itself you adjust for dividend also. Spot price itself you adjust for dividend also. Are you listening? That is also possible, but I'm not confusing you with that. Okay, because institute takes this stance, I will solve this method. Second method is also there. I don't want to waste time using that method, doing that method. Are you all comfortable? So what is the treatment? Dividend yield given in the question, remove it for what is that? RF, risk-free rate. Now the question is, sir, dividend yield are not given. What is the dividend? How can this be dividend yield? Expected cost of dividend. What is the understanding? I don't understand anything. Very simple. Dividend yield, I told you it is a treatment something like dividend yield. Opportunity cost is the issue. Okay. There, when you buy a share option, okay, the option where underlying asset is a share, equity share, there you had dividend yield because share gives dividend income. Hence, if you hold the option, you will lose the dividend income from the share. That is understanding. Here, what is the opportunity cost? I'll tell you. How many years the patent takes to develop a license? What is the time period for the patent? 15 years. Are you all understanding? At present, what they say, there is an assumption here, I'll tell you. At present, you tell me the drug has been already developed, it is yet to be developed. Are you all listening? So what they say, I will take a time lag. I will take this as time lag, which means if I have the drug today itself, I can generate this cash flow. I can generate the 16.7 million which is stated and the 12.5 million which is stated. I can instantly get the present value of this cash flow, exercise it by paying 12.5 million, receive 16.7 million as cash flow. That is fine. But I have already developed the patent or I have not yet developed the patent. Very, very important adjustment. Are you listening? So, question may explicitly give you some time lag. Okay, I will need some time lag, which means I start today. Okay, today itself, tomorrow itself, I can develop a patent. No. Okay, there will be time lag. Institute may give you 2-year time lag, 3-year time lag. Like this, specifically, they will give you time lag. If they give you time lag, then what you should do? 2 years given time lag. Now, 2 by 15, you will assume. Why? 2 years opportunity cost you will lose, which means 2 years benefit you will lose. Are you understanding? Okay, had you developed the drug today itself, okay, you will enjoy that extra 2 years income, that will be lost okay, income opportunity cost, which I will include. Are you all understanding? Which I have to be considering. So if question is silent, what you should assume? Institute generally takes the standard time lag of 1 year, cost of delay. This I call it as cost of delay, which means very simple. The expected benefit is to be enjoyed, okay, over a period of 15 years. And what happened? Okay, 1 year time taken for developing the drug. So 1 year income you will lose, 1 year benefit you will lose out of 15. So 1 by 15. Okay, what is that? 6.67 percentage, which means out of 100% of benefit, I lose 6.67 percentage due to the time lag, due to the delay in developing the drug. Are you all understanding? That's the understanding. That is what is expected cost of delays. Expected cost of delays. 1 year I have assumed, the institute has taken a stand, assumed 1 year you will do. Specifically given, not 2 by 15 you will do. 2 years is given 2 by 15. Like that you will assume. Now, nothing great. All the remaining things, everything, you have all the data. Apply the formula, Black-scholes formula. See, very simple. D1, first step D1, ln of S by X, 16 by 7 divided by 12.5. I told you, RF adjustment, this is the method they have taken. Then ln of S by X plus RF, what is the RF here? 7.8%, 0.078 minus 6.67 percentage, 0.0667 plus, okay, this is variance by 2. Don't get confused here. See, there, sigma square by 2, we studied the formula, correct? Sigma square by 2 or half into sigma square. Half into, what is that? Sigma square. Now, the sigma square is nothing but variance. Variance, standard deviation square is nothing but variance. So, variance 0.268 divided by 2 into 15 divided by sigma root of t. Again, sigma variance 2.6. Sigma is square root of 0.268 into square root of 50. Sigma root of t, time is 15 years. You will get D1 value as 1.315. Then ND1 value, normal distribution table value, generally given in the, okay, will be given in the question itself. Here, they have given how much in the question itself. Okay, so institute study matter they have not given. For simplicity, okay, they will give you table value or they will give you the extract of the table. You can easily find out, that is not an issue. So where is that? Okay, N 1.2315 I have given from table. Okay, how much is that? 0.8910. 0.8910 you have to take. But one thing you need to understand, the table you need to clearly see. If they give the table for you, you need to clearly see it is what? The Z table, we call it as Z table, NT table, normal table. There, okay, it is mean to X to X bar table. It is called as X to X bar table. Okay, if you don't worry, see, if you don't know this concept, please revise, go and see my comprehensive revision series. I have created a playlist. There you can see the, okay, option chapter. Comprehensively, I would have covered for 7-8 hours. There, you take that portion alone. Okay, I would have put timestamp, normal distribution table. It would be hardly around 20-25 minutes, I think, 15 to 20 minutes. Go through that, all the possible scenario I have explained. Very simple. This is bell-shaped curve. Okay, normal distribution curve, perfectly skewed at center. Now, see here, this will not be touching. Okay, like this, it will be. Now, here, this portion is 50%. It will be perfectly in center. All this I have explained. Okay, now the Z. Okay, this is the target value. This I call it as mean value. This I call it as mean, and this I call it as target value, which means X to X bar table. The shaded area is what I want to find the probability, the normal distribution probability. In this case, what happens? Okay, always in Black-scholes model, I will take cumulative probability. Okay, which is, see, this is from the left tail table to, okay, to the entire target value. This I call it as cumulative value. Okay, now here cumulative value should be taken. If one tail value is given, you should convert it to cumulative value. Two tail value may be given. Okay, or the Z table will be given. X to X bar table. And in that case, what you should do? X to X bar table value will be there. You should add plus 0.5. Add plus 0.5 because the entire left side, okay, is 0.5 that you will add, and the total value you should take. For example, here, if you see the X table alone, you will get the value of what? 0.3910. Only 0.3910. In this right side shaded portion alone will be 0.3910. This portion alone will be 0.3910. But you want to convert it to cumulative table. Now you should add the 0.5 from left side. the till the middle center point, it will be 0.5. Okay, both are 0.5 na, so you add that, make it to cumulative. Are you understanding? Black-Scholes model, you need to have cumulative value. So cumulative value comes to, normal value comes to 0.8910. Then D2 value, D2 is D1 minus sigma root of T. Okay, you will apply that, you will get the value n D2. Okay, if n, see one more thing, if n D2 is negative, if D2 is negative, what you should do? If value is negative, okay, for computing cumulative value, what you should do? You should, okay, 0.5 minus this number. Okay, 0.5 minus this number will give you, okay, 0.5 minus this number, normal table value of minus 0.7735. Okay, will give you 0.2196, which means this would have been, okay, how much is the value? Minus 0.77. Okay, it should be negative, which means, see here, you are getting 0.2196. You are getting 0.2196 now. This you will get after adding this number. Are you all comfortable? Okay, that you should ensure, which means, okay, to put it simply, you will get the, see, very simple, I'll tell you. Z table value, x to x bar value is, suppose you see that minus 0.7735. I don't have the table value now, but assume the value something, okay, you get some value. This value, what you should do, if this minus is negative, this D2 is negative now, if the value of the D1 or D2 is negative, what you should do? You should subtract it from minus 0.5. You should subtract it from minus 0.5 to arrive at n cumulative value. Are you all understanding? If it is positive, you will add 1.5 to it. If it is negative, you remove this number from 0.5 and get the cumulative value. Okay, all these are there. I have already discussed it. Next, value of the patent, apply the formula. Okay, spot price into e to the power minus df. Na? Very simple. Spot price. See, this is present value of dividend. You should remove. It is something like dividend. Na? What you should do? Okay, either you can do 16 by 7 divided by e to the power tr, or 16.7 into e to the power minus tr. Both will be same, I told you. Here in this question, they have given e to the power tr, e to the power minus tr in question value itself. Hence, you will multiply. Are you all understanding? In this question, if you see, they have given e to the power minus 1.17 and e to the power minus 0.10005. So that you will consider here, where it is, okay, here. See, minus 0.667 into 15. If you do this, you will get 0007. This, see, very simple. I'll show you. Minus 0.0667 is there and 15 is there. 15 is T. This minus 0.0667 is what? Dividend yield. Upper yield into T they have taken. Okay, e to the power RT. So e to the power TR or RT, how much it is? See, 0.0667 into 15. Okay, what? 1.05. That is what it is, and you got the number as 0.367. So very simple. Spot into e to the power minus TRF, which is present value of spot. Okay, that you do into ND1 minus exercise price into, okay, e to the power RT into ND2. Why here e to the power RT? Present value of exercise price. So E into ERT. E means exercise price, or X into, in our example I show you X divided by ERT, or X into e to the power minus TR. In this question, minus TR given there also. Okay, there also this minus TR is given. Hence, you will take the value, multiply and take the value, find out. Are you all understanding? You will get the value of the patent as 4.619 million. This is, okay, as per the Black-Scholes model. Thus, the value of the patent is 4.619 million. Alternative solution possible based on different interpretation. Okay, that is based on the dividend yield and as well as the risk neutral model. With this, we are through with the option, real options. Now, shall we move on to Hiller's model? Last segment of the capital budgeting. Very, very important. Okay. Skylark Airways is planning to acquire a light commercial aircraft for flying class clients at an investment of 50 lakhs. The expected cash flows after tax for the next 3 years is as follows. Year 1, 2, 3 given. Cash flow after tax directly given. No need to do any adjustment. Okay, this is CFAT already given. Probability for the respective cash flow after tax given for all these 3 years. Every year they have given. So cash flow after tax for year 1, there is a 10% chance for the cash flow for year 1 to become 14 lakhs. 20% chance for 18 lakhs, 40% chance for 25 lakhs, and 30% chance for 40 lakhs. Like this, they have given. Next, cash flow for year 2 and 3. Okay, they have given. Next, the company wishes to take into consideration all possible risk factors relating to airline operations. The company wants to know the expected NPV of this venture, assuming independent probability distribution. See, the Hiller's model is a really good model, and they have discussed a lot of things. Here, for solving the question, you need to know the computation alone. We don't have time for detailed discussion. Okay, there are so many things here. The cash flow under uncertainty, the capital budgeting it comes under capital budgeting under uncertainty. Okay, where probability based prediction you will do. You don't know what will be the cash flow or NPV. You try to find out the cash flows. Then you try to find out the mean NPV, correct, from the project, and then you will decide whether to invest in the project or not. Now, what they say, okay, the cash flows. See, when you have so many years, say the project is running for 3 years. In this question, the project life is 3 years. In this question, the project life is 3 years. And what they say, there are 3 years cash flows now, first year, second year, third year. There might be 2 situations. Situation number 1, the second and third year cash flow may be dependent on the first year, cash flow. Are you all understanding what I'm trying to say? Okay, to give an example, okay, I'm running a coaching business where I teach intermediate as well as final. Suppose I teach intermediate, and intermediate students are not satisfied. I did not teach properly. Inter itself, I did not teach properly. If this is the case, you tell me, will students enroll for CA final with me? Doubtful, na? Are you all understanding what I'm trying to say? Which means the final registration is totally dependent on intermediate teaching. Okay, correct? Now, this is dependent cash flows. Dependent cash flow, which means the second, third year cash flows are very much dependent on the first year cash flow. What is the first year cash flow will be the trend setter for the years to come. This is possible scenario number 1. Second situation where, okay, see, the second situation, what happens? The year 2 and year 3 cash flows are not dependent on year 1. Year 1, anything can happen. Year 2, anything can happen. Year 3 also, anything can happen. Are you all understanding what I'm trying to say? Okay, this is what will happen if you teach multiple subjects in final. Okay, which means one subject, sometimes students may come. Okay, students may like one subject. Okay, that way of teaching, and students may not like the way of teaching for same faculty, another subject, right? So this can happen, which means they are not dependent on one another. Okay, so independent cash flow. Now the subject matter. What is the issue now? You tell me which one will be more risky. When the cash flows are independent, those cash flows will be riskier. When the cash flows are dependent, those cash flows will be riskier. Dependent cash flows will be more risky. Are you all understanding why? Because first year incur loss. First year negative cash flow. All the years negative cash flow will be there. NPV will be even magnified. The negative NPV will be magnified. Are you all understanding? Loss also will get magnified. Okay. Don't think, sir, negative na, positive, first year positive cash flow, I can get bumper profit na. Don't think like that. Okay, risk is captured by the volatility, the huge volatility. Are you all understanding? Here what happens? The risk is so high because if I earn extraordinary income. If I lose more. Are you all listening? So this is why dependent cash flows are more risky than independent cash flows. Point number 1. Are you all understanding? Say, I don't want to go deep into that. This alone is sufficient. This much knowledge is sufficient. We can solve the question. Then I will tell you what happens here. Say, now, they are asking only regarding independent cash flows and not dependent cash flows. Hence, I'm ignoring. Are you all listening? Now, see what they say. Okay, first step is to find the expected NPV, mean NPV. This I want to find out. For that to happen, you want to find mean NPV. NPV is what? Discounted cash inflow minus discounted cash outflow, which means discounted cash inflow. Now, every year I need to take some cash flow. Then I need to discount. Those yearly cash flows I need to consider. That also, I am certain, uncertain. I don't know what will be the yearly cash flow. What will be taken? Average cash flow will be taken. Mean cash flow will be taken. So first step is to find the expected NPV. For that, you need to take mean cash flows. That is what I am considering. Year 1, year 2, year 3. First year, you have cash flow, probability, cash flow into probability, weighted average, mean cash flow. I get a year cash flow. See, very simple. 10% chance for cash flow to become, all are in lakhs, rupees in lakhs. Okay. Now, tell my children, 14 lakhs into 10%, 1.4 lakhs, 3.6 lakhs, 10 lakhs. Okay, 12 lakhs. Total comes to, on an average, how much is that? X bar. What is this number? Mean cash flow or expected cash flow for year 1. Like that, I will find expected cash flow for year 2. How to find it? Very simple. Cash flow into respective probability. You will find expected cash flow for year 2. Next, same way, you will find expected cash flow for year 3. Expected cash flow for year 3. Okay, you will get the mean cash flow. Are you understanding? Now you have these 3 data. I have mean cash flow for year 1, year 2, year 3. These cash flows, if I discount using present value factor, bring it to present value terms, I will get the discounted cash inflow. From that, if I remove the discounted cash outflow of 50 lakhs, I'll get the mean NPV, expected NPV. Are you all understanding? First step, see here, NPV calculation. How to calculate NPV? First year's mean cash flow 27, second year mean cash flow is 29.3, third year mean cash flow, average cash flow is 27.3. I expect these cash flows. Now, if I discount the expected cash flows, yearly cash flows, I'll get the expected NPV. To get expected NPV, what you should do? Expected cash flows, you need to discount the appropriate risk-free rate. Okay, there is a concept also I don't want to discuss. Hiller's model crux is using the risk-free rate to discount. Okay. Anyway, in the question, if they mistakenly give you cost of capital and no other risk-free rate, nothing given, you will assume to be, you will take the cost of capital and discount. Are you all understand? Discount rate will be given in the question. But original Hiller's model, RF should be taken as discounting. Okay. Risk-free rate should be taken as discounting. Anyway, so expected cash flows are there. Okay. Then you discount using risk-free rate. You will get the total present value, expected. Okay. The net, what do you say? Discounted cash inflow minus 74.974 lakhs you are getting, minus 50 lakhs you reduce, you will get NPV, expected NPV or mean NPV. Mean NPV is how much? 24.974. Are you all understanding the first part of the solution? That is not an issue. Easy only, simple and straightforward. Correct? See, the expected NPV of this venture, assuming independent probability distribution. Independent probability distribution, very simple. See, why the independent probability? See, if you assume it to be dependent, all 3 years cash flow will be same. Are you all listening? All 3 years cash flow will be same. Yeah, because first year cash flow will be trend setter. So first year average cash flow, this will be repeated every year. Okay, this will be for all the 3 years. You will take 27, 27, 27 as cash flow. Are you all understanding? And find out the NPV. But they have given independent scenario. So every year separately you will consider and find out the mean NPV. Point number 1. Next, possible deviation in the expected NPV. Possible deviation in the expected NPV. Second, they are asking deviation of the NPV. Now see, I have got the NPV. This NPV is average NPV. Average or mean NPV. X bar NPV and a mean NPV. Okay, NPV bar. What I call it as NPV bar. Now tell me, this is mean NPV. Average. Average means it will have extremes. It is certain, uncertain. It may be anything. It may go up, it may go down. But on an average, I expect this NPV. Correct? That is what is mean NPV. What is it? Next step they are asking, find out the standard deviation of this NPV. You know the NPV. To find out the standard deviation of the NPV. How to find it? See, there are 2 steps involved. I will tell you what happens. If you discount the average cash flows, average yearly cash flows, you will get the average NPV. Correct? Now what do you do? First step, what is the first step? Find out the standard deviation of the cash flows, yearly cash flows. Are you all understanding? See, very simple. Now, what you need to do, ultimately, you need to find the standard deviation of the NPV. Standard deviation of the NPV. Before that, now what they say, okay, now, first year cash flow is there now. What is the average first year cash flow? 27 lakhs. Is this certain, uncertain? Uncertain. You don't know. Okay, first year cash flow also, this is mean cash flow. There will be deviation. Yes. So, I will have standard deviation of first year cash flow. I will have standard deviation of second year cash flow. I will have standard deviation of third year cash flow. So, first step is to find out the standard deviation of the cash flow. First step is the find out the standard deviation of cash flow for 3 years. So, you will get 3 standard deviations. Shall we compute? Okay. Now, this is same as the portfolio management standard deviation computation. Okay, first column X is the respective values. So, 14 lakhs, 18 lakhs, 25 lakhs, 40 lakhs, 4 different possibility. So 4 different cash flows you put X minus X bar. For this, first X bar you need to find out. I have put working out here. I have not put it, no issue. X bar, you take it from the first, you can directly take it. X bar is 27. For the first year cash flow, how much is the X bar? 27. So X bar is 27 lakhs. You should remember, first year X bar is 27. We are taking possible deviation of the expected value. Okay, anyway, for possible deviation of the cash flows, first step we are finding out. I have put expected value. Next step we are going to compute. This step you can segregate into 2 steps. First step in a possible deviation of the cash flows. We are computing cash flows. I'll come back to the expected value. NPV I'll come back later. Okay. Now, year 1 cash flow. What is the deviation? This you are finding the deviation of the cash flow. Okay, so cash flow, it may be 14 lakhs, 18 lakhs, 25 lakhs, 40 lakh. X minus X bar. What is the X? 14. Minus X bar, 27. 14 minus 27, how much? Minus 13. 18 minus 27, minus 7. 25 minus 27, minus 2. Okay, and 40 minus 27, how much is that? 30. So column you remember x minus x bar. This will be the deviation. This is the deviation. Very simple. I have mean of 27 lakhs. How much it deviates? Minus 13. Okay, the actual value, if it is 14, it will deviate from mean minus 13. Minus 13. It will reduce from minus 13 from, it will reduce by 13 from the mean value. This is x minus x bar. Then this is the deviation. If I total the deviation, okay, can I total? I should not total. I should not total. What I should do? I should square it up. I should square it up. Are you listening? So what is that? Into 30, minus 13 into 13, remove the minus sign. Okay, you need to square it up. 169, 81, 4 and 169. Are you all getting x minus x bar the whole square? Then you multiply with probability. Okay, the portfolio management chapter, I would have told you the probability without probability. With probability, okay, you should multiply the probability. Without probability, n you should, okay, you should compute the x minus x bar. Okay, then what you should do? The square root of x minus x bar the whole square divided by n. Like this you will find out. Are you all understanding what I'm trying to say here? What you do with this is without probability. With probability, now what you do? Okay, square root of probability into x minus x bar the whole square, x minus x bar the whole square. Okay, divided by n, you won't do the divided by n. Are you all understanding? Which means you multiply the probability. I already would have got it. So that is what. That is how you will find out. That is how you will find out the standard deviation. See, this is basic computation. P into x minus x bar the whole square. So x minus x bar the whole square already I get 169 into 0.1, 16.9, and this is, sorry, I have to include the summation. I have to include the summation. I forgot that, no issue. Summation, because you have to total it now. 16.9 plus 16.2 plus 1.6 plus 50 by 7, total comes to 85.4. This is, I call it as variance. This is nothing but sigma square. I need standard deviation, I need variance, I need standard deviation. I'll get it as 9.24. Are you understanding how to compute standard deviation? Same method, portfolio management, you would have studied, no issue. Okay, year 2, okay, this is revision lecture, so I'm just quickly moving on. Year 2, the same x minus x bar. Here also x bar, you put it here. What is the x bar for the year 2? X bar is 29.3. So 29.3. Okay, here 15 minus 29.3, you will get minus 14.3. 20 minus 29.3 minus 9.3. Like this, x minus x bar the whole square into P. Okay, summation of x minus x bar the whole square of P. How much? 98.61. This is variance. Square root it. How much is that? 9.93. Like this, you will get 3 years standard deviation. Agreed? So step number 1, find out the standard deviation of the cash flows. Standard deviation of the yearly cash flows. Agreed? Now, but we need a standard deviation of the cash flow. We need to find standard deviation of the NPV. Standard deviation of the NPV. How to find out standard deviation of the NPV? Very simple. If you discount the expected cash flows, yearly cash flows, you will get the expected NPV. If you discount the standard deviation of the yearly cash flows, you will get the standard deviation of the NPV. Are you all understanding? Very, very important. Now, what do you say? Okay, if I discount the standard deviation, I got 3 standard deviation or 3 deviation from the mean. I will put it here. Year 1, 2, 3. I got the deviation this much: 9.24, 9.93, 8.69. Agreed? This what you should do. Discount and bring it to present value terms. Discount it again. Are you all understanding? Discount the standard deviation now. Discount the standard deviation using 6% present value factor. Multiply with present value factor. You will get 8.71, 8.83, 7.24. Are you all understanding? Now, next step. This is nothing but PV of standard deviation you got now. This is nothing but x minus, just like you take x minus x bar, okay, this you should square it up. X minus x bar the whole square you do in the previous segment. Like that, what you do? Present value of standard deviation, square it up. Present value of standard deviation, square it up. Why? Because simply you cannot add it. What you should do? You should square it up, total it, then find out the square root. Are you all understanding? Okay, now 8.71 into square into is equal to, how much is that? 75.86, 8.83 square, 77.96, 7.24 square, 52.41. Okay, how do you compute standard deviation? Okay, root of 206.23. Okay, standard deviation of the NPV. How much is that? 14.36. 14.36. Are you all understanding? Now, alternatively, ICA has given a formula. ICA have given a formula. Okay, no, it's for, see, very simple. This is not for each and everything. It is like the square root of everything. Okay, square root of 81.4 divided by 1.6 the whole square, r of the whole square plus, okay, 1 plus r the whole raised to the power 4. Next to third year cash flow raised to the power 6. Okay, logic I have explained here. Are you all understanding? This method can be used, no issue, but okay, many students get confused with that. So I am okay, showing this method. Are you all comfortable now? This is better now. 3 years standard deviation put it. Just like you find out the standard deviation of the other things, okay, you find the standard deviation of the standard deviation. You find the standard deviation of the standard deviation, but discount it. That is important because you want to find out the present value of the standard deviation. Agreed? That is what you will do. You will get the square root of 206.23. With this, we are through with the Hiller's model. Okay, this is sufficient, more than sufficient. Okay, 1 or 2 more questions are there with regards to Hiller's model. They have been in the first 3 questions or so in the Hiller's model study mat. Please go through all the questions. Why I'm saying is this is very, very important. This may be tested this attempt. Okay. Now, next, shall we move on to the Forex chapter? Okay. Now. Okay. Very, very important chapter. Okay. Now, we will start from basics because I see that most of the students get confused in the basics itself. If your basics is strong, the entire Forex will be very smoothly taken care of. Otherwise, if your basic is not wrong, okay, you will have a lot of issues in the upcoming discussion, like money market hedge or the covered interest arbitrage, or say currency futures, currency options, everything. Okay, you need to have strong basics in Forex. Don't think and the basics are discussed, but exam oriented marathon, why you are discussing basics, don't think like that. Take some time out. Okay, if basics is strong, any question you can solve. Believe me, in the Forex chapter, mergers and acquisitions, there are hundreds of questions available. You cannot do all the questions practically. Okay, not possible to do all the questions before the examination. So what I would suggest now, be conceptually so strong, be prepared, and you can solve any question. Okay, you should be mentally prepared to solve any question. But for that, you should have the basics strong. Shall we start? See, okay, one by one, we will start discussing the concept. Okay, just give me 20 minutes. You will be absolutely thorough with the concept. See, direct quote and indirect quote. First concept you need to understand is direct quote and indirect quote. So what is the first Forex quotation you need to understand? See, very simple. A quote for a foreign currency in so many units of home currency is called as a direct quote. Assume you are living in India. Assume you are living in India. Now in India, you see that you go to the Forex market. Okay, you see that just like you go to the vegetable market, what will be the quote given for what? Vegetable. Like that you go to the Forex dealer. Quote will be given for what? Foreign currency, which means $1 will be given as 80 rupees. This is a quote given in the Forex market. $1 is equal to 80 rupees. Assume, for example. Okay, now it has become so much. But anyway, $1 is equal to 80. You tell me, this is a direct quota, indirect quota, direct quote. Why? This is quoted in India. In India, okay, 1 unit of foreign currency. This is what is the understanding of this? 80 rupee per dollar. The bar, okay, whenever you should understand this as per. So 80 rupees per dollar. Like this, you try to visualize. So 80 rupees per dollar, okay, is what they mean here. What is the foreign currency here? Dollar. For every 1 unit of foreign currency in so many units of home currency, this is the quotation for a foreign currency. This is a quotation for dollar or rupees dollar. So this is called as direct quote. A direct quote is a quotation for a foreign currency in India. Okay, if it is in India, then a quote for a dollar or USD, yen, okay, any euro, pound, okay, in so many units of your home currency is called as a direct quote in India. Are you all comfortable? A quote for a foreign currency is a direct quote. It is 1 unit of foreign currency in so many units of home currency. Example, $1 is equal to 60 is direct quote in India. Agreed? Now, a quote for a home currency is an indirect quote. A quote for a home currency, which means you are also living in India, and the quote is given for rupee. Which means, see, very simple, you go to the vegetable market, you ask for 1 kg tomato. 1 kg tomato is equal to 40 rupees. This is quote for that particular vegetable. Are you understanding? Sometimes what will happen? Okay, can you buy 1 kg of chili, green chili? What do? Okay, you will say 10 rupees is in hand. I have 10 rupees in hand. Please give me equivalent amount of green chili. Like this you will say, same way here also. Okay, a quote for home currency, okay, is an indirect quote. Is 1 unit of home currency in so many units of foreign currency. Very simple. 1 by 80. What is this 1 by 80? How much? Or 1 by 80, 1 divided by 80. Okay, 0.0125, which means 1 rupee is equal to 0.0125. If this is the quote given for rupee, this is the rupee quote. Okay, in $0.0125 dollar. Okay, this is called as indirect quote in India. In India, this is very, very important. Are you all understanding now? This direct quote in India becomes the indirect quote in US. It becomes the indirect quote in the US, and the indirect quote in India becomes the direct quote in US. Where? Because in US, if you see, that is why I'm saying The domicile is very, very important. In which country you are living is very, very important. Are you understanding? So always when you read the Forex question, try to identify which country you are living in, which country the quotation is given. Okay. The problem is that some question may not mention anything, directly quote will be given. If this is the case where country is not at all mentioned, the company or country, okay, the domicile is not mentioned. Now what you should do? You will always assume it to be direct quote. You will always assume the quotation to be direct quote and try to visualize which country, okay, the quotation is given. For which country the quotation is given. Are you understanding? Now, see here I have given 1 by direct quote is equal to indirect quote and vice versa. Some currencies like Japanese yen are quoted for 100 units. In such a case, 100 by direct quote. Don't think, see, indirect quote you are saying, some currency like yen and all, okay, it will be quoted in 100. Always 100 it will be quoted. Which means, okay, because their currency is so, it consists of very less value. What they do is that they quote in 100 units of 100. Their currency always they quote in units of 100. Okay, so for example, $1 is equal to they will give you some 4,000. Okay, yen, something like this. Are you all understanding? So that also you should not think 100 given. Okay, you would not get confused. It should be treated as direct quote only or indirect quote. Direct or indirect quote, what you should do? 100 divided by direct quote. Usually what you do? 1 by indirect quote you will do na. Direct quote is equal to 1 by indirect quote. Instead of that, direct quote is equal to, okay, sorry, this is indirect quote is equal to 1 by, that is, direct quote is also there, no issue, but still, okay, this is indirect quote is equal to 1 by direct quote you do na. Instead of that, what you should do? 100 by direct quote. 100 by direct quote, because that country's direct quote always be given hundreds of units. So you should do this. Are you all comfortable? Okay. Anyway, if question, we will find out. If there is any question, we will find out. There is no issue. Okay. Bid rate and offer rate. Next concept is bid rate and offer rate. What is the next concept? Bid rate and offer rate. See, bid rate is the buying rate of the dealer. Suppose the bank quotation gives you 60 by 61. You already know that. What is this bid rate? How to understand? I'll simply tell. Bid rate is the rate at which the banker buys foreign currency from you. Are you all understanding what I'm trying to say? See, I'll tell you now. This is quotation. $1 is equal to rupee 61 given. Which means this 61 is rupee per dollar. Assume this is India. It is a direct quota, indirect quota. Now you are comfortable with direct, indirect quota because I will frequently use that. So this is in India, direct quota, indirect quota, direct quota. If direct quota is given like this, you tell me children, what will happen? What is the 60 and 61? 60 is the bid rate. 61 is called as offer rate. 60 is the bid rate. 61 is called as offer rate. What is this bid rate now? Very simple. You should think from the dealer's perspective. 60 is the price at which dealer will buy the foreign currency from you. Now, what is getting traded? Dollar is getting traded. Foreign currency will be getting traded. Are you all understand? Forex market, what will be traded? Foreign currency will be traded. Since this is the exchange market, you should not get confused. Traded now. You can also sell rupee. You can also buy rupee. You can also sell dollar and buy dollar. But effectively, you need to see what you are trading. If you are trading foreign currency and the quote is given for foreign currency, $1 is equal to 60.61. What they say, the dealer will buy your dollar at a lower rate, bid rate. This is called as bid rate. Dealer will buy you from 60 for 60 and sell the dollar for 61, which may be very simple. Case number 1, dealer, okay, you are going to buy dollar from the dealer. You are going to buy dollar from the dealer. How much rupees you need to pay? You need to pay higher amount. 61 rupees you need to pay. Okay, he will have some spread. The difference between bid rate and offer rate is called as spread. This is the benefit, the profit of the banker. Okay, banker's margin or dealer's margin. Are you all understanding? So if you want to sell your dollar, you can only sell at 60 rupees. Why? Okay, this is the customer's dealer's buying rate. Very simple. See here, I'll show you. Here, bid rate. Bid rate is nothing but, okay, dealers buying rate, which is nothing but customers selling rate, okay. Offer rate also called as ask rate, okay, also called as ask, is nothing but dealers selling rate, which is nothing but customers buying rate. Are you all understanding what I'm trying to say? Which means I want to buy dollar. What rate I should use? Offer rate. If the quote is direct quote, that is the level of understanding. Are you all clear with this? So quotation is also important. If the quote is so, which means what happens here? When you quote the same thing as indirect, what you will do? Okay, 1 rupee is equal to, what you should do? 1 by 61 hyphen 1 by 60. The offer rate of the direct quote becomes a bid rate of the indirect quote, and the bid rate of the direct quote becomes a offer rate of the indirect quote. Are you all comfortable? Okay, this is the understanding. Anyway, see here, everything I've given notes. If you have time, go through. Otherwise, directly you can jump. Bid rate is the buying rate of the dealer and selling rate of the customer, and offer rate is selling rate of the dealer and buying rate of the customer. Rupee 60, 61 means, okay, persons having receivable exposure like exporter. Now it is very important. See, if you are an exporter, if you are an importer, okay, you can be borrower, depositor, exporter, importer. That's all. The chapter is all about exporter, importer, borrower or depositor. Okay, see, if I am an exporter, I have exported goods to US. I will have receivables. I will have receivable in INR, dollar receivable, because you have exported goods there now. So you will have dollar receivable. Now, what you should do? See, ultimately, I need INR. I am Indian company. I need INR. Now, what I will do? I will sell dollar. I will sell dollar to the Forex market, dealer. I will sell dollar to the dealer. I will buy dollar. I will sell dollar, because dollar I would have received after exporting goods. After 3 months, I will receive dollar. This dollar I need to sell. So exporter, okay, will use what rate? Bid rate, offer rate. If you have dollar receivable, okay, and you are selling the dollar to the dealer, you sell at bid rate, offer rate, bid rate. Are you all understanding? Provided the quote is direct quote. Anyway, okay, so exporter like importer will use offer rate. So exporter will use bid rate, and who has payable exposure. If importer will have payables exposure, will use the offer rate for conversion. Are you all understanding? This is true provided the quote is direct quote. Indirect quote, not directly opposite. Okay, spread is there. It is difference between offer rate and bid rate is nothing but difference between offer rate and bid rate, margin to the dealer, everything given. Okay, now spread as a percentage. Sometimes easy question they may ask. Okay, I've seen there are so many old questions. Just remember spread as a percentage. Now, if you want to spread in terms of absolute term, how you find spread? Now, offer rate minus bid rate. Okay, we'll give you spread. The spread in percentage terms, this offer rate is banker's selling rate. This is like selling rate. This is bid rate. He will buy. This is buying rate. I call it as cost. Okay, so what is the spread? Very simple. Profit margin. What is the profit? Spread means you have spread in amount divided by offer rate, the sale price. Okay, institute what they does. Okay, what they do now? Usually they take bid rate. Bid rate, okay, profit margin can also be computed in sales, can also be computed in cost. Like that, they have used a bid rate. I don't know why offer rate is the correct way, but again, anyway, they have used a bid rate, okay, for finding the spread in percentage terms. Just given, okay, not spread and all, they will not ask at your level. Anyway, I'm just discussing, okay. Next, direct to indirect quote, already you know, conversion, very easy. Next, okay, see here, 1 by offer rate of direct quote is equal to bid rate of indirect quote. 1 by bid rate of direct quote is equal to offer rate of indirect quote. Okay, but there also, when we buy dollar is also selling rupees, and we sell dollar, it is also buying rupees. Hence, buying rate of dollar becomes the selling rate of rupees. Buying rate of dollar becomes selling rate of rupees. Simple. Now, cross rates, very important concept called as cross rates. Now, cross rates are exchange rates determined between two currencies with the help of a common currency quotation. With the help of a common currency quotation. Okay, suppose $1 is equal to Tanzanian shilling, they have given us 2050, and $1 is equal to rupees 60. Now, you want rupee per Tanzanian, see here, $1 is equal to Tanzanian shilling 2050 given, $1 60 rupees given, also given as $1 rupees 60. Now, you want to find out rupee per Tanzanian shilling per rupee. Assume Tanzanian shilling per rupee. Okay, this given or not given or not given. What you should do, what you require, you find out. Okay, for cross rate, I'll tell you what you should do. Find out what you require. You need Tanzanian shilling by rupee. What you do? Tanzanian shilling by rupee is equal to, take a common currency. What is the common currency here? Dollar is the common currency, correct? So common currency, you take in the denominator as well as numerator. So Tanzanian shilling divided by the common currency into common currency divided by the rupee. Dollar will get cancelled. Eventually, you will get Tanzanian shilling by rupee, correct? That is why you took common currency. Now, this Tanzanian shilling by dollar given, dollar per Tanzanian shilling given, Tanzanian shilling per dollar given. How much is that? 2050. You take it 2050. Agreed? This will give you 2050 into dollar per rupee is given. Dollar per rupee is given. What is the dollar amount? Okay, dollar per rupee. Rupee per dollar given. Rupee per dollar given, not dollar per rupee. Are you all understanding? So what I should do? Into 60, into 1 by 60, 1 by 60. Okay, see that 60. Okay, rupee per, very simple. Okay, in the example I have done, rupee per Tanzanian shilling. Okay, but I have solved a Tanzanian shilling per rupee. I have solved a Tanzanian, it is the requirement. I have, okay, it just require. In my example, it is what is that? I have given notes as rupee per Tanzanian shilling. That's fine. Okay, 2050 divided by 60, how much is that? 2050 divided by 60. 34.16. This is a cross rate. Okay, the cross rate, you may need to compute bid rate and offer rate. At that point, how to compute all this, I will explain at the appropriate place. Okay, don't worry. There is one issue. Okay, how to compute cross rate when bid and offer rate is given. When bid and offer rate is given, mostly that situation will come. Okay, when there is two-way quote, where only single quote is given, I call it as one-way quote. Where there is bid rate as well as offer rate is called as two-way quote. Are you listening? Okay, I will explain. Anyway, identify quotes given. You can go through Axis Bank in Chennai. So it is in Chennai. Axis Bank has given the following quotes for its trade today for various currencies. Identify whether the quote is a direct quote or indirect quote. Also compute the direct and indirect quote and vice versa. Okay, direct quote opposite rate given. See, $1 is equal to 75.80. What is the quote? Direct quote. £1, because this is in India, na? So this is direct, this is indirect. This is, see, this is what I told you. 100 Indo Rupaya is equal to 0.51 rupees. So this is Indo Rupaya. This is foreign currency, FC, foreign currency. Now you tell me this is direct quota, indirect quota. Direct quote only. Don't think just because they have quoted in hundreds of units, it will not be indirect quote. But how to find, this is a direct quote. But what you should understand, so 100 Indo Rupaya is equal to 0.51. Opposite rate, if you find out the indirect quote for this. How to find out the indirect quote? All the other things very same. 1 by 75.88. Like this you will find out. I don't need to discuss at all. But this one, how you find out indirect? Instead of 1 by this amount, you should consider what? Okay, 100 by 0.51. Are you all comfortable? This is how you should do. Next step. Anyway, one Hong Kong, okay, can go through. But two-way quotes, shall we move on to two-way quotes? Yes, here also there's a question, simple question only. You can go through one or two things. I'll just do. INR 75.87, 75.97. How to find out bid rate and offer rate? See, first in a, what is the domicile? What is the domicile? What is the country? Which, okay, the company or the bank, you first to see in which country it is located. Now the following two-way quotes are available from a bank in Chennai. This is a Chennai-based bank. Now for this Chennai-based bank, this quotation is given direct quota, indirect quota, INR per dollar, direct, indirect, direct quote, which means bid rate. What is the bid rate? 75.87. Offer rate is 75.97. Are you all comfortable? Next, spread is what? 75.8797. 0.1 is the spread. Spread in percentage terms, 0.1 divided by institute solve takes bid rate. I told you 75.87. Are you all comfortable like this? If you find out, you will get the percentage terms. 0.1 divided by 75.87. Okay, into 100. Now percentage into 100. How much is that? 0.13 percentage. 0.1318 percentage. 3%. Like this, you can find out for all the other. Just given for practice. No need to worry. Okay. Now next. Application of bid and offer. This is important. Question number 26. Now you are going to apply whatever you have learned in the basics. Okay, I've taken some time to make you understand the basics. Now is the important discussion. Please apply. A customer has made the following transaction in the foreign currency. Determine the home currency inflow or outflow of the same. Quotation given. First, you tell me a customer has made the following transaction in the foreign currency. Now, assume you are in India. Okay, you are in India. Now you have taken a foreign currency transaction. You tell me. Exported goods to US worth 10 lakh. Exporter will have foreign currency receivable or payable. Foreign currency receivable. Are you all understanding? FC receivable. You will have dollar receivable. You have $1 lakh, you will have receivable. Now you tell me. Now, if you will take bid rate, offer rate, you have receivable. In the future, you will sell dollar, buy dollar. You already got the dollar in hand. Exported, you got the dollar. Now you will sell the dollar to the dealer and convert it to rupee. Now you will sell the dollar now at dealer's buying rate, selling rate. Dealer's buying rate is equal to customer's selling rate. If you want to sell it, customer's selling rate is nothing but dealer's buying rate, bid rate. Are you all understanding? 74.12 into $1 lakh. Okay, exposure amount. You will get the total receivable or payable in terms of INR, in terms of Indian rupees. Are you all comfortable? Next, like this, we will do each and everything. See here. Just we don't need to calculate the amount. Just to tell me bid rate or offer rate. That is sufficient. Purchased components from UK worth 25,000 pounds, which means imported foreign currency payable, pound payable I will have. If a pound payable na, tomorrow what I will do with the dealer? I will sell pound, buy foreign currency. If I want to buy, dealer will sell me pound at 91.33 and not 91.12. Are you all having the clarity? 91.33 should be taken. Are you listening? Next, euro. Okay, rupee per euro given. Borrowed money from Germany. Euro 1,70,000. Borrowed money from Germany. Euro 1,70,000. Which means you have borrowed from Germany. Na? Tell me, you will have foreign currency payable, receivable. See here again, the interest payment is separate. Borrowing amount cash flow is separate. So you initially will borrow. See, if you initially borrow, it will be inflow or outflow. It will be inflow. Are you all understanding what I am trying to say? You borrow foreign currency that you want to convert into INR. For example, India-based business, you are borrowing from US. You will be borrowing USD, but can you spend USD here? What is the use of it? Are you understanding? You will convert it into INR. Then for your business, you will use it. Are you listening? So borrowing. Don't think of interest now. Borrowing is a separate transaction. Later on, interest payment is a separate transaction. Are you listening? So for borrowing, what I will do? If I borrow now, money will be foreign currency. I will have in hand. I will need to sell the foreign currency at bid rate. Are you all having the clarity? Next, interest paid on borrowing. What is that? Interest paid on borrowing. Very simple. I have borrowed foreign currency, euro borrowing, which means I borrowed in foreign currency, euro. But later on, I need to pay periodic interest for that. Up interest, I need to pay in INR. I need to pay euro interest. Agreed. Up euro interest, where I will go? I will steal a pickpocket, or I will need to convert. I need to convert, which means I will sell rupee, buy euro, and then pay the interest. Are you all understanding? So with regards to euro, foreign currency, I will sell foreign currency or buy foreign currency. Buy foreign currency. From the dealer, I will buy the euro and settle the interest to the, what is the lender. Which means here, what rate I will take? I will, what is that? I will borrow by euro. I have to buy 81.93. I have to pay 81.93 and buy the euro, and then settle the interest. Are you all listening? Next, deposited funds in Japan to the extent of 19 lakhs. Up 19 lakhs, I deposited funds. Not received interest, I am depositing. A separate transaction. So I deposit. What I need to do? I need to deposit foreign currency. I have rupee in hand. I need to convert into foreign currency. What I will do? I will buy foreign currency from the dealer. I will buy foreign currency using my INR. I will sell INR, buy foreign currency and deposit in the Japan bank. Or what I will do? Rupee by 100 yen is given, right? Rupee 100 yen is given. Now this is direct quota, indirect quota. Again, rupee per yen, this much. Direct quote in India. So what I will do? Deposit, which means you will sell la bhaiya. You have to buy the foreign currency, which means you will buy at 70.93. Are you all understanding? You need to make deposit. Okay, 70.93. Next, cross rates. Tell me, children. Okay, here. Are you all understanding? Okay, see. Cross rates. Okay, find out the cross rates from the following. Dollar per pound given. This much. What is this? Yen per pound given. So here, what they have given, you need to find dollar per pound given and yen per pound given. You need to find out yen per dollar. So what you need to find out whenever you are trying to find cross rate, whenever you are trying to find it, okay? First to find out what you need actually, which means yen per dollar. You need, target is yen per dollar, you need to find it, correct? Which means quotation for dollar, yen per dollar, quotation for dollar. This is the understanding. Okay? Is equal to what? Yen divided by common currency. What is the common currency? Pound. Into pound by yen. Agreed? This is very simple. Yen divided by pound given, yes, yen by pound given 235.2. Okay, divided by what you should do. Tell me, what is the understanding? Into now pound per yen given. What is it? Pound per. Okay, what is that? Not yen. Okay. Sorry. This that is what I'm thinking. Pound per dollar, because you need dollar. This will go to denominator. Here pound will be there. Okay, 235.2 into pound per dollar. What is the pound per dollar given? Dollar per pound given. Dollar per pound given. Up into 1 by 1.5240. Okay, solve 235.2 divided by 1.54524. How much is that? 154.33. Are you all understanding? This is the way you need to solve. Okay, you can go through next also. Okay, next, just roughly tell me, children, what is here? Second point, euro per pound is equal to this much and euro per T is this much. Okay, what is the, okay, pound given or euro given, okay, euro is the common currency. Euro is the common currency. They want to find, okay, this is to be, some mistake is there, I think. What is this T? Okay, sorry, inge pound is given, euro is given, there are more currency in it. Okay, so no, there is a printing mistake, no issue. Okay, where there is mistake, I don't know. Leave this question part. Don't need to do this question, leave it. Okay, I don't know where the currency mistake is there. Some typographical error is there. Okay, move on to the next 3. Okay, now there is bid rate and offer rate. This is very, very important. This is important. See, there is bid rate as well as offer rate. There is bid rate as well as offer rate. You need to find out euro divided by pound, euro per pound, and okay, the common currency is what? US dollar. The common currency is dollar. Then what you should do? Okay, euro divided by dollar into dollar divided by pound. This is what you need to find out now. Here I have 2 things. I have bid rate as well as offer rate. I have bid rate as well as offer rate. Are you all understanding what I'm trying to say? When you have bid rate and offer rate, first to form this equation. Okay, to find out euro per pound, you need to have euro divided by dollar into dollar per pound. Fine. The problem is, first you need to identify, okay, whether you will sell dollar and convert it or whether you will buy the dollar. Are you understanding? So before doing all this, if two-way quotes are given, cross rates also will have bid rate and offer rate. Cross rate will also have bid rate and offer rate. Are you all understanding what I'm trying to say? Which means, see here, very simple. Now, this two-way quotes given now, the euro per dollar I need to find out now. This will have euro per dollar now. I will have bid rate as well as offer rate. How to compute bid rate? Very simple. What you should do? Dollar per, here, euro per dollar given now. Euro per dollar given. What is that? 0.1982, 0.1992. So, bid rate of the cross rate, bid rate for the cross rate is equal to bid rate of the euro per dollar is given. Take it as such, 0.1982. Take 0.1982, 0.1982, which is nothing but euro per dollar, which is nothing but euro per dollar. Are you all having the clarity? Into dollar per pound. Now, here, dollar per pound is also given. What is that? 1.5537 hyphen 1.5559. 1.5559. Now, what you should do? Multiply with 1. Here, dollar per pound. Bid rate you require, offer rate, bid rate. What you should take? 1.5537. 0.5537. This is bid rate of the cross rate. How much is that? 1.982. 0.982 into 1.5537. How much is that? 0.30. 0.3079. Are you all understanding? Next, offer rate. When you come to offer rate, tell me children, same offer rate you will consider 92, அதாவது 0.1992 into 0.1959, 0.1559. So 0.1992, 0.1992 into 1.5559. Okay, this will be the offer rate. What is the offer rate? 0.3099. Are you all comfortable? So this is the bid rate. Apo the euro per pound can be quoted as how much? 0.3079 bid rate. Offer rate 0.3099. Cross rate will also have cross bid, cross offer. Are you all understanding? Comfortable? Now, one question will arise. One question, okay, will generally come here. What happens? The quote is given for dollar per pound is given. Sometimes they may also give pound per dollar. Okay, any one quote. Here we have got directly this quote and we have taken directly. Are you all understanding? In this case, what you should do? You convert it one by other rate. If that is the case, if you need to convert this, suppose this quote, suppose in the same example, here they have given pound per dollar is equal to 1.5537. 1.59 or 1.5559. This is given. Now what you should do, very simple. Okay, pound per dollar, you need to convert it. If you want to convert it, first, when you are finding bid rate, you should not use bid rate, you should use 1 by offer rate. That is why I have explained in the first segment. Are you understanding? Which means this we did now 0.1982 into 1.5537. While you compute the bid rate of the cross rate, 1.5537 you have considered now. That 1.5537, instead of that, okay, what you should do? 1 by 1.5559 you should consider, or you are understanding, you will get the bid rate of the cross rate. Okay, anyway, this is enough for the basics. Okay, you will, I think at this level you should be already thorough with these concepts. Anyway, I have discussed briefly. Shall I proceed? Forward hedging basics. Shall we move on to forward hedging? Shall we start forward rates? Okay. Forward rate is an exchange rate quoted today for a transaction to take place on a given future date, which means if you want to buy dollar or sell dollar, not today. If you want to buy or sell dollar today means, okay, you go to the spot market. I go to the spot market and there will be quoted, exchange rate quoted now 80 rupees per dollar. Like this quotation will be given. It is spot quotation, spot rate. Now, if you want to, okay, enter into a transaction wherein, okay, the transaction will take place on a given future date, but you want to lock in a price. This is called as forward rate. Okay, this is forward rate. Now, the forward rate, okay, may either be quoted at premium or discount. For it, very simple, premium or discount with regards to the spot price. So, spot price is given. Spot is given $1 is equal to 80. Forward is given, okay, $1 is equal to 85. What is this? Premium. The dollar quoted is what? The currency quoted is dollar. The dollar is quoted at a premium in the forward market. Are you understanding? Forward market, the dollar is quoted at premium and the rupee is quoted at discount. This is what is the understanding. Now, forward premium and discount forward, which means how to compute the forward? Now, very simple. Either outright forward, this forward rate, okay, either they may give outright forward. Outright forward means you don't have to do anything. Just the forward rate will be given just as it is, you can consider. Or they may give you spot rate and they may give you swap points. Okay, the swap points you need to add or subtract, plus or minus the swap points. See, the premium forward, okay, forward rate greater than the spot rate is called as premium forward. Discount forward means where spot rate is, okay, greater than forward rate, which means forward rate, quoted forward rate is lower than spot rate. It is called as discount forward. Very simple. Spot rate 60.45 and 60.55. Now, forward rate is 60.75, 60.75 and 60.95, which means this is higher. Yes, the forward rate is greater than spot rate. It is trading in premium or trading at premium price. Are you understanding? This is spot rate here, rupee per dollar, 60.45 and 60.55 spot rate, but the forward rate is lower than spot rate, 60.05 and 60.25, which means forward rate is lower than spot price. This is discount forward. Now, sir, which currency is quoted at premium or discount? Now, very simple. The rate is given for dollar. Now, rupee per dollar. Now, what is the quote given for? This is the quote given for dollar. Hence, the dollar is trading at discount here. Okay, here the dollar is traded at premium. Why? Because very simple. In the spot market today, which means today, spot is a price. Spot price is the price. Okay, for the transaction to take place today, which means if you want to enter into transaction today itself, this is the price you have to pay or you will get. Are you understanding? So 60.45 and 60.55 is the spot price, which is lower than the forward price, which means today you have to pay lesser rupee to get the dollar. Tomorrow you have to pay more rupee to get the dollar. Are you all understanding? So dollar is trading at premium, okay, in the forward market. Here dollar is trading at discount in the forward market. Are you all clear with this? Okay. Now, the forward rate, see, you may think why we are discussing this much. Okay, relevance is there because in the future, okay, money market hedging, covered interest arbitrage, what is that? Currency futures and currency options, everything will go smoothly and quickly if you are comfortable with this. Okay. Now, the forward rate quoted can be outright forward or spot rate with swap points. I told you, now, forward rate can be quoted as directly quoted, which I call it as outright forward, or swap. The spot rate will be given, swap points will be given. Either you have to add or subtract. Okay. Now, see, premium swap points. Sir, whether I have to add or subtract, what is the indicator? How to see it? Very simple. if the order given is ascending order, which means the points is given as swap points, the order of what? Swap points. If the swap points, see for example, this is spot rate given 60.44, 60.55. Swap points is given 30 by 40, 30 by 40. Ascending swapper, descending swapper, ascending swap, increasing swap. Now 30 is lower, 40 is higher. In this case, what you should do? You should add, okay, which means this premium 60.45 plus 0.3. See here, decimal, if decimal is 2 decimal is being asked, you just add to the from the last 2 decimal. Are you all comfortable? Okay, if here it's a quotation given for 4 decimal, 60.4525, like this quotation is given, and 30 by 40 is given a swap point. What you should do? Last 2 digits you should add. Are you all comfortable? Okay, swap points generally will be added from the last 2 digits anyway. Now, the swap spot rupee per dollar 60.45, 60.55, which means what you should do? Ascending swapper, descending swapper, ascending swap, add 60.45 plus 0.3, 60.75, 60.95. Okay, now here spot rate is 60.45, 60.55, and the swap points are given as descending swap, 40 or 30, which means what you should do? Subtract it. Okay, 40.45 minus 40, how much is that? 60.05. 60.55 minus, okay, 0.3, this 30 means last 0.330, okay, which means 60.25. Are you all comfortable? Okay, this is how you will compute ascending swap and descending swap to arrive at a forward rate. Now, forward premium or discount, I told you how to find out this premium or discount in annualized percentage terms. This is very, very important. Are you all comfortable? See, now the forward premium or discount is expressed as annualized percentage, so it can be compared with interest rates. Okay, covered interest arbitrage in the next topic we are going to discuss. Okay, for that this will become a computation. So tell me, forward premium or discount. Forward premium is equal to what? Premium or discount. Premium or discount. If it is in negative, it will be discount. If it is in positive, it will be premium. So forward rate minus spot rate divided by spot rate into 12 by n into 100. This is the into 100 into 12 by 1. Anything you can do. Okay, you'll get the same answer. Are you all understanding? See, what is the formula for forward premium? Forward rate minus spot rate divided by spot rate into 12 by n divided by 100 into 100. You will get in percentage term, in annualized percentage terms. Why this is important? Very simple. Forward contract entered for 3 months, but okay, interest rate in the market will be always quoted in the annualized terms. Are you listening? So forward premium or discount, okay, the forward time period, say for example 3 months or 6 months will be there, but you cannot compare this forward or premium discount with the interest rate, because interest rate will be always quoted on the per annum basis. Therefore, you have to annualize this forward premium or discount. Okay, which means what you should do? The forward rate minus spot rate divided by spot rate is there. This is and premium or discount into 12 by n. N here you will take the forward period, maturity period, forward maturity period, which means the 3 months forward, not 12 divided by 3. Okay, you should multiply it 4 times. Are you all comfortable? This is how you should find forward premium or discount. Okay, here one small question is there. We can quickly solve this question and move on. Forward premium or discounting basics given. See, spot $1 is equal to 75.12 and 75.24. 3 months forward rate given. Comments on the forward as outright, a spot outright forward, which means because directly given as forward rate, okay, this is called as outright forward. There is no swap points involved. Where there is no swap points, it's called as direct outright swap. Outright forward. Find out premium or discount in annualized percentage. How to find a premium or discount? Again, very simple. See, 75 point spread in a premium or discount. See, this is, you should not get confused with the spread amount. Here the bid rate offer rate spread is there. That is not okay, that is not what we are concerned with. Are you all understanding what I'm trying to say? Which means here when there is bid rate and offer rate or ask rate for both here spot as well as forward. Are you all understanding? So forward also has bid rate and offer rate here. Now, what do you mean? Here we are computing forward premium or discount, which means for bid rate also there will be premium or discount. Offer rate also there might be premium or discount. Are you all comfortable? So it need not be same always. It need not be same. Okay, the spread between okay bid rate and offer rate might be different. Are you all comfortable? So what I do is that forward bid rate minus spot bid rate, okay, divided by spot bid will give me premium, okay, into 12 by n into 100 will give me, okay, premium or discount for forward bid rate. Are you all understanding? Okay, like this we need to understand. Okay, this will be calculated for bid rate also, premium will be there, and offer rate also, premium will be there. Need not be same. Like this you need to compute the premium or discount. In this example, tell me one question we will solve. What is the premium for bid rate? Tell me 75.87, 75 point, okay, 87 minus, what is the spot rate? What is the spot rate? 75 point, spot bid 12 divided by 75 point into 12 by how many months given? Not given. 3, yes, 3 months, 12 by 3 into 100. How much is that? 75.87, 75.12 divided by 75 point into 12 divided by into 100. How much is that? 3.99%. Annualized, this is annualized premium percentage. Premium, na, because created premium, so annualized premium percentage. Are you all comfortable? This is bid. Again, this is for bid. Offer, you tell me 75.99, 75.99 minus, okay, 75.24 divided by 75.24 into 12 by 3 into 100. How much is that? 75.99 minus 75 point divided by 75 point into 4, 3.98. Okay, 3.987, roughly same here. Okay, 3.987%. Are you all comfortable? It need not be same. Okay, I've seen a question where they have asked you to compute the bid as well as the offer. The what do you say? The premium for bid and offer. Okay, spot rate given. 3 months, swap points is given. Find out the forward rate. How to find out swap? Ascending swap or descending swap? First ascending swap. What you will do? I will add 75.01 plus 0.54. 75.55 is the bid. Okay, bid forward bid and forward offer. This is forward bid. Forward offer. How much is the forward offer rate? 75.0, 75.12. 75.12 plus 0.96. How much is that? 76.08. Are you all comfortable? This is how you need to find out forward rate using swap points. Okay, then you can go through simply. Okay, shall we move on to forward rate determination? See, okay, now we have the forward rate. Now, how to arrive at fair forward rate? This is forward rate determination. Now, we are here trying to compute the fair forward rate. Till now, we computed the quoted forward rate. How in the market, if you see that forward rate will be given. Forward rate will be quoted. This is called as quoted forward rate. Are you all understanding? The quoted forward rate, okay, which is quoted at fair price or not, we need to find out now. Just like future, fair futures price, any other asset, okay, we need to value this forward now. Okay, correct value of this forward. How to find out? We have something called as purchasing power parity theory and interest rate parity theory. First, we will explain the purchasing power parity theory. This is fair forward as per PPT, purchasing power parity PPP theory. Okay, and we have IRPT theory, fair forward as per IRPT. Okay, we will find out. First, purchasing power parity, what it is, how to determine the forward rate. See, forward rates quoted in the market, quoted in the currency dealers, they quote the forward rate, fine. But how they are trying to quote the forward rate, how the fair forward will be arrived, this we need to understand. Valuation of the forward. Okay, very simple. See, purchasing, there are two methods to value this. Purchasing power theory, there are two predominant theories, purchasing power parity, interest rate parity theory. What is this purchasing power parity? Okay, see, price of the goods, okay, there should be only one price of the goods prevailing in the market. Across the globe, only one price should prevail. For example, in India, I'll give you one example. In India, assume a computer is 40,000 rupees. In India, this is in India, this is US. Simple example. Okay, there is a computer. Okay, same model, some model. Okay, you take one computer, you can buy it for rupees 40,000. Model, everything same. Okay, all the aspects same. Price is 40,000 in India. In US, if you see, it is quoted at 1,000. It is quoted at $1,000. Are you understanding? So same good. Assume this is computer. So the same good, if you want to buy in US, okay, the equivalent dollar you need to spend is 1,000. Are you all understanding what I'm trying to say? In India, for buying this computer, you require to spend 40,000. In US, you require to spend 1,000. As per purchasing power parity theorem, okay, one price should prevail Okay, across the globe, one price of the good should prevail across the globe, which means if I say the $1,000 will be equivalent to 40,000, the purchasing power of $1 will be equal to 40 rupees. Are you all understanding the purchasing power? Which means in US, whatever you can purchase using $1,000, the same thing you can purchase using 40,000 rupees. Upon the purchasing power of $1 as per the PPT is equal to nothing but, okay, 40,000 divided by 1,000, which is equal to 40 rupees. Are you all comfortable what I'm trying to say? Okay, $1, the exchange rate, fair exchange rate should be $1, 40,000, because whatever I can buy here by paying 40,000, I can buy there by paying just $1,000. This should be the forward price. Are you all understanding? To simplify it, this I can put it in formula. Okay. Now this is spot rate. This is spot rate. Are you all clear with this? Now what I say, see, this is as of today. This is as of today. Okay. Now, what happens tomorrow is that very simple. Tomorrow, same India, okay, and I have US, same computer is there. You tell me, Chan. Last year, I bought a computer for 40,000. The same computer, can I buy using the same 40,000 rupees in India? Can I buy? I cannot buy. Why? Because of inflation, because of the inflation factor, which means the as the time gets elapsed, okay, the value of the money gets diminished, correct? Because of inflation and risk, I already told you in the time value of money. So very simple, either 40,000 rupees, okay, the purchasing power of this 40,000 rupees will be diminished. Because of it, the same computer you cannot purchase using the same 40,000 rupees. Assume the inflation, because of inflation, the inflation assume in India is 10%, US is 5%. This is inflation. Okay, reduces the purchasing power of the money. Hence, here inflation 10%. 40,000, whatever I purchase the computer using 40,000, I have to pay 44,000 in the next year. This is year one. Next year, I have to spend 44,000 to buy the same computer. US, okay, inflation is 5%. Hence, the goods, okay, increase in value. But what I should pay now? Only 1,000. What is the 5%? 1,050. 1,000 into 5%. How much is that? 50. So $1,050. Are you all comfortable what I'm trying to say? Which means 44,000 is the amount in India after considering the inflation effect next year. Same way US also, you can purchase the same computer not using $1,000 by using $1,050, which means this should be the equivalent price of both the goods. Are you all comfortable? Now this becomes the equilibrium price, which means $1,050 is equal to 44,000 rupees, which means $1 is equal to 40. What is that? 44,000 divided by 1,050. How much is that? 44,000 divided by 1,050. Okay, 41.9. 41.9. So next year, the fair forward rate, okay, as per purchasing power parity theorem, it should be 41.4, 41.9. Okay, the formula for the purchasing power parity is nothing but, okay, see here, I'm showing no place. No, here I will just see, there is a formula now. You can understand it like this. Formula I'll give you very simple. Forward rate as per PPT, purchasing power parity theorem, PPPT is equal to, what is that? Spot rate into 1 plus, okay, inflation of home currency divided by 1 plus inflation of foreign currency. 1 plus inflation of foreign currency. Now tell me, children, what is the spot rate? First, initially, spot rate was 40. 1 plus inflation of home currency is how much? 10%. So 1 plus 10%, 1.10. I can write 1.10 divided by 1.05. Are you all comfortable? Is equal to 41.9. This 41.9, I can derive either this method or this method. The understanding, okay, because this I equate it now, very simple. 44,000 I equate it to 1,050. 1,050, how I arrived? Okay, spot of the dollar, spot dollar 1,000 into 1 plus inflation of dollar currency, correct? Here also, spot of rupee 40,000 into 1 plus inflation of rupee. Are you all understanding inflation in India? I just considered and found out the forward rate. Everything I have given notes, you can go through. So simple terms, what do you tell me? Okay, I have go through, you can see that. Example, transaction sold is 100, similar transaction 4,000. Transaction inflation India is 8%, here 3%, number is changing. That's all, I explained everything. Okay, this is what is PPT theory. So formula, here I have given formula, not given I have given, I think, where I have given, okay, purchasing power I have not given Not given. No issue. Not given. You can write it down. Spot rate into 1 plus inflation of home currency. Inflation of home currency divided by 1 plus inflation of foreign currency. Are you all understanding what I'm trying to say? This is what you will get. Okay, you will get the exchange rate 41.9 na, that is 41.9 you will get as exchange rate. Okay, this is fair forward. Today 40 rate. If today is what is 40 and tomorrow interest rate is next year, the current year, upcoming year, the inflation of the India is 10% and the US is 5%. Now, this will be the fair forward. Quoted forward need not be same as fair forward. It can be something different. This is fair forward. Next one. See, you can go through the notes and all. I'm moving on to interest rate parity theorem. Same, everything will remain same. Replace interest rate, okay, replace the inflation with interest rate. Are you all understanding? Interest rate is a better measurement than the inflation. There are so many reasons. Okay, I don't want to discuss that, but understand that it's an equilibrium price. To avoid, okay, the arbitrage in the money market, really speaking, the currency market value derives value from the money market, prevailing interest rate of two countries. Are you all understanding? So, interest rate is a very key metric. Hence, what is the IRPT forward rate as per interest rate parity theorem is nothing but spot into 1 plus interest rate of home currency divided by 1 plus interest rate of foreign currency. Agreed? Okay, this anyway. Now, the problem is that you will understand covered interest arbitrage. We are going to understand why interest rate will influence the exchange rate. Are you all understanding? The underlying theory of this interest rate parity is that very simple. See, the country's exchange rate should never give an opportunity to make the profit in money market. There should not be ready-made arbitrage opportunity in the currency market because of the interest rate fluctuation. Are you all understanding? Which means, as per this theory, what the conclusion we can, this is US, this is India. Okay, the India assume currency $1 is traded. See, currency market. This is the currency market. CM currency market. $1 is equal to at present 80 rupees. $1 is equal to 80. And forward market, this is a forward, this is spot. And forward, what is the rate? $1 is equal to 85. Assume this is the rate. Okay. Now, the point is the exchange rate I'm giving spot and forward. Now, this is actually derived from the interest rate, which means the prevailing US interest rate is there. Indian country's interest rate is there. The country which is having, suppose US interest rate is 5%. And India interest rate is 10% in the bank. If you go to the long-term interest rate, okay, it is 10% and 5%. Okay, the country having, now it is important conclusion, the country having a lower interest rate will have its currency always quoted at premium. Are you understanding? The country which is having a higher interest rate, okay, will always have its currency, rupee, quoted at discount. Are you all comfortable with that? Which means, to put it simply, I have two markets involved. One is currency market and another is money market. That's why money market hedge I am going to clarify. In the currency market, if you are quoted in premium, you will gain in the currency market. Assume you bought the dollar. Tomorrow, dollar became 40. $1 was 40 rupees last year. This year, it became 41.9. Dollar appreciated na. Up a currency market, you will have gain. You will make a profit. Are you all understanding? If you make a profit in currency market, money market, you will incur loss because, okay, what will happen? Money market, you will always lose because the money market, the interest rate will be quoted at discount. Are you all understanding? So the currency which is quoted in premium in the currency market will be quoted in the money market. It will lose in the money market, and the interest rate, okay, in the country in which the interest rate is lower will have its currency quoted premium in the forward market. Are you all understanding? This is the okay, detailedly I need to discuss. I don't have time. That's why I'm discussing briefly, which means two markets available. One line summary, two markets are there. Currency market, money market. Currency market, assume the spot rate is 40, you are gaining. Okay, tomorrow currency appreciates. Very simple. Currency market, money market. Currency market, currency appreciates. Interest rate market, what will happen? Okay, the country's interest rates have come down. That is understanding. When interest rate market you are gaining, okay, then what is happening? For example, today interest rate in India is 10%. Tomorrow interest rate become 5% after 1 year, which means currency, Indian currency will appreciate. It will be quoted at premium. Are you all understanding? So these are all the understanding currency market and relationship between currency market and money market and IRPT forward rate as per IRPT, interest rate parity theorem. What is the formula? Okay, spot rate, forward rate as per IRPT is equal to fair forward as per IRPT. This is fair forward. Are you understanding? For comparing, when we learn arbitrage, we will compare fair forward with actual forward quoted by the dealer we will take, and we will take fair forward and compare. Okay, then we will find out if the actual forward is not quoted as per IRPT, is not as per IRPT forward, what should have been the fair forward, then arbitrage is exist. We have two arbitrage, currency arbitrage and covered interest arbitrage. We are going to see covered interest arbitrage, very important for this attempt. Shall I discuss? Okay, see. So fair forward, actual forward, now very simple. Fair forward formula, what is a spot into 1 plus interest rate of home currency divided by 1 plus interest rate of foreign currency. Are you all understanding? Provided the quote is direct quote. Provided the quote is direct quote. Again, that you should remember. If the quote is itself is indirect quote, okay, what will happen to the formula? Na? Spot into 1 plus interest rate of foreign currency divided by 1 plus interest rate of home currency. Don't think why we are discussing all this. Everything I'm going to explain and apply. Are you understanding? Okay, people who don't have clarity in these concepts will suffer in covered interest arbitrage, currency market, currency futures, currency options, money market hedge. Everything will be complicated. Are you all understanding? Okay, this clarity you should have. Shall I proceed? Okay, I've given everything as notes. You can go through. I will put it as a PDF. Okay. Now, after 1 year, what will happen? And formula also I have given. Okay, for 1 unit of foreign currency is equal to, this is 1 unit of foreign currency in the forward rate. This forward market is equal to spot rate into 1 plus interest rate of home currency divided by 1 plus interest rate of foreign currency. Shall we solve some beautiful question? Take question number 49 for discussion. Very interesting, one of the part RTP and examination question, not asked for many attempts, hence I feel this can be tested. The following table shows interest rate for the US dollar and French franc. Okay, the spot exchange rate is 7.05 French franc per dollar. Complete the missing numbers. All the percentage rates are annualized. All the percentage rates given in this question. Okay, here, everything is annualized, they are saying. Okay, now, see what they have given and what we have to find out. Now, I'll just explain and then solve. Following, see, question solving will take hardly 2 minutes. Understanding the question is important. See, the following table shows interest rate for US dollar and French franc. What is the spot exchange rate? 7.05 French franc per dollar. You tell me, children. Question gives you about, tells you anything about domicile. In which country this is quoted? Nothing given. Are you understanding? So what I told you, if nothing is given, you will assume the quote to be direct quote. You will assume the quote to be direct quote. Up direct quote, now if 7.5 French 7.05 FFR per dollar, US dollar is given. Okay, per US dollar is given. So the country, what is the country? In which country this will become the direct quote? France. Are you all understanding? So the country is France. That is the understanding. Are you all understanding? In France only, the dollar is, okay, foreign currency. A quote for a foreign currency in so many units of home currency, it's a direct quote. Are you all having the clarity? Now we will see the question. So the quotation is given in France. We are going to discuss. See, dollar interest rate is there. Sir, why we discuss all this now? Don't think. 1 plus interest rate of home currency is there. Foreign currency is there in the formula. Na? That is why I explained it. Which is home currency, which is foreign currency, you will get confused. That's right. Okay, dollar interest rate 11.5%. 6 months ago 12.25%. What is the dollar interest rate for 12 months is the ask. So here, dollar interest rate for 12 months you need to find. Franc interest rate for 6 months you need to find. Forward franc per dollar you need to find out for 3 months as well as for 6 months. Forward dollar or premium for 3 months as well as for 12 months. How to start? Are you all having the clarity? You have all the data given. From where to start? Okay. From 3 months I need to start. 6 months, 12 months. Okay. Here I have dollar interest rate, French franc interest rate, spot rate given, spot dollar is given. Okay. French franc per dollar. No, spot dollar means French franc per dollar. Otherwise, spot quotation for dollar is given. And dollar interest rate, franc interest rate is given. From 3 months, we can arrive at franc, what is that? Forward rate for dollar and forward rate for premium for the dollar. That is the starting point. Are you all having the clarity? This is a missing figures calculation. Where to start is very important. See, in the 3 months, you have dollar interest rate and, okay, franc interest rate and spot rate is given. From there, you will compute forward rate. Then forward, after computing the forward rate, you can easily find out the premium or discount, annualized premium or discounted percentage. Are you all understanding? Now, see here what happens. 3 month forward rate, I will compute first. $1, okay, $1 into 1.02875 forward rate. Now, very simple. Dollar interest rate is considered. What is dollar interest rate? Here only I want your attention. All the interest rate given are annualized. So, dollar interest rate 11.5% given na. Is the dollar interest rate. Upon US, what is the interest rate? 11.5% is the US interest rate, but the forward, this forward, what is that? The instrument is for 3 months. What is the maturity period? 3 months. What you should do? This is annualized interest rate. Equivalent interest rate divided by 4 I should do. 11.5 divided, what is that? 11.5 divided by 4. How much is that? 2.875. That is why. So 2.875 is the dollar interest rate. This is the dollar interest rate. And what is the interest rate in France? In France, what is the interest rate? See, given a 19.5% per annum. This is per annum. Convert it for 3 months. So 19.5 divided by 4. How much is that? 4.875. Agreed? This is the interest rate. Now, you have two interest rate. Very simple. You have $1. So $1 into this interest rate, 2.875. Okay, 1 plus this interest rate. How much is that? Next year, $1 into 1.02875. This is what I have given. $1 is equal to 0.2875. This is nothing but 2.875 is the interest you compound. Next year, you will increase. Here also, France interest rate, 7.05 into 1.04875. Are you all understanding? If you equate it, you will get forward prices this much. Don't think, sir, forward, you have explained formula, you have not, no issue. Formula you can apply. Forward rate is equal to spot rate. What is the spot rate? This can also be solved using formula. Spot into 1 plus interest of home currency. What is home currency? I told you, France. So France interest rate, what is the France interest rate? Tell me, children. France interest rate, this na, 4.875 na. What is the France interest rate? 4.875. Agreed? Yes, 4.875. Now 1 plus 0.04875 divided by 1.02875 dollar interest rate. Okay, 1 plus interest rate of foreign currency, dollar, other US. What is the interest rate? Okay, is equal to spot. What is the exchange rate? Spot exchange rate. Spot exchange rate is 7.05 into 1.04875 divided by 1.02875 will give you how much? Will give you 7.1871. Both are one and same. I'm just explaining. In the future, I'm not going to explain. Okay, the purchasing power I showed you na, 40,000, 40,000 divided by 1,000. Like this. Okay, 44,000. Consider the inflation of this interest rate of this country. Consider the interest rate of US. Then you will equate and find out. Are you all comfortable? Okay. Now, we will move on to the next adjustment. 3 month forward premium. Now you have forward rate and spot rate. Apply the formula. Forward rate minus spot rate divided by spot rate into 12 by n into 100. Already I discussed how to find out the premium. Okay, 7.187 minus 7.05 divided by spot price 7.05. Once we have the forward rate, easily you can find out annualized term 12 by 3. That is very important because, okay, you need to convert it, annualize it. How much you are getting? 7.78%. Next, 6 months forward rate. Go to 6 months forward rate. So first we have these two numbers we already solved. Okay, these two numbers we already solved. Next, move on to the 6 months rate. 6 months rate, you have spot rate, you have dollar interest rate. You want to find out, okay, first franc interest rate. You have dollar interest rate, you have spot rate. You need to find out franc interest rate. But interest rate, here question, you need to give them annualized interest rate. Annualized interest rate. Okay, how to compute annualized interest rate? Same formula, everything you will replace. Very simple. First, forward rate, how should compute? Forward premium is equal to forward rate minus spot rate divided by spot rate. Why? Because here premium is given na. Yes, here premium is given. You will find out first forward rate. Here forward dollar premium is given 6.72%. That you equate it to the formula. So 6.72 is equal to, okay, forward rate minus, you don't know the forward rate, keep it as X or FR. FR minus spot rate 7.05 divided by spot rate into 12 by n. If you solve this, you will get, okay, forward rate as 7.2869. Are you all comfortable? Okay, this is, you found out the forward rate. Now you have forward rate. Okay, premium, you leave it premium. You have forward rate, dollar interest rate. You need to find out franc interest rate, French franc interest rate. How to find out? See, very simple. Same method, apply the formula. Okay, $1 is equal to French franc 7.05. This is spot rate. Apply interest rate parity theorem. What you should do? $1, apply the dollar interest rate. What is the dollar interest rate? Okay, dollar interest rate given as how much? Divided by 3 you should do. 12.25, yeah? Yes, 12.25 is the dollar per annum. Per annum dollar interest rate. Here, maturity period is 6 months. Don't make the mistake of dividing it by 4. Dividing it by 3. What you should do? Divide it by 6, which means divided by 2. 12.25 divided by 2. 6.125, yeah? Yes, 6.125. That is what they are doing. Okay, dollar, you add 1 plus interest rate of dollar. What is that? 1.06125. Equate it to, okay, the French franc interest rate. French franc 7.5. Into 1 plus x into 100. Why? Because x into 100, you see, you don't know what is the interest rate. This you want to annualize, so this interest na x into 100. Are you all understanding? Okay, very simple. X into 100 na, this is the percentage. If I say 12%, what is that? 12 by 100 na. You want to find x number na, if it is 12 by 100 na, you will find out 12%. If you want to find out, it will be 12 by 100. Are you all understanding? Or 0.12. Now, for in x by 100 into 6 by 12, you want to convert, annualized interest. Here there will be annualized interest rate into 6 by 12. Okay, are you all comfortable? Now, by solving, we get x as 19.38. In this question, we want annualized. You can go and verify, you can solve. Okay, I don't want to get into solving all this. Easily you can solve. Simple algebra, 19.38. Can you do it as, okay, you can do it on your own now, 19.38. So 6 months annualized interest rate, apply the formula, you get. Also, you can use this formula also. Okay, forward rate is equal to, what is that? Spot into 1 plus interest rate of home currency divided by 1 plus interest rate of foreign currency. Agreed? Now here also, in the home currency, you know the interest of home currency, don't know. This is what you need to find out. Are you all understanding? Foreign currency interest rate you already know. What is that? 12.25. This 12.25, okay, you should divide it by 2, which means 6.125. That you need to remember. Okay, here also home currency there. If you solve it, okay, you will get the 6 months interest rate. Then you will multiply with 12, multiply with 2. Are you all understanding? Then you get the 12 months interest rate. So what I do here, instead of doing this, okay, I will, the home currency is there now. What I will do, I will divide it by 2. X by 2 I will solve. Are you all understanding? I will take x by 2 and try to solve this. You will get the same answer. Okay, you can verify, you will get the same answer. Next, 12-month forward premium, annualized forward premium. How to find out 12 months annualized forward premium? See here what I'm saying. You have frank interest rate, you have spot rate, okay, and you have forward rate. So spot rate and forward rate is there. Find out the premium. Very simple. Spot rate and forward rate is there. Find out the premium. So spot rate is given, forward rate is given. Okay. Yes, 12-month forward premium. Here first I have discussed the no issue. Forward rate is given, spot rate is given. Find out the premium. How much is the premium? 6.67. Are you all understanding? Next, spot rate is given, forward rate is given, and the dollar interest rate. Dollar interest rate na 12 months ago, premium is given. 1 second. Yes, dollar premium is given. Now we need to find out what is the dollar interest rate. Dollar interest rate. Are you all understanding? This is easily doable because it is 12 months. No complication at all. Okay, spot into 1 plus interest rate of home currency. Home currency is how much interest rate? 20%. 1 year na 0.2. Upper spot 7.05 into 1.2 divided by x. If you solve this, divided by 1 plus, okay, x percentage terms, you will easily get the dollar interest rate. Are you all comfortable? Okay, this is how to short. Can we move on to main area, covered interest arbitrage? Very, very important for this attempt. Okay, to make you understand properly the covered interest arbitrage, money market hedge only, I discussed these many concepts. Shall I discuss core area? See what happened. Covered interest arbitrage, I told you, interest rate, if you include in the exchange rate, the fair forward rate should be as per IRPT, interest rate parity theorem. I told you fair forward rate should be as per IRPT, and I already told you that the quoted price is something different from fair price. Quoted price need not be same as fair price. If quoted forward rate in the bank, you go to the dealer, you ask for a forward rate. If he is quoting for forward rate, if you see that forward rate is not as per as per fair forward, then there exists arbitrage opportunity. Then there is arbitrage opportunity. Are you all understanding? Which means the quoted forward, if quoted forward is not as per IRPT forward, is not as per interest rate parity theory forward, then there exists arbitrage opportunity. Riskless profit you can gain. How to gain and all I'll tell you. Are you all understanding? So there are two markets involved, currency market and money market. Okay, how if the quoted forward is not same as IRPT forward, then what you should do? Okay, you should use the money market and try to gain or try to make arbitrage profit. Try to create arbitrage profit. Are you all understanding? How we do this is, okay, I have few steps here. Okay, logic I'll explain later. First, you need to understand the steps. Very simple. I have two approaches. The approach to leave it. Only one we used to discuss in regular lecture. We don't need to do that. Approach one, very, very simple and straightforward. See, what I do is that, very simple. I need to decide, okay, where to borrow and where to invest. Very simple. If you borrow in US, you will invest in India. If you borrow in India, you will invest in US. Okay. What is the logic? Arbitrage exists now. So arbitrage exists in the money market. If, okay, the quoted forward is not same as IRPT forward, then you can either make gain in currency market or you can make gain in money market. Whichever is beneficial, you should gain. But whether you will gain in currency market or money market now, which means at one place you should borrow, another place you should invest. Correct? How to decide where to borrow and where to invest? This is the issue in covered interest arbitrage as well as money market hedge. Are you all understanding? Now, in case of covered interest arbitrage, first step is to calculate the forward premium or discount. First step is to calculate. I see, very simple. First, in these questions, spot rate will be given. Spot rate will be given. In the question, what are all the things will be given? I am telling you. Forward rate will be given in the question. Spot rate will be given, forward rate will be given. This is currency market. Both rates will be given. Money market, they will also give you India interest rate or home currency interest rate, foreign currency interest rate. Okay, foreign currency may change. A company, if it is domiciled in US, that will become the home currency. Are you understanding? That will become the home country interest rate. Now, interest rate of these two countries will be given. Interest rate of these two countries will be given. India, what is the interest rate? US, what is the interest rate? Currency market, spot currency exchange rate will be given. Forward exchange rate will be given. If these are all the data will be surely given in covered interest arbitrage. Are you all understanding? Now you have to understand. Money market is also involved. Currency market is also involved. By seeing the question itself, you should understand this is covered interest arbitrage. They may not give you covered interest arbitrage. Okay, their name may not give you, but you should see interest rate quotation given, currency quotation also given for spot and forward, which means they are testing, and they will ask you find out the arbitrage opportunity, which means they are testing the covered interest arbitrage concept. Shall I proceed? Okay, see how to calculate. Now, very simple. First, decision to be made of where to borrow, where to invest. If you know that is it, you can solve the question. So how to decide where to borrow or where to invest? Very simple. First, identify the local currency and foreign currency. First, identify local currency, foreign currency. The company, okay, XYZ Limited is domiciled in India. Okay, like this, if it is given, easily you can understand local currency is INR, foreign currency is US dollar. Agreed? So that you will find out. Now, the country itself is not given. How to find out? Assume the quote is to be direct quote and find out, okay, in which country it is given. Are you all understanding? You will assume that it is, just now we did not. France, we assumed that, we assumed it to be the home country, and hence the French franc per dollar we assume to be direct quote. Are you all understanding? That is why we assume to be home country. Like this, what you do, find out first local currency and foreign currency. First step. Agreed? Now what you should do? Find out the annual forward or premium discount on annual forward or premium discount of the foreign currency. That very simple. If you are in India, okay, US dollar quotation, INR per dollar given, which means identify whether you need to find out the forward premium or discount. Now, forward for what? Dollar only, because this is the foreign currency. For dollar, you find out the premium amount or discount amount. How I should find out? Just now I discussed forward rate minus spot rate divided by spot rate into 12 by n into 100. Annualized forward premium or discount. This is why I discussed the basics. Are you all understanding why I discuss all these basics? Now see, first to find out annualized premium or discount. This you are getting. Now this I will adjust or add. If it is annualized forward premium, I will add it to the foreign country interest rate. I will add it to the foreign country interest rate. Okay, very simple. Here, see here, I have given here adjusted foreign interest. Okay, it's nothing but foreign interest rate given. See, foreign interest rate. Okay, home interest rate. Two interest rates will be given in the question. Okay, now using country not given. Using the exchange rate, you can assume which country you are dealing with. Agreed? Now the point is, you have foreign interest rate, assume 10%. Okay, 5%. Assume foreign interest rate to be 5%. Indian interest rate, assume India is the home currency, interest rate to be 10%. What you should do? Now, foreign interest rate is lower. This country's currency will be quoted at premium. That premium, assume annualized premium is 3%. The annualized premium is 3%. You add it to this 3%. This you add it to the foreign country interest rate. So adjusted foreign interest rate means foreign interest rate I have 5% plus premium of the foreign interest rate I will add. Now, if it is discount, if foreign currency is traded in the discount in the exchange market, forward market, what I will do? I will reduce the discount. I will minus the 3%. Are you all comfortable? Which means if it is premium, I will add it to the foreign currency interest rate. If it is discount, I will reduce from the foreign currency interest rate. Net effect is nothing but you are finding foreign interest, adjusted foreign interest rate. Adjusted foreign interest rate. To put it simply, two interest rate given, it is not comparable as such, because it will be only comparable when you adjust for the currency exchange fluctuation, the currency difference, exchange difference. You should adjust in the money market, interest rate market, then only it will be comparable interest rate. Are you all understanding? Now you will compare. Now we will move on to the first step. See here what happens. Okay. Now you have already computed annualized forward. Now what do you do? Adjusted for interest. What is adjusted for interest? Normal foreign interest plus or minus premium or discount on foreign exchange market. Are you all understanding? That you will add. If it is premium, you will add. If it is discount, you will reduce. Is more than local interest rate. Now there is a comparability. Now you compare the foreign interest rate with the local interest rate, which means that 5% was the foreign interest rate in our example, plus 3% is the premium. Assume that 5 plus 3 premium 8%. You compare it to Indian interest rate of 10%. Now what you should do? Normal principle you will apply. Tell me children, normally you go to the bank. You go to one bank is quoting 8% interest. Another bank is quoting 10% interest. What would you like to do? Okay, where interest rate is lower, you will borrow. You will borrow in the bank where interest rate is lower, and you will deposit in the bank where interest rate is higher. Same principle here also applies. When adjusted foreign interest, it is effectively interest rate. Now, interest rate, how will you decide? Lower interest rate, I will borrow. Higher interest rate, I will like to deposit, invest. Are you understanding? So, adjusted foreign interest rate, okay, is more than local interest rate. Is more than local interest rate. Tell me, where will you borrow? If adjusted for interest rate 10%, local interest rate is only 8%. Now you will like to borrow locally. Borrow locally. Okay, invest abroad. Borrow. What is the strategy? Borrow locally, invest abroad. This is the strategy. Next, if adjusted interest rate is less than local interest rate, okay, local interest rate is higher rate, I will not borrow locally. I will go to abroad and borrow at lower rate. Borrow abroad and invest here. Invest locally. Are you all understanding now? Sir, what I need to do? I borrowed, I invested, but I borrow in one country, I borrow in another country. Okay, now I need to convert. I need to convert in between. Are you all understanding? Now listen to me, friends. Very, very easy. Okay, there are 3 or 4 transactions. See, there are 3 transactions which will happen today, and there are 3 more transactions which will happen on maturity. 4 more transactions which will happen on maturity. You will find out the what is that? Riskless arbitrage. Are you all comfortable? Very simple. What you do? Spot. All the above discussion is to decide where to borrow. Once you borrow, assume you borrow from US. Once you borrow from US dollar, you borrow from America. You borrow. What you should do next? You borrow. What is the strategy? Borrow in US or abroad. Invest locally. Invest locally. But can I borrow in US dollar and put it in SBI bank in India? No, you need to convert. So what I do? Spot. Today what I do? I borrow from US, convert it and invest. Indian bank. Are you all understanding? I go to sleep for 6 months period or whatever is the maturity period of the forward market. Are you all listening? So what I should do? 3 things. I borrow. I decide where to borrow from the following step. Thereafter, I borrow from one country, convert it using exchange rate, spot rate. This conversion will happen using spot rate. That also. Now, here also, question will give you borrowing rate, deposit rate, spot rate, spot bid rate, spot offer rate. Are you all understanding? Forward bid rate, forward offer rate, everything they may give you. Are you all understanding what I'm trying to say? Two-way quotes also given, interest rate also, borrowing rate, deposit rate, 2 different rates are given. What you should do, I'm explaining. Very simple. You borrow. Okay, prevailing borrowing interest rate in US, you will borrow. Then you will convert. When you convert, if you borrow in US dollar, when you convert, okay, you will sell dollar and convert. You will buy dollar, I will sell dollar. Are you all understanding? You borrow dollar, you need to convert it into INR and then deposit in the bank. When you convert into INR, what you need to do with the dealer? You need to sell dollar and convert it to INR. Sell dollar, bid rate, bankers buying rate, which is or customers selling rate. At what rate you will sell? Bid rate you will sell. Provided the quote is direct quote. Anyway, quote is direct quote now, you will assume. Okay, so bid rate you will sell at bid rate. Then you will invest in the Indian bank at the deposit rate prevailing in the Indian bank. This is what you do with the spot rate. 3 transactions. Borrow, convert, deposit. That's it. Maturity date, go to sleep. After 6 months, come back. What you should do? Realize the maturity value. You have deposited some amount, realize it. In Indian bank, you would have deposited some amount, realize it, then reconvert it into dollar. Why? Because see, I use this, but initially I started borrowing. Okay, I took from the US now. So I need to repay the borrowing now. From where I will repay the borrowing? From this maturity, I will convert it and repay the borrowing balance. I will get the profit. Are you all comfortable? Which means maturity date, I will realize the deposit amount with interest. Reconvert this using forward rate. Again, if you want to reconvert, okay, the deposit will mature as INR. If you want to reconvert, what will you do? You will sell dollar, you want to buy dollar, I want to buy dollar to repay. Agreed? If you want to buy dollar, what you should do? Bid rate, offer rate? Offer rate. Are you all understanding? So forward offer rate I will consider to reconvert the rupee into dollar. Okay, then repay borrowing, book profit. After reconverting the deposit, I will repay the borrowing. Balance is the arbitrage profit. Are you all comfortable? Shall we see this question? Okay, we will apply all these in one question, one single question. Okay, you will have absolute clarity. 2 questions are there even though. Anyway, we'll see. Given the following information, exchange rate given, Canadian dollar 0.66 per Deutschmark. Deutschmark is the Germany's currency, old currency. Okay, now everyone uses euro mostly. Canadian dollar per Deutschmark. And Canadian dollar, what is this? This is 3 months forward rate. This is forward rate. This is spot rate. But only bid, one rate is given. One-way quote is not bid and offer rate. This is one-way quote. Are you all understanding? This is one-way quote is only given. Next question, I will discuss the two-way quotes also. Okay. This is one-way quote. Now tell me children. Country given. Domicile given. Not given. Are you all seeing? So, what you should assume? I will assume it to be direct quote. I have told you now. Where they have not given the country. Okay, where the exchange rate is quoted or the company which is into exporting or importing, no details given, no clue is given. What you should assume? You will assume that it is direct quote. Direct quote. Now you tell me which country it is. See, 0.66 Canadian dollar per Deutschmark. Now Deutschmark will be the foreign currency, which means this country is what? Canada. Home country is Canada. Are you all having the clarity? This is home country. And foreign country is what? The Germany. Okay, Germany is the foreign country. Are you all understanding now? Now, see the thing. Now you see, apply the rule. Very simple. What you should do first? Quoted on premium. Quoted at premium. Yes, quoted at premium. 0.667. Find out the first step in what is the find out the premium for Deutschmark. Deutschmark is traded at premium Apo premium, okay, against Canadian dollar. Deutschmark is at premium against the Canadian dollar. Okay, Canadian dollar premium, the Canadian dollar is equal to okay, this should be alignment issue. Premium is equal to 0.671 minus points forward rate minus spot rate divided by spot rate into 12 by 3. 3% is the premium. Next step in this is forward premium or discount. Next step in adjusted foreign currency. Find out adjusted foreign country interest rate. What is adjusted foreign country interest rate? Normal foreign country interest rate. What is my country here? Canada. If I am living in Canada, what is the foreign country? German interest rate? What is the German interest rate? Deutschmark interest rate 8%. Canadian dollar interest rate given in the question as 10%. Correct? So, see, I have not read fully the question. No issue. You can see what operations would you carried out by the arbitrator to earn the possible arbitrage gain if he is willing to borrow Canadian 1 lakh or Deutschmark. They have given. Why they have given like this now? They have given you to confuse. They are given to confuse you so that you don't know where to borrow. You need to decide first where to borrow. If you borrow in Canada, you will borrow 1,000 Canadian dollar. If you borrow in Deutschmark, you will borrow 1,501 Deutschmark. Why? Because spot rate is given as 0.666. 1.501 into 0.666. If you do, you will get 1,000 Canadian dollar. 1,501 into 0.666. If you do, you will get 1,000 Canadian dollar. Okay, just a conversion of the spot rate. You can either, so they have not given any clue. You may either borrow in Canada, you may either borrow in Deutschmark. They want you to find out where to borrow. That is an important decision. Are you understanding? Now, adjusted foreign interest rate. How to find out? Normal foreign interest rate, Deutschmark interest rate 8% plus what you should do? Okay, the premium or discount. Here premium, Deutschmark is trading at premium plus 3%. How much is that? 11%. Now, adjusted foreign interest rate 11%. Local interest rate 10%. Where will you borrow? Borrow locally, borrow abroad. Borrow locally. Where interest rate is lower, you will borrow Canadian dollar. You will borrow Canadian borrow in Canada, invest in Deutschmark or Germany. That is what is the C. Therefore, adjusted foreign interest rate 8%, 3%, 11%. Hence, adjusted foreign interest rate more than local interest rate. Strategy: borrow locally, invest abroad. Okay, are you understanding? Now see the procedure. Borrow Canadian dollar 1,000. If you borrow locally in a Canadian dollar 1,000, you will borrow 10% interest rate. Why? Canada interest rate 10%. So you will borrow for 3 months. Next, convert. Next, first step, borrow, convert. Change this sum into Deutschmark. Convert using spot or forward. When are you converting? Today you are converting means use spot rate. Tomorrow you are converting means forward rate. Today I am converting now to deposit. So what I will do? Spot rate. What is that? 0.666, 1,000 divided by 0.66 because you are converting into Deutschmark. Okay, Deutschmark 1,000, 501.5. Okay, this you are getting a 1,501.5. This 1,501, where you should deposit? In Germany you will deposit. In Germany you will deposit. What is the interest rate? 8%. This happened today, va? This happened today. Okay, now tomorrow. They have not given stepwise anyway, but you can understand now what happens on the date of maturity. On maturity, the following transactions will happen. Principal amount you deposited how much? 1,501.5 plus interest at 8% for 3 months, 30.03 Deutschmark interest rate. Total Deutschmark, okay, what I will receive? Invested abroad, I invested in Germany, I'm going to receive Deutschmark inflow of 1,531.53. But this is in Deutschmark. I need to convert it in Indian rupee to pay the local borrowing. Correct? To pay the local borrowing, I need to reconvert. How much is that? Forward rate 1531.53 into forward rate I will reconvert. How much I am getting? 1027.666. Are you all comfortable? Next, refund the debt taken in Canadian dollar with the interest due on it, which means earlier I took 1,000 Canadian dollar locally borrowed. Now, how much I borrowed? 1,000. Repay the borrowing along with the local interest rate. If a local interest rate is 10%, but only for 3 months I borrowed. 10 into 1 by 4. How much is that? 25. Okay, 2.5%. 1,000 into 1.025 or 2.5%, you will get 1,025, which means after reconversion, I am getting 1,027.66 from Germany. Okay, the deposit. I reconvert and got 1,027. Here borrowed locally 1,000 and the maturity of the borrowing is 1,025, which means I even repay the borrowing balance 2. What is that? 25 and 20, so 2.66. Okay, this is the profit. This is the profit. 2.66 Canadian dollar is the profit. Okay, okay, I should have mentioned the conclusion. Anyway, it's missing. I don't know why. But anyway, the 2.66 is the arbitrage profit. Therefore, arbitrage profit is equal to 2.66 Canadian dollar. Always the profit, arbitrage profit, etc. You should always write it in the local terms, which means in the country in which you are living, there only you need to show the profit. Okay, dollar profit comes, right? Again, you are exposed to interest, the exchange risk, na? So that is no use. Okay, now shall we move on to the next question number 51? Two-way quote, simple only. See, already we discussed this. See, anyway, now in this question, again, this is given Bombay. See, quoted at Bombay. Quoted at Bombay. Luckily, we don't have the issue. The home country is India. Home country is India. Foreign country is British, Britain, Great Britain. Okay, now see solution. Let's see the how to find out arbitrage. Here, one important observation. When they give you two-way quotes, when they give you bid rate and offer rate, okay, two-way quotes is given, which means here swap points is given. That also if 52 point ascending swap, so 52.80 by 7 plus 7, 1.4, so 53.40. This is given now. This is forward rate given. This is spot rate. This is forward rate. Okay. Now, interest rate given in India, London given. No issue. Now, when two-way quotes are given, are you all understanding? Spot bid, spot offer, forward bid, forward offer. Two-way quotes are given now. What you should do? You will not readily find out which country you should borrow, which country you can deposit. You cannot find out. There is no hard rule that you can find. You cannot use the previous rule here. Are you all understanding? Which means all the possible scenario you need to do various permutation combination, then find out in which option there is arbitrage. Why? Because when there is bid and offer rate, the dealer will also come into picture. He will also have the spread. Because of the spread, okay, the rates may be altered. Are you all comfortable? The rates may not match. Hence, you cannot do it using the formula. You should try manually. That is the only option. Okay, solution I have given. Verification. That's why, what is the question giving now? Verify whether there is any scope for covered interest arbitrage. If you borrow rupees, they have told you where to borrow. Don't worry, they have given you where to borrow. And they told you find out whether there is any scope for arbitrage. That's all. So you don't need to worry. Go borrow locally in their saying. They have given you the hint. Borrow locally and try to find out whether there is an arbitrage opportunity. So I will borrow. How much is that? 10 lakh rupees. Not given. Okay, amount not given. I'll simply borrow. In this question, amount given. Not given. Any amount you can assume. In covered interest arbitrage, okay, you may come across the issue. Amount will not be given. You can take either 1,000, 10,000, no issue. Anything is possible. Okay, so we have 10 lakhs I borrowed. In this question, I assume to be 10 lakhs. So 10 lakh I borrowed. Then I converted 10 lakhs divided by 52.7. What is the conversion rate? Convert using spot rate or forward rate or spot rate. Because these three transactions are spot transaction. These three I'll do today. Borrow, convert and invest. Agreed? These four transactions, realize, reconvert, repay borrowing and profit or loss. Okay, this I will do, okay, on a given future date, on the maturity date, on maturity. Are you all comfortable? See, tell me. Borrow how much? 10 lakhs. Convert it using spot. What is the spot given? Spot bid rate given. Spot offer rate given. Here only I want your attention. Very simple. You have borrowed locally. You want to convert into what? Pound. If you want to convert into pound, now you want to buy pound. You have rupee in hand, you have borrowed locally, you want to buy pound, you want to sell pound, you want to buy pound and invest in Britain. Which means if you want to buy pound, bid for spot bid rate, spot offer rate, 52.7 should be considered. 52.7. Okay, we'll give you equivalent pound 19,212. Agreed? Next, invest. This pound you invest. What rate you should invest? Invest prevailing rate in the London market, which is 5%. Interest rate prevailing in London, you will interest. What is that? 5% interest rate. So 3 months you will borrow. Okay, for 3 months you will deposit. Go to sleep. Okay, don't bother. After 6 months or after 3 months, what is the maturity period here? 3 months. After 3 months, what you should do? Realize the amount you have invested in the realized. What you should do? Okay, you will realize for 3 months. The 5% is for 1 year. What is for 3 months? 5 into 3 divided by 12. Okay, 1.25. So that is maturity value 1.0125. Are you all understanding? Or 101.25% if you do, you will get 19,212, which means 18,975 will mature to 19,212. Reconvert it again, 58.2. Okay, you will get 10 lakh 14,394. Okay, why reconvert using this? 52.8 is forward rate. Forward bid offer. When you are reconverting, what you want to do? You will get the pound. You have the pound in hand. You need to sell the pound and rupee. You need to realize rupee. Okay, selling pound forward bid rate. Forward bid rate I will use to reconvert. What is the forward bid rate? 52.8. That is what we computed now. 52.8. Don't think where they can swap points given. We have computed. Okay, next. Repay borrowing. 10 lakh rupees is there into 1.02. Why this 20%? 2%, which is 8% per annum. In India, borrowing rate was 8%. You borrowed for 8%. Borrowed at 8%. 2% is 3 months interest is 2%. 1.02. Repay the borrowing 10 lakh 20,000. Sir, I got the deposit amount at 10 lakh 14,000, but I have to repay 10 lakh 20,000. I am incurring a loss. Hence, there is no arbitrage opportunity. Like this, okay, you need to verify, show the calculation, and then tell that there is no opportunity. When there is two-way quotes, there is no way that no hard rule, you cannot apply that rule we applied now, adjusted foreign interest rate more than local interest rate. Borrow locally, invest abroad. This rule we cannot apply when you have the two-way quotes, because dealer's margin will affect entire calculation. So you have to recompute. We have to calculate manually and find out. Hence, there is no arbitrage opportunity. With this, we are through with a very, very important discussion. Covered interest, arbitrage. Shall we move on to money market? Okay, within 10 minutes, we can complete the money market hedge. See, you forget about steps. I have given the steps and all. Just like covered interest arbitrage, I have given the steps and all. But try to understand this logically. I'll try to make you understand logically. See here. See. Money market hedge is there. Okay, briefly I will explain what happens. See, you are an exporter or importer. Assume you are an exporter in this case. I'll tell for exporter, you can easily think for, we are doing one question for importer. So exporter, I'll explain here. Importer, we can do one question. See, very simple. If you are an exporter, you will have foreign currency receivable. This you agree? First of all, by now you have to, you would have been comfortable now with the exporter, importer, receivable, payable, all this comfortable? Now, foreign currency receivable you have, correct? This receivable, as an exporter, I will have foreign currency receivable, means this is foreign currency asset, foreign currency liability. Foreign currency asset or liability, asset, simple. See, T-shaped balance sheet. Okay, this is asset and this is liability. This foreign currency receivable, here I have foreign currency receivable, or you're understanding dollar receivable, I am exporter. Agreed? What do you mean by money market hedge? You use the interest rate market. Money market is nothing but interest rate market. Okay, just like in covered interest arbitrage, both are strategy. Okay, that is arbitrage. This is hedging. Are you all understanding? In the hedging process, what you should do, you use the money market to hedge your foreign currency exposure. That is what is happening. Which means you have exported, you have foreign currency receivable. Now you exported goods worth $1 lakh. Okay, today's spot rate is 80 rupees. Today's spot rate is 80 rupees. The equivalent amount is 80 lakh rupees will be receivable amount. But you have exported, the receivable amount is payable after maturing after 3 months. Assume you are going to receive this $1 lakh not today, after a period of 3 months, but you tell me the exchange rate will be same. It may fluctuate. Hence, I am exposed to foreign currency risk. This you agree? Money market hedge is one of the tool to one of the tool to hedge the foreign currency exposure. Now I made a transaction, exported goods, and I realizable amount is $1 lakh. But not in terms of rupee. I don't know what will be my rupee realization. What will be my rupee realization? Hence, I use the money market to hedge the position. Very simple. I'll tell you what happened. Now you have the foreign currency risk, which means you don't know what will happen to currency market tomorrow. Tomorrow, dollar if becomes 70 rupees, you will only receive 70 lakhs. Are you all understanding? For your export, you will only receive 70 lakh rupees as the proceeds. Same way, if you are 90 rupees there is no problem. 90 lakh rupees I will receive. Okay. Sir, there is a possibility of receiving 90 lakhs. Why I go to hedge? Don't ask. Because hedging, okay, hedger doesn't see the potential benefit from he doesn't come to the market to enjoy the benefit from the transaction. He comes to, okay, eliminate the risk, eliminate the uncertainty. Hedger wants to protect his exposure. That is important. Now, to bring in a certainty, he will go to the market. Now, problem is, foreign currency receivable, 1 lakh I have in hand. This 80 I have. What do you do? Money market hedge. What is the strategy? If you have receivable 1 lakh foreign currency asset, create a corresponding foreign currency liability. Create a corresponding foreign currency liability. Foreign currency receivable asset, I understand, sir. What is this? How I can create liability? Simple. Borrow in US. Borrow in US. Okay, borrow in the foreign country, you will have foreign currency liability. Borrow in the foreign currency, you will simply have the foreign currency liability. Liability create the borrowing. Borrow abroad. That's what they are saying. Borrow abroad. Sir, how much I should borrow? I need to borrow, okay, such amount that after 3 months, this 1 lakh rupee exactly offset the foreign currency borrowing. Are you all understanding? This is offsetting each other. Are you all understanding? So, how much I will borrow? I will borrow such amount today that the maturity of this amount will become 1 lakh after a period of 3 months. Are you all comfortable? Which means after 3 months, this 1 lakh receivable I have in dollar, I will tell to the exporter, hey exporter, you don't need to pay me $1 lakh. I don't need to convert at all. I have currently borrowing. I have borrowed from a US bank. I have borrowed dollar. That maturity value of that borrowing is 1 lakh. Just to repay that amount. Just repay the amount for me. Are you all understanding? I don't need to again reconvert this amount. Are you all comfortable? So $1 lakh receivable exposure, I will ask the other party to just repay and close the borrowing. So what I do today? Today I will do the borrowing. I will borrow in which country? If I am an exporter having foreign currency receivable, I will create foreign currency liability. Create foreign currency liability means what? Borrow foreign currency. Borrow in foreign currency. I will borrow in dollar. How much I need to borrow? Present value of the exposure amount. Very simple. Here foreign currency asset is $1 lakh. Here present value is suppose 98,000. Okay, present value borrowing rate you need to discount 1 lakh rupees. If you discount using the US interest rate, you will get the present value of this $1 lakh. Up a dollar 98,000 I have this 98,000 after 3 months will become $1 lakh. This $1 lakh I need to offset. I will cancel out my receivable and the borrowing amount. Are you all understanding? So what is the strategy? I borrow present value of XC. Very simple. I have given the step. First step, identify. See here. Here, I'll go back to the question now. Okay, see, I have given the question steps. Now see, very simple. Where to borrow, you need to find out. That's all in money market hedge. Okay, now other steps will remain mostly same. Okay. See, identify the foreign currency exposure. You know that receivable or payable. Okay, if it is receivable, payable, now what is the currency? You find out the foreign currency exposure. Then calculate the present value of exposure using foreign currency lending rate as discounting rate. See, I told you bid rate, offer rate, two-way quote I'm explaining, so that comprehensive one question if we discuss that is sufficient. Okay, so I'm discussing this. So there will be two-way quotes. Just like money market lending rate, deposit rate will be given. Indian lending rate, Indian deposit rate. US lending rate, US deposit rate. The borrowing rate, deposit rate. Okay, next you have bid rate, spot bid rate, spot offer rate, forward bid rate, forward offer rate. Right? This, okay, quotation will be given. In this case, what you should do, very simple. You should, if you have receivable exposure, what you should do? Okay. See, this is payable. Two-way quotes. Okay, MMH receivable. What I was discussing, receivable exposure. Okay, if the receivable exposure, identify the foreign currency exposure. That is common for all. Next step, calculate the present value of exposure using foreign currency lending rate, because you will borrow abroad. If you have receivable, what is the strategy? Create foreign, this is foreign currency asset, create foreign currency liability. Foreign currency liability na borrow. Borrow abroad. Borrow abroad. Now, what you should do? Borrow. Okay, you should discount and borrow present value of the exposure amount. $1 lakh is the exposure amount. Find out present value of this exposure amount. And the lending rate is discounting rate. Lending rate you will take as discounting rate. Why? Because you have borrowed now, so lending rate you will take as discount. Now, borrow the present value of exposure at foreign currency lending rate for the exposure period against the receivable. How? Okay, for what time period I will borrow? I will borrow for 3 months. If my forward contract is for 3 months, which means I have exposure receivable amount after 3 months. Now I will borrow for 3 months. Agreed? For 6 months. Now 6 months I will borrow. Maturity period I will borrow. Now convert the amount you borrowed. What is to be done? Very simple. Borrow, convert, deposit. That's what you should do. That's the only thing. Are you all understanding? So earlier covered interest arbitrage, 3 steps we had: borrow, convert, deposit. That's what the same step will apply. Convert this borrowed amount, present value of this borrowed amount, you will convert, and then what you should do? Into local currency using spot bid rate. Now you will convert. You will use spot rate, no doubt. Spot bid or spot offer, just like covered interest arbitrage, spot bid rate. Why? You borrowed US, you want to sell now and convert into INR. If you want to sell dollar, what rate you should use? Bid rate. That is what I'm telling you. Bid rate you should use. Next, deposit the amount converted at local currency deposit rate for exposure period, which means deposit the amount converted at local currency deposit rate. What do you do? See, you have converted the amount, deposit the local bank. What is the rate? Deposit rate or lending rate? Deposit rate. Deposit rate you will deposit. Now, on the date of maturity, 2 things will happen. On the date of maturity, 2 things will happen. Not 4 things like covered interest arbitrage. Only 2 things. Jujupi. Okay, only 2 things. What will happen now? See, deposit amount you will realize. Deposit amount you will realize. That you will realize anyway. Another thing is, your realizable value is there now. The receivable amount. You will realize the receivable amount will be there after 3 months. Say after 3 months, the exporter will come to pay you the dollar. That will be there. Are you understanding? So what you should do? Adjust the dollar amount, receivable amount with the maturity value of the borrowing. You would have borrowed this amount. You earlier covered interest arbitrage. I take the invested amount, the deposit amount matured. Taking the maturity value, I repaid the borrowing. Here what you should do? Use the receivable amount, repay the borrowing. You don't need to convert again at all. Are you comfortable? Realize the deposit amount. Whatever amount you realize in the local bank, that will be the amount, fixed amount. Are you all understanding? So hence I remove the uncertainty. We will do one question, everything you will have absolute clarity. Shall I do this question? Question number 52. Take question number 52, you will understand. The finance director of P Limited has been studying exchange rates and interest rates relevant to India and USA. P Limited has purchased goods from the US at a cost of 51 lakhs payable in dollars in 3 months' time. This is payable related question. That you should remember. Okay, this is not receivable. Payable related question. Okay, in order to maintain profit margins, the finance director wishes to adopt, if possible, a risk-free strategy. How this is risk-free, how this will become certain, everything I'll explain. Okay, that will ensure that the cost of the goods to P Limited is no more than 22 crores. What they say, you hedge in such a manner that my total outflow comes to 22 crores. It should not be more than 22 crores. It should not be more than 22 crores. This is what they are asking. Okay, exchange rates, rupee per dollar, spot rate 40, 42. $1 is equal to 40 or 42. 3 months rate 42, 45. Okay. Interest rate available. Indian deposit rate given, borrowing rate given. US deposit rate, borrowing rate. 4 different rates are given. Are you all comfortable? Okay, now next. 13%, 16, 8%, and 11%. Calculate whether it is possible for P Limited to achieve a cost directly associated with the transaction of no more than 22 crores. Which means hedge in such a way that your total amount, exposure amount, will never be more than 22 crores. By means of forward market hedge or money market hedge. Here I have removed the, forward market hedge I have, but I am not discussing forward as a simple calculation. Hence, money market hedge only I am discussing. Are you all comfortable? Because forward hedging is very simple. Yeah. Payable exposure. What is your payable exposure? What is the amount? 51 lakhs dollar, na? 51 lakh dollar into forward rate. See, after 3 months, you are payable. Payable means you will have dollar receivable, dollar payable. Which means you want to buy dollar. Buy dollar, na? Okay. You want to buy dollar means, tell me, forward bid, forward offer, forward offer. What is the forward offer? Forward rate, offer rate 45. So, what is that? 51 lakhs into 45. How much is the amount? 50 lakhs, 45. 2295 lakhs, which means 22.95 crores. Okay, if I use forward hedging, my outflow will be surely more than 22 crores. That is why no point in discussing forward hedging. They are mainly asking money market hedge only. Okay, to find out the exposure amount. Shall we solve the question? Listen to me, friends. Okay, P Limited purchase goods from outside importer and has foreign currency payable. Point number 1. Agreed. P Limited purchase goods from outside. He is an importer. Hence, foreign currency payable he will have. So, foreign currency payable, now it is foreign currency asset. I will have foreign currency liability. Today, I have foreign currency liability, foreign currency asset, foreign currency liability. If I have foreign currency liability today, what I need to create? Foreign currency asset. Asset, na? I deposit or invest in foreign currency. Are you all understanding? I need to create an asset. Now, I will invest in foreign currency, which means borrow locally, invest abroad. I will borrow locally, invest abroad. That's the strategy. So, borrow locally, invest abroad is the strategy. Now, see, what will happen? I'll tell you. That one thing you need to understand how borrowing. Initially, I will, how much I need to borrow? First of all, tell me how much I need to borrow. Earlier, in case of receivable, present value of the exposure amount you took, correct? Here, there is a catch. See here, borrow locally and convert, you need to convert it to dollar. But this dollar, how I will understand how much I require? Na? Very simple. First, what is the exposure amount? You tell me. Okay, 50 lakhs is the exposure amount. 50 lakhs is the exposure amount. For this, you need to borrow. But in the earlier receivable question, dollar, if you had foreign currency asset, borrowing will be easier. Then you will have $1 lakh receivable. Now, $1 lakh, present value of this 1 lakh directly you can borrow abroad. Agreed. Here the problem is, $50 lakh is the payable amount. But you want to borrow abroad or locally, you want to borrow. You want to borrow equivalent amount of rupee first. Then you need to convert into dollar. Then I need to make the present value of dollar deposit. Are you all understanding? So first exposure amount is 50 lakhs. Find the present value of this 50 lakhs. Find the present value of this. Very simple. Yeah. See how much I need to deposit. How much I need to deposit locally. How much I need to here in this question. I need to deposit locally. Yeah, I need to deposit abroad. Where I need to borrow. Where I need to borrow. Very simple. Here 50 lakh payable amount I need to pay, I am having liability. Yeah. Then asset I need to invest abroad. I need to borrow locally. Now, borrow locally means how much I need to borrow. Very simple. Convert and deposit. 21 crores to make it as 50 lakhs. 21 crores to make it as 50 lakhs. Which means deposit amount should be maturing to 50 lakhs. Deposit amount should be, see, foreign currency liability. How much you have foreign currency payable? 51 lakhs dollar. 51 lakhs. 51 lakhs dollar. 51 lakhs. This is liability. You have payable amount of 51 lakhs. Agreed? Asset I need to deposit. I need to deposit such amount that the maturity value of the deposit becomes 51 lakhs dollar after 3 months. After 3 months, if the maturity value should become 51 lakhs, what is the current value? How much I need to deposit today? First of all, you need to think. How much I need to deposit? See, US deposit rate is how much? 8%. US deposit rate is how much? 8%. Which means if I deposit in US, I'll get 8%. How much I need to deposit to make it 51 lakhs? Very simple. Discount it using 8%. 51 lakhs. 8% for 3 months or 6 months. What is this? Here. 3 months time. Can you see the maturity period? 3 months time. Same 3 months time. So, very simple. What is the rate? 8% or 2%? 2% per 3 months. 8% is the annualized interest rate. So if I deposit 2%, 51 lakhs Okay, 51 lakhs divided by 1.02. How much is that? 50 lakhs. 50 lakhs. Present value of 51 lakhs at 2, sorry, present value of 51 lakhs at 2% discount rate. Okay, 51 lakhs divided by 1.02. If you do, you will get 50 lakh dollar, 50 lakhs dollar, which means if you deposit 50 lakh dollar today, it will mature to 51 lakh dollar or after 3 months. This maturity value you can use to repay your payable amount. Okay, from the import you can repay the payable amount for the import. Okay, are you understanding? Now 50 lakhs dollar, if I want to deposit today, how much I need to borrow? You need to convert. I need to convert. I need equivalent rupee, and see, I need to borrow locally. I need to convert rupee into dollar. I need to deposit 50 lakhs dollar. How much I need to borrow locally? Very simple. Bid rate or offer rate, which rate you will use for conversion is very important. Okay? 50 lakh rupees is there. Okay, you will sell dollar, you will buy dollar in the local market, currency market. What you should do? You should borrow, you should buy dollar. Are you understanding? You will sell your rupee, buy dollar. Okay, deposit the dollar in foreign country and then realize the maturity value of the dollar. Are you comfortable? So what is the rate? You will sell dollar, buy dollar again. You will buy dollar, now offer rate. What is the offer rate in this question? Spot or forward spot rate, because this transaction happens today. What is the spot offer rate? Spot offer rate is 42. Spot offer rate is 42, which means, see here, what you should do, how much above 50 lakh dollar, I need to convert into 42. 50 lakh dollar into 42. How much is that? 21 crores. That is how I got 21 crore. Are you all understanding? So 21 crore rupees I will borrow, convert using 42 rupees spot offer rate, get 50 lakh dollar, deposit 50 lakh dollar in the US bank. Then you will realize 51 lakh on the date of maturity, repay using that 51 lakh deposit amount. Are you all understanding? So what will be effectively your payable amount? Your local maturity value, you have to pay your local bank now. That will become your payable amount. Very simple. Repay local borrowing. You have borrowed at what rate? 16% is the given. Borrow Indian borrowing lending rate is 16% per annum. For 3 months it is 4%, which means, okay, you have borrowed how much? 21 crore, which you have to repay after 3 months into 4%, 1.04. How much is that? 21 crore, 84, 21 crore, 84 lakhs will be your payable amount. The maturity value which you pay to the local bank you borrowed, that will be your ultimate maturity value. Are you all having the clarity? Okay, this is their use of the foreign currency investment maturity of 51 lakhs and pay of the payables. Now, sir, you told me this, okay, this will be a hedging tool and uncertainty will be removed. How uncertainty will be removed? Very simple. What happens? You normally see. You tell me, children. You need to borrow 50 lakh rupees. You need to invest 50 lakh dollar now. Okay. You invested 50 lakh dollar. This you are doing today or tomorrow? Today. Okay. This 50 lakh dollar you are depositing for how much? What is the interest rate? 2%. Or deposit interest rate. Dollar deposit interest rate. Is it certain or uncertain? Certain. So 50 lakh I convert it today itself at 42. This 21 crore I need to borrow is certain or uncertain? Certain. The interest rate which I lock in 4%, other 16% per annum, which I pay to the which I pay to the local bank is certain, uncertain, certain. So everything is certain. Okay, uncertainty is removed. Today itself I know what will be the maturity value of this 50 lakhs dollar. So 50 lakh dollar, I have the payable amount. I don't know what I will pay if I leave the exposure open, but if I use the money market hedge, I will know for sure that 21 crore 84 lakhs will be my exposure amount. That payable, ultimate net payable amount, outflow. Are you all understanding? Hence, outflow as per money market hedge is 21.84. And the question asks us this hedge will give me 22 crores, below 22 crores. I want to target that. I should only have my outflow below 22 crores. Is this tallying? Yes, this is proper. So money market hedge is viable. You can go for money market hedge as a solution for the question. Are you all understanding? Okay, with this we are through with the money market. Both these concepts can be tested. Very, very important. Hence I have discussed. Next, a small question: supplier credit versus bank only. Shall we? Gibraltar Limited has imported 5,000 bottles of shampoo at landed cost in Mumbai of $20 each. The company has the choice of paying the goods immediately or in 3 months' time. It has a clean overdraft limit where 14% rate of interest is charged. Calculate which of the following method would be cheaper to Gibraltar Limited. Okay. Pay in 3 months' time with interest at 10% and cover risk forward for 3 months. Okay, settle now at a current spot rate and pay interest of the for the overdraft for 3 months. The rate are as follows: Mumbai rupees per dollar given. Okay, direct quote in India given. 3 months swap points are given. Descending swap point. So discount swap. Okay. Now what they're asking really in this question. Okay, this is a leading or lagging question, which means which type of payment you will choose. Okay. Now this is what they say. See, now okay, there is a strategy just like your forward, money market hedge, currency option, currency futures. Like that, there are 8 different strategies in which we are learning in Forex chapter. One of the strategies leading and lagging. So for example, this company Gibraltar Limited imported 5,000 at 20, which means exposure amount 5,000. Okay, 5,000 into 20. How much is that? 1 lakh. Okay, so 1 lakh dollar. 1 lakh dollar is the exposure amount. Tell me, imported. Okay, 5,000 bottle, which means this is payable. Payable. How much is the amount payable? 1 lakh dollar is payable. Are you listening? So now, what they say? This company has two choices. Two option given. Option number 1, option number 2. What they say? First option. Okay, the company can pay immediately. Pay now. Pay now. Or pay after 3 months. Pay after 3 months. See what happens. If you pay now, you don't have money. If you pay now, you don't have money. What do? You can take loan from your local bank. Take loan from your local bank at 14% per annum. Okay, for that, option 1, pay now. Okay, in pay now, this is, yes, option 1, pay now. And option 2, pay after 3 months. Now, what happens here? See, when you say pay now, okay, in this case, option 1, for option 1, you have OD from local bank, LB na local bank, or I can say local bank. 14% per annum is the interest, OD interest. Overdraft you need to take, and for that you will have to pay 14% per annum. Now for 3 months, into 3 by 12 you will do interest, not an issue. And okay, you will pay now, you will pay now itself, agree? So if you pay now, this is the interest amount you need to pay. Are you all understanding? Settle the payable now itself. You don't have money now. Take the loan, settle. This is local loan and settle the payment. This is here. Settle now at current spot rate and pay interest in the overdraft for 3 months. Which means what will happen? Whatever is the spot rate, current settlement amount, $1 lakh you have imported. You tell me this is the quote. For spot rate is given. Now you tell me $1 lakh you have to pay now. You will sell rupee and buy dollar. If you buy dollar, at what rate you will buy? Okay, if you buy dollar from the dealer, you will have to pay 60.55, which means 60.55 I pay rupees and then get at $1 lakh. 1 lakh into 60.55, I get that much dollar. Now, for that, you want rupees, for that amount, you will take the loan at 14% overdraft. This is option number 2. I have put under option number 1, no issue. Convert it as option 2. Okay, this is option 1. Okay, see. This as option 1, no issue. Pay after 3 months. First, pay after 3 months time with interest at 10%. Cover risk forward for 3 months. Very simple. In the option 1, what they say, don't pay the customer now, which means don't pay them now. You have imported, don't pay now. What do you do? After 3 months, you pay. After 3 months, you pay. Now, after 3 months, you pay now. See, the other party is waiting for 3 months. For that, what he say? You pay me dollar interest. You pay me dollar interest. You don't have to take loan from your bank, local bank. You pay me dollar interest along with the capital. Convert in the after 3 months, you have the forward rate now. Forward, use the forward rate for conversion. Are you all understanding? Which means what they say? Very simple. Option 1, you have it. How much is the amount of exposure? 1 lakh. Now you see the solution, you will understand. $1 lakh is there. Repayment in 3 months time. After 3 months, you are going to repay. Okay, $1 lakh into what? 10% is the interest. Okay, if you see the first option, you pay the interest at 10%. Why? Supplier interest is cheaper. Are you all understanding? Supplier says, I will give you 10% interest, but this interest is dollar interest. This interest is dollar interest and not rupee interest. Which means $1 lakh you need to pay. Very easy, my friends. $1 lakh you need to pay. Either add interest. Now interest, you need not convert the dollar. What you will do? 3 months interest you add. Dollar interest now 10% for 1 year. So 10 divided by 4 for 3 months. How much is that? 2.5. So 1 lakh to 2.5 now 2,500. Are you all understanding? So total, what is the total? $1 lakh $2,500. $1 lakh $2,500 you pay me. Instead of $1 lakh you pay me Not today, after 3 months, 1,02,500. Now convert it. If you want to convert it, this transaction is going to happen after a period of 3 months. So today, conversion will happen after 3 months. You will take spot rate or forward rate. Forward rate. Are you all understanding? Forward rate also. Forward bid, forward offer. You see, you are buying dollar. You will go to the dealer, try to buy dollar and give it to the importer. Now, equivalent amount of dollar. Now, what will you do? Offer rate or bid rate. You will buy dollar. Now, it is offer rate. Are you understanding? So, 2.5. This is swap point. So, 60.55. Okay, minus 0.25. How much is that? 60.3. The 60.3 you will under. So, 1 lakh into 1. Okay, 2.5 percentage. 1,02,500. 3 months out rate, forward rate is how much? 59.9. 60.3. Okay, they have computed. Forward rate is 60.3. Offer rate you will consider 60.3. 1,02,500 into 60.3. If you notice, okay, because of the basic discussion, now you are thorough with the rates to be taken. Now see, 1,02,500 into 60.3, 61,80,750. Come to option 2. Option 2 what is option 2? Okay, localized bank, you go and take the OD. OD, what is the rate? So overdraft, 1 lakh you pay, settle now itself. What is the amount? I need to settle 60.55 offer rate, but spot offer, not forward offer. How much is that? 60,55,000. Interest on overdraft, how much is that? 14 divided by 4, which means 14 per annum. 14% per annum divided by 4. 3.5 per 3 months. So 3.5 for 3 months, 60,55,000 into 1.035, 2,11,925. All these are already INR. You need not convert because conversion happened today itself using spot. Thereafter, you just add a local interest, which is already in rupee. So rupee terms, first option, okay, when you pay, this is payable question. First option, option number 1, what is option number 1? Pay after 3 months, take the supplier's loan. This will be your outflow, 61,80,000. In the second case, it is 62,66,000. Which is better? Option 1 is better. Don't settle immediately using OD. Take supplier's loan. That is cheaper. Okay, in terms of rupees, whatever is the cheapest option you will select. Okay, why rupee na? This is your local currency. You are in India na? So you are in India, so local currency you will consider. Shall we move on to question number 54? Okay, cash position versus exchange position. Very important concept, small concept only. I'll tell you. There are 3 accounts involved. First, you need to understand that. Thereafter, you will understand this. See, there are 3 accounts. Okay, see here. Nostro, Vostro, and Loro accounts. Okay, I'll give you a background. Very simple. What happens? See, now there is a SBI bank. Okay. You want to deposit some dollar in this account. Are you all listening? You want to deposit some dollar. Possible or not possible? Not possible. What they do, SBI bank, okay, will have a dollar account in Citibank. Let's say Citibank is there. Citibank of New York or US based Citibank. Now what happens? Okay, SBI has Citibank account. In the Citibank account, they will put the dollar. Are you all understanding? Dollar account. Every bank dealer will have their, okay, the banker will have their own dollar account. Agreed. They will open in Citibank, assume. So SBI will deposit the dollar in Citibank. So you are best bank. This I call it as my account with you. My account with you. Are you all understanding? Okay, this is my account with you. This is my account, SBI account, but dollar account I am opening with you. My account with you. This is called as Nostro account. Nostro account. Are you all understanding? This is Nostro account. Now there is Vostro. Vostro na the same account. SBI having account in Citibank, the same account. Say 503864, the account number. The same account only from a different perspective is called as Vostro. People get confused, but don't worry. Both are same accounts. See, SBI opened an account in Citibank. Now, from the SBI's perspective, this is called as Nostro account. This is called as Nostro account. My account with you. Our account with you. Are you all understanding? Now, Citibank is thinking, SBI has account with me. SBI has a dollar account with me. SBI has a dollar account with me. This is nothing but your account with me. So, from Citibank's perspective, this is called as Vostro account. This is called as Vostro account. Are you all having the clarity? Same way, Citibank, New York based bank. The Citibank is opening a rupee account with SBI. Citibank with opening a rupee account. This is Citibank opening a rupee account with SBI. If this is the case for Citibank, that is our funds with you, between my account with you. So this is for Citibank. This is same account as Nostro account. Okay, for SBI Bank, it is having rupee account of Citibank with it, correct? So this is called as Vostro from SBI's perspective. Are you all understanding? Perspective changes. Same applies to Loro. Loro means, okay, see, these are the two party. Assume SBI is having account in Citibank. In this case, okay, in this case, SBI account is having dollar account in Citibank. Dollar account. Now, there is third bank, say Deutsche Bank. Say Deutsche Bank, okay, Deutsche Bank is there. It is facilitating some trade. It is facilitating some trade. Assume cross currency exchange. It is facilitating. The third bank is okay. It is providing some help to the these banks. Assume from this bank's perspective, their account with them. This is called as Loro. Are you all understanding? It is neither the party. Okay, then which means it is neither SBI Bank, it is neither Citibank, it is a third party. It is third party, which means the same Nostro and Vostro account. If you see from the third party's perspective, it is called as Loro account. Are you all having the clarity? Which means the same account only. From SBI's perspective, my account with you now, it is Nostro account. Your account with us from the Citibank perspective, it becomes Vostro. And third bank, okay, the third party bank, if you take, they are seeing their account with them. It is called as Loro. The same accounts becomes Loro for the Deutsche Bank. Are you all understanding? Now, this is all about the Nostro. What happens here is, see, the bank will have the dealer, Forex dealer will have on any day two accounts. Okay, normally exchange account, all the transaction, Forex transaction will happen. This is something similar to your P&L account. Something similar to P&L account in your. This is like cash account. The cash account is called as Nostro account. Are you all understanding? This is like cash account. Okay, cash book. This is like P&L. Okay, only cash transaction, which means on the date of the transaction, or if you take a forward after 3 months, whenever the cash is getting affected, whenever cash position, I call it as cash position, gets affected, it will have credit and debit side. Okay, if the foreign currency, the cash is nothing but foreign currency. If foreign currency inflow is there, it will be credited. Foreign currency outflow is there, it will debited. This is all about Nostro account, something similar to cash account. Are you all understanding? When you do spot transactions, it will affect Nostro account. When you do spot transaction, it will affect Nostro account. Okay. When you do forward transaction, or the transaction, the money inflow or outflow will not happen today. Say, for example, you bought 3 months forward buy. 3 months forward buy, which means you will have to buy. It will ultimately be purchase or sale. It will be purchase of foreign currency. Foreign currency will come to you, which will be flowing to your entity. But the point is, okay, it will happen after a period of 3 months, not today. But this exchange account is something similar to P&L account. It will get affected, which means spot transaction as well as forward transaction. All the transaction will get affected here. It will affect the exchange position, but will not affect the cash position. Today. But on the transaction date, it will affect the cash position. Are you all understanding? Something similar to bank reconciliation statement you do. Correct? Okay, the transaction will happen. Later on, you need to reconcile the account. This is what is called as exchange account, cash account, or Nostro account. Exchange account and Nostro account. Exchange position, cash position. Exchange position, you will have buy and sell. Very simple, buy or sell. Buy means it will come. Okay, sell means it will go out of the entity. Okay, cash position also, it will be debit, credit, same as your cash account. Are you all comfortable? Nostro account is nothing but cash account. Shall we do one question? Simple, straightforward question. See, question number 24. This was asked two attempts back, but still I feel they may test it. That's why simple concept only. Within 5 minutes we will cover. Okay, you are a dealer in a foreign exchange having following position in Swiss francs on 31st October 2022. Okay, 31st. Yes. October 2022. Balance in the Nostro account credit, Swiss francs 1 lakh. Opening position overbought. How much is that? 50,000. Purchased a bill on Zurich 80,000. Sold forward TT 60,000. Forward purchase contract cancelled. Very simple. See, you have buy side, sell side. When you make forward purchase contract, which means it will be exchange affecting the exchange position, it will be buy. But this is contract cancelled. When you cancel a buy, corresponding sell, so it will come under sell position. Are you all understanding? Sell side, the 30,000 will come under sell side. Are you all having the clarity? Because purchase cancelled. Okay. Remit by TT, draft on Zurich cancelled. This is a question that is being asked. What steps would you take if you are required to maintain a credit balance of Swiss franc 30,000? Now, what happens? All the transaction you keep recording on the target date, which means the last day of the particular month. what they do, okay, you will have some nostro account balance. You will have some nostro account balance. What they say, every company will have some procedure. They will give you what is the balance to be maintained. In the question and all, they will give you what is the nostro account balance to be maintained. So what you do, first close the nostro account position. First you should close the nostro account position, see what happens there, cash position. Okay, you will bring it to the required value. Now, if you do that, what will happen? Exchange position, you need to take some position. Exchange position will get affected. Again, you need to balance it without affecting again the cash position. Otherwise, you keep on doing the cycle. Are you all understanding? Let's read the question. You will understand one by one. With the numbers, you will understand better. See what happened. Credit balance of Swiss franc 30,000 in the nostro account and keep an overbought position Swiss franc 10,000 in exchange position. That is in exchange account. That is a understanding, which means what they want ultimately, maintain a credit balance, closing cash balance of 30,000 you maintain. That's what they say. And this is the nostro account, a cash account, you keep it. And keep it as overbought position, which means overbought position on Swiss francs 10,000, which means in the exchange position, okay, exchange account, just like in the P&L account, you keep 10,000 overbought. It should be 10,000 overbought. Are you all understanding? Net buying position you should have to the extent of how much? 10,000 Swiss francs. Let us solve this, you will understand. One by one, you will understand. Exchange position, cash position. I will record about the transaction. See what happened. Opening balance overbought. Apo purchase account, sales. Purchase, sales. Only two columns. Okay, you can also write it like this. This simple thing. Purchase, sales. This is for exchange position. Cash position, nostro account, debit, credit. Like this you will have. Are you understanding? Simple cash account. Okay, what you do? Purchase account. You tell me one by one. Opening overbought position. Now already you have bought overbought position. Where will be there? Purchase. Okay, 50,000 overbought position. Are you all understanding? Next. Bill on Zurich. Okay, you drawn a bill. How much? 80,000 rupees. Bills you. Okay, 80,000 to the extent of 80,000. You have drawn a bill. How much is that? Here you put it on purchase. Are you understanding? Next. Forward sales TT. Now forward sales TT. What do you mean by TT? Telegraphic transfer, spot transaction. TT means spot transaction. Okay, telegraphic transfer, instantly wire transfer you are doing. Assume. Okay, forward say. What is that? Okay, this 60,000 is the, oh, sorry, sir. This is not, okay, not instant sales, this is forward sales. This is forward sales. Forward sales, TT. How much is that? 60,000. Now tell me, forward sales, will it affect my cash position now? Yes, exchange position 60,000, I put it in sale. Will it affect my cash position? Will not affect. Will not affect. Are you all understanding? In a forward, okay, will not. The moment you see forward sale, okay, the moment you see forward purchase or sale, it will never affect. Why? Because it is not, transaction will not happen today. It will be, the amount will be agreed today, but the transaction will happen on a later date. Transaction date only, the cash position will get affected, not today. So hence I ignore it. 60,000, I will not do anything. In the nostro account, I will not do anything. Are you all understanding? Now, next, you have, how much is the cancellation of forward contract? Cancellation of forward contract, which means, see, the forward contract, okay, here, the forward contract, here there is no mention of, see, the forward sale cancelled, purchase cancelled. Institute has assumed that forward purchase is cancelled, which means you have bought a forward earlier, you are cancelling it now. Forward cancel of forward contract, it will affect yes, exchange position 30,000. Okay, it will come under sales. Okay, it will come under sales now. Next, TT sales. TT sales when they give just a TT sales and nothing about forward. Okay, they don't mention forward, just they say TT sale or TT buy. Telegraphic transfer sales, which means you assume that is spot sale. That is, assume it is spot sale. Very simple. 75,000. You tell me. If I put sales now, I will put in sales side. No issue. Exchange, the sales position will come. Cash position, it will affect the cash position. It will never affect it will affect when you make foreign currency sale. Okay, it is debit, credit, foreign currency, TT sale, debit, credit, debit. Because see, sales don't think you are selling the foreign currency, you will receive the rupee. Not like that. This account itself, foreign currency account. All the transactions are foreign currency account, which means when you sell foreign currency, it will go out of your funds. Are you understanding? Cash will go out. It is nothing but cash. Cash only you are buying and selling. It is nothing but foreign currency only, which means you will go out. Debit. 75,000 will be debit. Okay, here. Next, last draft on Zurich cancelled. Okay, earlier you have taken a draft. Okay, sale position is called a draft. You have taken a draft, which, okay, you have cancelled the draft, which means draft taken sales low round, draft cancelled it will be purchases, counter closing. Okay, it will come under exchange position, purchase side. Okay, now will it affect the cash position? It will not affect. Okay, now closing of 1,60,000, 1,65,000. Now tell me, children, it is overbought position, oversold position. If you see it carefully, it is oversold position, overbought position, oversold position. Are you all understanding? It is 1,60,000, 1,65,000. You have oversold position of how much? 5,000. Oversold position of 5,000. This you keep in mind. I'll come back to the cash position. Cash position, opening credit balance. They have told that opening cash should be 1 lakh. Can you see this? See here, balance in the nostro account credit. How much is that? 1 lakh Swiss franc. Which means you have bank in hand, cash in hand. How much is that? 1 lakh. Then TT sales. I already told you it will be debited. So balance is 25,000. You have credit balance or debit balance? Credit balance of 25,000. Okay, credit balance how much? 25,000. Dollar. Okay, currency, foreign currency. Now you tell me, this is all about the account. I'm closing the account. I've closed till now 10,000, 10,000. Fine. Now, before I close the position, nostro account, okay, I have to consider what is given in the question, what they asked. First, you will close the cash account. Cash, the nostro account, what they told. If you are required to maintain a credit balance of Swiss franc 30,000. Sir, I have at present, what is the credit balance now? 25,000. I want to maintain a credit balance of 30,000, which means what I should do? See, I want to increase my credit balance. If you want to increase my credit balance, what you should do? Buy, and that increase also should happen now itself. Which means you want to make spot transaction. You want to make spot transaction. You will spot buy, you will spot sell. Tell me, children, you will spot buy, you will spot sell. Okay, you will spot buy. That is what they told. Buy spot TT Swiss franc 5,000. You will make a spot buy. Instantly, you will get a credit of 5 more thousand. Up a total credit balance will become how much? 30,000 as required in the question. You will make the cash balance of 30,000. But there is one problem. When you make a cash spot buy of 5,000, spot transaction also affect the exchange position. Okay, which means earlier you had 5,000 oversold position, correct? Oversold position you had. Now 5,000 you have bought, na? You have bought 5,000. Are you understanding? This will get cancelled. So net zero, overbought or oversold position will be nil. Are you all understanding? Now the issue is, first, so step by step understand. First I need to close that nostro account. Once I close the nostro account, what will happen? I make TT purchase, spot purchase. Because of that, what happened? That will affect the exchange position. Exchange position was overbought 5,000. Oversold 5,000. What was the position? Exchange position? Yes, oversold 5,000. I bought 5,000 more. I bring the parity. There is no position. Exchange position is nil. Exchange position is nil. But I want to have some balance in hand. What they say? Increase the balance in nostro account. Yes, this is done. Already done. This would see. Then what they say? Not the question, sorry. This is the question. That's the solution. Balance of 30,000. Nostro account keep the overbought position 10,000. Which means I want to keep exchange position overdraft, over purchase. How much? 10,000 overbuy. But at present, I have made it nil, 0. Now what I should do? If I do spot purchase, what I will do? If I do spot purchase, yes, exchange position will be 10,000 overbought. But it will again affect the cash position. Without affecting the cash position, how I can increase my overbuy position in what is that? Exchange account. Forward purchase. Are you all understanding? What is the strategy ultimately? Okay, buy 5,000. See here. The bank has to buy spot 5,000 to increase the balance in the nostro account to 30,000. This you close the nostro account fully. But this will have impact. This would bring down the oversold position to nil. This will bring down the exchange position also. Spot transaction will affect. It will bring down to nil. Since the bank requires an overdraft position, again, if I make spot purchase, it will affect the nostro account. The cycle will continue. So what I should do, without affecting nostro account, if you want to make a transaction in exchange position alone, what I should do? Forward buy. Okay, overbought position of Swiss franc 10,000. Now it has to buy forward Swiss franc 10,000. Very, very important. Are you all understanding? Without affecting nostro account, over to make it overbought account. Shall I proceed? Okay, next question number 55. Very, very important area. Currency futures. See. For this attempt, I feel currency futures, currency options. Okay, yes, these two areas are very important from Forex. Okay, I think they may get tested. And covered interest arbitrage and one or two questions which I'm going to discuss. I feel these are all important. Okay, now, shall we discuss? See, XYZ Limited is an export-oriented business house based in Mumbai. The company invoices in customers' currency. Okay, its receipt of US dollar 1 lakh is due on September 1, 2009. Market information is given below. Okay, exchange rate given. Spot 1 month forward, 3 month forward. Currency futures is given. June futures, September futures, and the contract. One contract is okay, US dollar per rupees. This is the contract size. Okay, contract size is 4,72,000. Are you all understanding? Okay, rupee. Okay, this is US dollar per rupees. Okay, contract size is 4,72,000, which means contract is in Indian currency. Futures are for rupees. This is US dollar per rupees. Now, rupee future. These are all quotation for rupee futures and not for dollar futures. Okay, I will explain later. Next, just we will read out the question first. Initial margin interest rate in India. Initial margin June 10,000. For September it is 15,000. And you have interest rate 7.5%, 8%. See here, interest rates in India they have given loosely. What is the understanding? Whenever in our subject interest rate given without mentioning anything, interest rate means okay, it will always be per annum interest rate. Are you understanding? Keep that in mind. Okay, next. On September 1, 2005, the spot rate US dollar per rupee is again indirect quote. In Indian rupee, this is indirect quote. That's why dollar per rupee given, not rupees per dollar. Okay, indirect quote. And currency future rate is 0.2134. Comment which of the following methods will be most advantageous for XYZ Limited. Using forward contract, using currency futures, using no hedging option. I will, okay, first discuss the forward contract and no hedging option. Then I will discuss the futures because you will have better understanding. Shall I proceed? Okay, now see what happened. It may assume that variation in margin would be settled on the maturity of the futures contract. On the maturity of the futures contract. This is a question that is being asked. Now, can we go through the first option? Okay, first what they say, you should do, okay, based on currency future, forward rate and without hedging option. First, I will do this same question without hedging option and forward. Thereafter, I will enter into future. See here what happens. Forward rate, let's take forward. See, for example, you took forward for hedging. First, tell me, it is export-oriented business located in Mumbai. Domicile is in Mumbai. Agree? Now, it will have dollar receivable, dollar payable. Step by step, I'll make you understand. You will understand the importance of the first half an hour or 1 hour we discuss now basics. Why I discuss basics, you will understand the relevance. Now, listen. See, this is Mumbai-based company. It has exported a dollar receivable. It will have dollar receivable. Now, it is due on September 1, 2009. Now it is June 1, 2009. So, July, August, September. 3 months futures or 3 months is the contract period. 3 months is the contract period. This you agree. Okay, this is a contract period. 3 months is the relevant contract period. Now tell me, if I take forward, I'll take 1 month forward. I'll take export. 3 months forward. 3 months forward for exchange. So tell me, what is the exposure amount? $1 lakh is the exposure amount. Okay. 0.02127. This is direct quota, indirect quota. Quote for a rupee in India. It is quote for a rupee. What is that? US dollar per rupee. It is quote for rupee in India is indirect quote. Which means what you should do? $1 lakh. Okay. How much rupee is converted into rupee now? How much is the rupee? Into 0.02127. Divided by 0.02127. Divided by 0.02127 or $1 lakh into 1 by 0.02127. Are you all understanding? Which is nothing but same now. 1 lakh divided by 0.02127. What is the amount you will get? Okay, this is the amount 47 lakhs 1,457. Are you all clear with this part? Okay, next. Now, I'll come back to futures hedging later as promised. I'll come back to no hedging option. You tell me, children, you have not taken any hedging option. You leave the position unhedged. Which means after 3 months, I have not taken any position today, June 1. September 1, what is the spot rate? Spot rate is 0.2133. Spot rate is 0.2133. This you will consider. If you are doing no hedge, this will be your exposure amount. This will be your receivable amount. Up $1 lakh divided by 0.02133. How much is the amount? Okay, 46 lakhs 88,233, which means under no hedging option, I get 46 lakh 88,233 as receivable amount inflow in rupee. Okay, now when you are comparing all these methods, you will ultimately find out inflow or outflow in terms of your local currency. If your company based in India, okay, you will find out the rupee outflow or rupee inflow. You will select that option, whichever gives you highest inflow or least outflow. If it is outflow based question, if you are a payable exposure, if you have a payable exposure, you will find out, okay, which option gives you highest payable amount in terms of rupees. That option, least outflow in terms of rupees. This you will find out. In case if you are an exporter, you have dollar receivable. In terms of rupee, what is the maximum inflow you will get? Which option will give you highest inflow? That you will find out. So no hedging option. This is the inflow. Okay, this question is about inflow, receivable exporter. So which option will give you highest inflow? You will select that option. 46,83,000 and you have forward hedging of 47,01,000. So forward is better than no hedge. Now we need to see the futures option. Futures option difference. What will happen? Unlike forward, okay, it will not be directly applied one rate and calculated. What they do, futures transact. This is cash market. This is futures market. Okay, I told you in the futures, there are two markets: cash market, future market. Listen to me, friends. Even if you take position in futures market, it is an exchange traded instrument, stock exchange that is getting traded. What is the net settlement will happen? In case of futures, net settlement will happen, which means in futures you will have gain or loss. You will have gain or loss in futures. Agreed? This cash transaction normally will happen as if you are taking no hedge, which means cash market as if you are taking no hedge. Now 46,88,000 some amount we got now under no hedge option. 46,88,233. That will still remain here. Where is the 46,88,233? This will be same. Are you understanding? Your cash position now you leave it unhedged on the date of maturity. You will take the maturity date spot exchange rate. That rate you divide it by 1 lakh. You will get this 46,83,233. This is that futures option. While you compute net outflow under futures option, it will be cash outflow under normal option without hedging option, plus or minus the gain or loss from the futures transaction. Are you understanding? By entering into futures, okay, you will have some loss or you will have some gain. This gain or loss you adjust with the cash market position and find out the net benefit or net cash outflow, or inflow. In this question it is inflow. This question receivable net cash inflow you will find out. Shall we see futures, currency futures? I'll explain one by one. First, you need to understand whether you are going to buy futures or sell futures. See, with normal stock futures, what you do, if you take buy position in cash market, this is cash market, this is futures market. Okay, cash market, if you take buy position, futures market, opposite position you will take. Long in spot market, futures market, you will take short position to hedge your position. If you take short position in cash market, you will take long position in futures market, opposite corresponding position. All this we saw in the futures segment. Now what they say, in currency futures, so tell me whether I need to buy futures or sell futures. Question arises now. Very simple. I'll tell you what you need to do. You are an exporter. How to think, I'll tell you. Very, very important. First, okay, just like in the covered interest and money market, where to borrow, where to invest is the main issue. Here, you need to see whether you are an exporter or importer, or to put it simply, I'll say you have foreign currency receivable or payable or foreign currency payable. First, you need to decide whether I have to pay in the future foreign currency or I have to receive foreign currency. Are you all understanding? If you have receivable in the foreign currency, if you have receivable in the future date, receivable on the future date, if you are receivable, you have exported goods, you have receivable, dollar receivable, which means after 3 months, you will sell dollar, buy dollar, you will sell dollar. As a receivable person, you will sell dollar. As a payable person, you will buy dollar. You are agreeing. Now you understood? Now, if you want to sell dollar, now whatever you want to do tomorrow, do it in the futures market. What the position? Sell futures, sell dollar futures, sell dollar futures. Are you all understanding? If you are an importer and you have payable exposure, what you do? Buy dollar futures. In future, what we are going to do in the future timeline, you do it in the futures market. So buy dollar in the future. If I'm an importer, I will buy dollar tomorrow. So futures, I'll take buy position, buy dollar futures. Now this is important. Dollar futures. Here also sell dollar position futures. Why I'm saying is, now this is normally happen. Exporter will buy dollar futures. Why? Because exporter will have to sell, exporter will sell dollar futures. Importer normally will buy dollar futures, provided the quote is for dollar. The quote is for dollar, or to put it simply, if the quote is direct quote. If in India, okay, if the quote is given like this, in India, if the quote is given like this, say for example, in India, it is given dollar futures is equal to 46.48. Like this quote is given for dollar futures, just like forward. $1 is equal to 80, $1 is equal to 82. Like this, bid rate and offer rate, whatever this is, quotation given for dollar in India is a direct quote. Just like, okay, your spot market, exchange market, like this, the futures market also will give you quotation. If the futures market, okay, gives you a quotation not for dollar, but for rupees, Classic example, this question. In this question, what happened? Okay, you want dollar quotation. If dollar quotation is given, you will sell dollar futures. But the point is, if rupee quotation is given, if you sell dollar tomorrow, what will you do with rupee? You will sell dollar. Okay, you will buy rupee. You will sell dollar and buy the rupee. Are you all understanding? Which means normally exporter, okay, if the quote is direct quote or the quotation is for dollar futures, what will you do? You will sell the dollar futures. But if the quotation is giving for rupee futures, what will you do with respect to rupee? Opposite position, buy rupee futures. What is my position? Buy rupee futures. See here, the quotes given are not for dollar futures, but for rupee futures. Hence, we should approach the problem as buying and selling rupees for determining profit and loss in futures market, as well as for determining number of contracts, etc. Now, tell me, children, futures contract selected, September futures. September futures price is this much, 0.02118. This is September future you need to select. At present, what is the futures price? Okay, there is June futures and September futures. You are sitting on June. Okay, same day June futures. What is the use of it? Which means this is the price at the end of this month. 1 month future, that will not, you will not take. This September future only you will take nearby the maturity period. See, future contract is exchange traded, not available. Okay, not always it will be matching, because exchange there will be on any given day 1 month future, 2 month future, and 3 months future. Suppose you are taking a transaction, okay, say for 4 months. You're understanding? Can you take 1 month, 4 months future? Can you demand from exchange? No, it is exchange traded. Whatever is available in the exchange, you will take as a forward. Is a OTC contract. Forward is a OTC instrument, which means you sit with the bank, customize it. Okay, you say the bank, see, I want 4 months forward now. You deal with the bank like this, okay, in private. But you can't say to the exchange, stock exchange, okay, whatever is available, you have to buy. You can't demand anything. Are you understanding? So there will be maturity mismatch. All these things are profound issue. No, don't worry. Now I'm saying, September is the time period. You take the September futures, 0.02118 for hedging. This is the price. So what will you do? Buy September rupee futures. What is the futures? Buy or sell? This is very important. Since we are going to sell dollar on September, selling dollar mean buying rupee in the future, buying rupee futures. We want to have a guaranteed dollar selling price or rupee buying price. Hence, we buy rupee futures. In the question, rupee quotation is only given. So we'll take rupee futures. Amount of rupee futures to be bought. How much is that? $1 lakh divided by 0.02118. Now, the dollar, $1 lakh I require. But number of contract, okay, futures will be traded in number of contract, standardized contract size. Okay, you cannot say that, give me equivalent amount of futures. No, futures will be traded in lot size, and contract will be there. Contract value will be there. You cannot just like that and trade for whatever amount. Okay. Now you say you have exposure of 1 lakh divided by the price. Okay. So what is the price of the futures? 0.02118. You have bought a September futures price will give you total contract value. Okay. This is contract size, total contract value, which means how much is the total contract value? 47,21,435 rupees. This is a total contract value. Now, to hedge my 1 lakh rupee position, I'll take total how much? Okay. Sorry, 47,21,437. Now, number of futures contract, again, how many futures contract I need to sell? I need to buy 47,21,435. This is a value divided by what is the contract value? Each contract is for how much? 4,72,000. 4,72,000. Contract size is 4,72,000. Okay, hence you can get 10 contracts. Little bit more than that, but again, 10 contracts you should get. Okay, are you all understanding? Now, strategy, buy 10 September rupee futures contract at 0.02118. Buy 10. What is the strategy? Buy 10 September rupee futures contract at this price, September futures trade price. Now, profit or loss on 1st September, very simple. You bought futures on this price, selling futures at this price. How you got this price? Future. One more thing, important adjustment. When you close the futures position, okay, you will have buy and sell now. So futures market is there. I say futures market. Here I bought for this price, bought for this price, selling for this price. Fine. Now while closing, you should not take the maturity date spot price. Sometimes what they give two different prices on the date of maturity. Convergence will happen. Generally, maturity date plus spot price and the future price may be same also. When question doesn't mention, you will assume that convergence will happen most probably. Okay. When question separately gives you one future price and spot price, okay, vegetable market you go, you can only buy vegetables. Fish market you go only buy fish. Like this future contract can be only closed by the future price, which means if you buy futures now, it should be closed by counter sell. That also should be futures price, not spot price. For example, why I am discussing now, in this question, initially you taken future price as 0.21, 0.02118. Agreed? This is the price you have taken. Now, when you sell the future, the counter close, when you count the close the position, what is the rate you should take? If you notice, on September 1, spot price is given and futures price is also given. What you need to take to close the futures buy or sell other position? Only futures price, not spot price. Are you understanding? But generally, there is a concept called as convergence. The spot price and the future price on the date of maturity will converge, will be one and same. Hence, okay, where question doesn't mention separate futures price, then in that case, the maturity date spot price will be taken as futures price and futures will be closed by taking that price. Are you all understanding? This is why I've discussed this. Okay, now let's discuss this, finish this. Okay, see what happens. So profit, this is profit per contract in terms of dollar is 0.000016. Profit per contract, if you put it in rupee, lot size is in rupee, 4,72,000, contract size in rupee. So 4,72,000 into 0.0016 will give you profit in dollar. Why? Because you multiply this 3, profit per rupees is this much dollar. This, if you multiply with this, okay, you will get the dollar amount. Are you all understand? This is in rupee, but since this is in dollar, it will get converted into dollar. Are you all agreeing? Okay, so 75.52 will be your dollar profit. This dollar profit is for one contract. You have taken 10 contracts. Total profit is in terms of dollar is how much? 755.2. This is profit in terms of dollar, but I am an Indian company. I want to make it to, okay, Indian rupee. Now, what you should do? Convert it. When I convert, I will use what rate? See, very simple. When you will realize the profit, timeline is important. When you are realizing the profit, when the transaction happens, that day, conversion rate, spot or forward you will take, which means this conversion will happen. Future profit or loss will be credited or debited on which date? Maturity date. Maturity date 1st September. On that date, I'll convert using spot rate. This spot rate is not futures date. When you convert, okay, the exchange market you will go, because futures transaction happened, this much profit credited in your demat account, okay, which is credited, that you will take and convert it using the exchange rate prevailing on September 1. Okay, so you will get the profit in terms of rupees 35,000. What is that? 35,406. Are you all understanding? This is variation margin or profit or loss. I told you this is profit or loss. Now, apart from that, there is one problem here. See, initially in the futures contract, margin account will be there. Margin money will be deposited. I discussed in the future. Margin money will be deposited. 10,000 or 20,000. The point is margin money will be a refundable amount. If you go to the, okay, make up electricity deposit, that is refundable deposit. So margin account, see, the P&L will be adjusted, balance margin amount will be given to you or belongs to you, right? So that initial margin amount which you put, that is not an issue. But problem is, the initial margin, assume you deposited 10,000 rupees, for the 3 months period, you lose interest amount. So opportunity cost, which means because of this lock-in amount of 10,000 or 20,000, which you deposited an initial margin, for that interest will be computed for 3 months period, because, okay, transaction 3 months period, interest you will lose. Had you not taken the futures transaction, okay, what will happen? You will gain interest from the bank. So opportunity cost also I should consider. Margin for September futures, how much initial margin I should deposit? See the question, 15,000 or 10,000, 15,000 you will deposit. On 15,000, what will be the interest you will lose? This is rupee. See, interest rates in India, 7.5%, 8%. What is interest rate? For September interest rate, that annualized interest rate, 8% interest rate I will consider. So 15,000 into 8%, this is per annum. You convert it into 3 by 12. What is it? Yes, 3 by 12. Okay, you will get interest on futures amount. Okay, the margin deposit, how much is that? This 3,000 amount is lost. This is cost for you. Are you understanding? Futures you may gain, but you lose in interest cost, opportunity cost, and then you will net the cash transaction. Total amount payable in terms of cash, you will get the conversion of double in terms of cash market. No hedge option, I told you now. So no hedge option, 46,88,000. Already I discussed here. In the no hedge option, what happens? The 46,88,000 you will get, and the futures gain or loss how much? So to conclude, very simple. No hedge option. What is the conversion proceeds? This is cash market. This is what happened. This will not change. Just because you take position in futures market, cash market position will not change. That will happen on that will happen at the rate of maturity date spot price, which means 46,88,000 is the value. No hedge option value. But since I take future position, okay, I have some gain in the futures which will offset my negative position. Are you all understanding? So what is the gain in futures? 35,406. Up of 46 lakhs, 38,233 plus this gain on futures 35,406 minus 3,000. Why? The 3,000 is the opportunity cost, interest lost on initial margin. So all these three you net it off. 46, 88, 233 plus 35,406 minus 3,000. You will get net cash outflow, net inflow as 47 lakh 20,639 under futures option. So which option is better? Highest inflow. Okay, it is advantageous through futures market is having inflow, highest inflow. Hence, I'll take futures position. Are you all understanding? Okay, with this I'm through with the currency futures. Next question I've given just to make you comfortable. Okay, with the reading of the question. Okay, I'll read the question. I'll help you out with what position to be taken, and you can go through the solution. Are you all understanding? See, this question you can take. Altman Incorporation, a UK company, is in the process of negotiating an order amounting of 4 million with a large German rate. Now, you say UK company, already given. Domicile is UK. Domicile is UK. Now, comfortable, not like previous question. You have to, yes, previous question also company given. Mumbai-based company, no issue. Okay, with a large German retailer on 6 months credit. If successful, this would be the first time that Nitrogen Limited, okay, this is all. Okay, has exported goods into. What is that? Highly competitive German market. Okay, the company name is different. Okay, make a correction. There's not Nitrogen Limited. Assume the Nitrogen Limited has exported goods into the highly competitive German market. The following are German retail. Yes, yes, correct. First time that German is exported goods. Yes. Okay. Yes, this is the company. Okay, any company name, no issue. The following three alternatives are being considered for managing the transaction risk before the order is finalized. No issue. Three alternative given. Now see, this person has exported goods worth 4 million euro. See, UK will have pound. UK will have its currency as pound. German, or earlier they had before the merge they had the Deutschmark, like the German based DEM, the currency was there. Now everything merged into euro they merged. Okay, so which means German currency is euro, UK alone is pound. Okay, they have separate pound. So what I say here, UK based company exported goods, which means this is UK based exported goods. Receivable generally will be in euro receivable. Are you all understanding this? Euro receivable. Invoice the German firm in sterling, pound sterling. Three options the company has. Either it can invoice in sterling using the currency exchange rate to calculate the invoice amount. Are you listening? So what do you say? Whatever is the amount, invoice the amount in sterling, pound sterling. So pound sterling, if I invoice, very simple. This is a 3 months transaction. What is the the following data are given. Yes, 6 months. Okay, 6 months is given. Forward points is given. Now forward rate you invoice the amount. Forward rate you invoice. Are you all understanding? That's the first option. Next option, alternative of invoicing in the German firm in euro. Alternatively, invoice the German firm in euro and alternative of invoicing the it has an alternative of invoicing the German firm in pound, some typographical error, no issue, firm in euro, and using a forward foreign exchange contract to hedge the transaction risk. Are you all understanding? So what they say, second option, very simple, invoice in euro itself, using forward foreign exchange contract. Very simple. Next, invoice the German first in euro and use sufficient months sterling future, pound sterling future. Are you understanding? Contracts to hedge the transaction risk. Okay. Now it is UK based company, they use pound sterling futures. Again, indirect quote will be there, maybe anyway. Now indirect quote will only be there because you use pound sterling in UK. Now it is same currency in rupee futures in India. First question we saw, same way this question is there. First point, let me check it. Spot rate is given. What is the given? Euro 1.175 per pound. Again, this is direct quota, indirect quota, indirect quote. Agreed? 6 months forward point also given, euro cents, indirect quote. Next, future also. Generally, spot market, whatever quote is given, future also will be given same. You can assume it to be pound futures, indirect futures. Okay, pound futures. How much is that? 1.1760 per pound. Next, 6 months future contract. Again, same way, just like Indian rupee 4,72,000 was there. Here, pound futures. For pound is given. Futures contract size is given in pound. after 6 months spot rate, maturity spot rate and the future date. See the beauty in this question. Okay, spot rate, maturity date after 6 months, the maturity date spot rate and the future rate is same. What is the understanding? Convergence happened, which means maturity date, generally future and spot rate will converge. Okay, the gap will be closed slowly, and on the date of maturity, the gap will be converged. This is what is happening. Anyway, if separate gap is given, you will take for cash transaction as well as for future. This is the closing rate you will consider. Shall I proceed? Okay, now I will not discuss. I'm not going to discuss all the question. Just I will discuss a few points. One important observation. First to tell, if you have tell this answer, you will get the solution right. Tell me. UK based company enters exporter, highly competitive German market, which means exporting in Germany. Okay, exporting to Germany. Now tell me. Now it will have sterling receivable, that is euro receivable, euro payable, foreign currency receivable, payable, euro receivable. If you have euro receivable, in future, what you are going to do? You will sell euro, which means sell futures, euro futures. But provided the quote is given for euro futures or sterling futures or pound futures okay, pound sterling, sterling, sometimes pound is used, sometimes it is nothing but pound sterling. This is pound sterling. Okay, now see what happens. Sell futures, then what you do? Quotation is given for pound futures, euro futures, pound futures. So in respect to pound, what you will do? Buy pound futures. This is the strategy. Shall we do? Okay, shall we see the strategy whether it is correct or not? Okay, you will buy the what is the given use of futures contract. The equivalent sterling order placed this is this much number of okay. Oh, all this is fine. Yes, here see this. Net P&L, if you want to find out, you buy pound future at this price, sell pound future at this price. Okay, buyer at a lower price, higher price, it will be profit. Are you all understanding? If you don't know at what price you are buying and selling, okay, profit or loss will be wrong. Okay, it will be either profit or either loss. Okay, it will be either profit or loss. That will be incorrect if you don't properly analyze. Are you understanding? So this is the solution. 8,438 will be the total profit on futures contract. You can go through the solution. Are you understanding? Very important observation. What you need to buy or sell, what position you need to take is very, very important. Shall I proceed to the next question? Next, currency option question. I think it is currency option question. Yes, currency option question. Very, very important. Question number 57. Okay. Shall we discuss question number 57? An American firm is under obligation to pay interest of Canadian dollar 10,10,000 and Canadian dollar 7,05,000 31st July and 31st September respectively. The firm is risk averse and its policy is to hedge the risk involved in all currency foreign currency transactions. The finance manager of the firm is thinking of hedging the risk considering two methods, i.e. fixed forward or option contract. Forward versus option contract ratio. Okay. It is now June 30. The question: following quotations regarding rates of exchange US dollar per Canadian dollar from the firm's bank were obtained. Okay, spot 1 month forward rate, 3 months forward rate given. Okay, spot exchange price for a Canadian dollar per US dollar option on a US stock exchange. Canadian dollar per US dollar on a US stock exchange direct quote. Okay, for this is Canadian dollar option. Okay, cents per Canadian dollar payable on purchase of the option. What is that? Canadian dollar per US dollar. Okay. Now this is contract size Canadian dollar 50,000 are as follows. What is that? Strike price. Strike price given US dollar per Canadian dollar. Call option, put option, July, September. Here also July, September. What are all these various strike prices? Okay, for this is strike price. For each strike price, there is okay. This is percentage terms. This is all premium. These are all premium and percentage terms. So the contract value, assume the contract value is 10,000 rupees. 1.56% is the premium. Are you all understanding? 2.56 is the premium. This is premium for July call option. This is premium for September call option. Put option July, September, given to confuse you. If you don't know which option should be selected to hedge, you will never understand the solution. Are you all understanding what is the issue? Okay. We need to identify the correct option. Okay, next. Like this they have given, we will try to solve. Okay, according to the suggestion of finance manager, if options are to be used, 1 month option should be bought at a strike price of 94 cents and 3 month option at a strike price of 95 cents. And for the remainder uncovered by the options, the firm would bear the risk itself, which means generally forward rates will be taken. For this, it would use the forward rate as the best estimate of spot, which means yes, you will bear the risk, but best estimate of spot forward rate can be used. Okay, forward rate can be used, which means what they say after a period of how is it visible? After a period of 3 months, suppose the maturity date spot price, okay, will be the forward rate, will be taken as forward rate. In this case, the uncovered portion now will take forward rate as hedging option. That's what is the understanding. Next, transaction costs are ignored. Okay, recommend which of the above two methods would be appropriate for the for this. Okay, now see, very simple. Strategy 1, forward market cover. See, first read the question here. American firm, domicile is US, and obligation to pay interest of Canadian dollar. This much is the interest, and Canadian dollar this much. Are you all understanding? This interest is payable on 31st July. This is on 30th September, and today is June 1. They are telling. Are you all understanding? So June 30, June 30. So June already gone. August and September, August, June gone. July, only 1 month is pending. So this is 1 month contract, and this is September means July, August, September, 3 months contract. Are you all understanding? So 1 month and 3 months. Now forward rate, that is why they have given forward rate, 1 month forward, 3 months forward. Very simple. Now you have, this is American firm, you have Canadian dollar obligation. Quote is given Canadian dollar per, see what is they given, US dollar per Canadian dollar. This is US dollar per Canadian dollar, direct quote, which means what you should do, what is the exposure amount? 10,10,000 into 0.9301, 7,05,000 into 0.9356 for both the contract. Okay, two different na, July, September. July, okay, 10,10,000 Canadian dollar payable into 0.9301 US dollar amount. What is the okay output in terms of outflow in terms of dollar, US dollar? 9,39,401. September forward, okay, 7,05,000 into 0.9356. You will get 6,59,000. Are you all having understanding the forward market cover? No issue. Question is not regarding forward cover. I am discussing the question because of the option contract. See, very simple. First, you tell me, children. The quote given in the question, direct quota, indirect quota, direct quote. American firm, a quote is given for Canadian dollar, US dollar per Canadian dollar. Quote is given for Canadian dollar. Now you tell me the same. When the spot rate is for Canadian dollar, usually the option will also be Canadian dollar per US dollar, price for a Canadian dollar per US dollar option on a US stock exchange, cents per Canadian dollar payable. Okay, on purchase of the option, contract size Canadian dollar 50,000. Are you all understanding? The contract size is also Canadian. This is direct quota, indirect quota. Now you need to see strike price US dollar per Canadian dollar. All this have been given. Okay, now first of all, you tell me, children, what will you take? See, what they say, contract, option contract. Now, first, number of contracts. What is the number of contracts? 50,000. What is the Canadian dollar payment amount? 10,10,000. Up number of contract is how much? 10,10,000 exposure amount. Okay, divided by, okay, the contract size, 50,000 is the contract size for the July. You will get 20.20. September payment, what is the amount of exposure? 7,05,000 divided by 50,000. Contract size is same, so 14 contracts. So to hedge the July payment, I will take 20 contracts, and to hedge the, what is that, September payment, I will take 14 contracts. Are you all understanding? Now, one main issue here, I'll come back to that. First, see here, when I when I pay the premium, you tell me, children, which option I will take, which option I will consider. That you need to remember. Very simple. Option. Now, first question we are discussing regarding option. Main thing, you will assume that the option is exercised. You will assume that the option will be exercised, which means you don't know the maturity date spot price. If it is okay lower than the actual spot price, if the future spot price is okay, what do you say? The maturity date spot price. The maturity date spot price is more than exercise price, you will exercise the call option. Now, if your maturity date spot price is less than the put option, you will exercise. But in the share question and all, if you see in the option question and all, they will give you the maturity date spot price and they will give you exercise price. You will compare and decide. here, okay, they won't give maturity date, what is the spot price? No? Sometimes they may give, they may not give. You will always assume that you will exercise the contract. Option, the assumption. Now, you tell me, children, here what happens? Hey, I have Canadian dollar exposure. I have Canadian dollar payable. If I have Canadian dollar payable, what I will do with regards to option? You tell me. Canadian dollar is payable. I will buy Canadian dollar. I will sell Canadian dollar. I am payable. I will buy Canadian dollar to, okay, payment. Make the payment. Are you all understanding? Interest payment. And the first example itself I discussed, correct? Interest payment. Now, Canadian dollar, you will buy Canadian dollar from the dealer, which means you will sell the US dollar, buy Canadian dollar, pay the interest. Pay the interest. Are you all understanding? Now, buy the Canadian dollar. If I want to buy the Canadian dollar, if option quotation is given, direct quote, now this quotation, direct quote is given, Canadian dollar quotation is given, which means you will buy the Canadian dollar in the future. If you want to buy Canadian dollar, now call option you will take. Call option gives a holder right to buy the underlying asset, right to buy the dollar. Underlying asset in case of currency option is currency, nothing but exchange currency. Now currency is what? Here currency is Canadian dollar, foreign currency is Canadian dollar. Hence you want as an importer, you want to, okay, buy the foreign currency and settle the payment. So buy Canadian dollar. Now if, okay, the option is given for dollar, Canadian dollar, you will take the call option. You will take the call option. So here also call option, here also I'll take the call option. Are you all understanding? Now the important is, now you understood that you will take the call option, which means I'll take the call option. I will, the 10 lakh 10,000 is there now. For that, I will take July call option. For this 7 lakh 5,000, I'll take September call option, which means July for contract, I'll take 20 contracts. For September call option, I'll take 14 contracts. Are you all understanding what I'm trying to say? So here is that. Sorry. See, for 94 cents, okay, this is the premium for the call option. Now you forget about put option. Okay, I don't care about the put option. Forget about it. Call option only you are buying. July call, September call. Okay, for July call option, this is the premium, 94 cents. This is the premium. For 95 cents, what is the premium? This is not applicable. This is 1.64. So these are the two premiums relevant for July call option for 94 cents, because July call option can be taken for strike price of only 94. Strike price of only 94. For the September call option, strike price can only be taken, a strike price of 95 only can be taken. Are you understanding? 3 months option means, okay, each and every contract will have its own exercise price. What do you say? The premium which you pay for the option contract will be varying because of the exercise price. Are you all understanding? Different exercise price means it will have different premium. So if I want to buy a July contract, I can only buy 94 cents, having a strike price having 94 cents, here 95 cents, agreeing for this premium 1.64%. This is all in percentage terms. Okay, now see, very simple. So 20 contracts you took, 20.2. Now the balance amount I only take in round number, 20 contracts and 14 contracts. So balance amount will be unhedged that I will take forward cover. That given in the question, unhedged portion will be covered by forward rates. Okay, now see what happens. 20 contract for July, 14 contract for September respectively. Now take July contract, September contract, covered by contracts, which means 20 is the contract size for July. 20 contracts into 50,000 per contract. 50,000 per contract. How many Canadian dollar covered? 10 lakh Canadian dollar covered. Now tell me, uncovered Canadian dollar how much? 10,000. Total exposure is 10 lakh 10,000. Adla 10,000, 10 lakhs is covered by the contract itself, covered by the option contract. Uncovered portion, I will take forward hedging. Forward rate I will multiply and find out the exposure amount. Are you all having the clarity? Now for September, for this, if I want to convert in US dollar, July option contract, call option contract. What is the strike price? Strike price is what? 94 cents, which means for $1, 94 cents, 94 US dollar cents. Okay, which means I will convert using 0.94. Okay, 10 lakhs into 0.94, 9 lakh 40,000 US dollar. It will become 9 lakh. Now, 94 cents is the exercise price. So now, yes, I will assume that I have exercised. When I will exercise? When the maturity date spot price, currency price is more than the exercise price, I will exercise. Okay, I told you in call option questions, you will the question, currency option question, you will assume that you have exercised the option. 9 lakh 40 will be my outflow. Are you all understanding? Balance 10,000 is there, na? That 0.9031, I will multiply using forward rate. I'll get the total amount as this much. Up 9 lakh 40,000, July contract is expo covered amount. 9301 uncovered amount rate, the total, okay. This is the total. How much is the total? Okay, 949. What is that? 9,003, na? So 9,49,301. This amount is total amount. This is the, okay, the exercise price. This will be the outflow. Apart from that, you have to pay premium. You will pay the premium. That is, I call it as option cost. This I call it as option cost. Very simple. This option cost how much? 50,000 Canadian dollar into 20, which means the contract value covered by the option is 10 lakhs into the 1.02 percentage. This is 0.0102 is nothing but 1.02. They have given now. This is percentage on the contract value. This is nothing premium represented in percentage terms. You multiply it with the contract value. This is the contract value. How much amount is hedged? 10 lakhs. 10 lakh into 0.012, 1.02 percentage, 0.0102, 10,200. Are you all understanding? So total comes to 9 lakh 49. This amount plus 301 plus 10,200. Total amount comes to 959, 501. Hear me out, children. Here, when you do the option question, okay, you have these transactions, correct? But apart from that, when interest rate is given in one of the question, ideally what you should do, really speaking, the premium you pay upfront. This premium will be paid upfront for the option contract. Be a premium, just like insurance premium. Insurance premium you pay during claims, or you upfront you pay. Upfront you pay, then only you will get the right to exercise the contract. Are you all understanding? So premium when you pay upfront, this amount is real outflow. It will have some opportunity cost, just like in futures where we computed the interest portion. Really speaking, the option premium, the interest on option premium should also be considered. Really speaking, the interest on option premium should also be considered. In this case, not considered, but wherever interest rate given in the respective country, you will consider. They have considered, or you just can put a note that interest on option premium also can be considered. Like this, you can put a note, because institute have also in one of the question, they did not consider the interest rate, even though interest rate is given, but they have given a note. Okay, note is given that, okay, even though interest rate is given, they told that they are not even interest rate can be considered, even interest on premium can be considered. Note is given. Anyway, that you can also do. Okay, if you don't have time, just give the note at least. Are you all understanding? So 10,200. This is the total payable amount. You will see, okay, what is the total payable amount in case of September call option. Now we can move on to September call option. See what happens in case of September call option. Okay, what is the hedged portion? 7 lakhs. Why? See, for 50,000 into how many contracts? 14 contracts. Remember, okay, for September it is 14 contract, 14 into 50,000, 7 lakhs. Unhedged portion 7 lakh 5,000. The total unhedged portion is 5,000. This 7 lakhs, what is the strike price? So you see, very simple. What is the strike price? September futures, what is the strike price? 95 cents. So 7 lakhs into 9.95. Are you all getting this? 6 lakh 65? Yeah, okay, 6 lakh 65,000. And 5,000 unhedged. What will you do? Okay, just change it to the spot price. You will convert it, balance at the spot rate. Now, how much is the total amount? Okay, this is the total amount, and premium. This is also to be paid. Premium also to be paid. Now you will add all these are payments. You add the premium amount. How much is that? Canadian dollar 50,000 into 14 contract. Total contract value into 1.64 percentage. Okay, you will get the premium amount. Total outflow comes to 6,81,158. Now see here what happens. See, 9,59,501, 6,81,158. You see, this is the outflow under option hedging method. This is for July, this is for September. You see the forward cover, which is having a least dollar outflow. This is having dollar outflow 9,39 and 6,59. Okay, this is having 9,59 and 6,89, which means forward cover is the better cover. Okay, better option. As the firm is stated as risk covers and the money due to be paid is certain, a fixed forward contract is better. Forward contract being the cheapest alternative would be recommended. Are you all understanding? So now one line summary, currency options, how you should decide. You should see, very simple. In the future, if you are an exporter, you will have receivable. You want to sell the foreign currency. If you want to sell the foreign currency, take put option. If you are having payables, if you are an importer, if you are having payables, what will you do? Okay, buy call option. You take the call option. Are you understanding here? One more thing. Here there is no possibility of selling put option or selling call option. You will never become writer of the call or writer of the put. Okay, you will become the buyer of call option or put option. So that complication is not there at least. Okay. Next, forward versus currency options. Okay. Again, I am not discussing fully this question. I'll tell you how to think about it. For practice, we will do one thing. See here. Indian firm given. Domicile is India. Japanese yen payable or receivable? Payable. So very simple. Indian firm, Japanese yen payable. Okay, which means you will buy dollar, you buy Japanese yen, buy foreign currency in the future. If you want to buy foreign currency, call option you will consider. Call option you will consider. Provided the quote is given for Japanese yen. The option quote is given for Japanese yen. Yen, okay, dollar yen option you will buy yen option, call option. But problem is, see what is the rate given. Spot rate 1.9516 per, see, Japanese yen per INR. Sadly, in India, it is not a quote for Japanese yen, it is a quote for INR. Hence, it is indirect quote. Which means as an importer, when you have foreign currency payable, you will generally take call option. Okay, why? Right to buy, you will buy the what? Foreign currency, Japanese yen. But here, rupee option is given. So what you should do? Sell rupee option. Are you all understanding? Sell rupee option. Sell option. What is the sell option? Put option. Buy put option. That is the understanding. Shall I proceed? Okay, like this you need to sing. Baki, all the other things remain same. So call option also given to confuse you. This call option given to confuse you. Put option premium is only to be taken. These are all premium. Okay, this is prices for Forex currency option. Option price means what is the meaning? Premium. Option valuation model you just said. Option value, option price is nothing but premium. This is the premium which you need to pay. So this is what is the, this is strike price. This is premium. So 0.098 means, okay, what is the understanding? 0.098. This is okay. Option premium 0.098. Okay. Now option cover is there. Yes, this is the strike price. 2.125 is the strike price. Okay, that will become the exercise price. Premium is there. Can you see the premium? Okay, this is the premium. 0.098 you will find. Total option value is 2,25,294. Okay. Now, shall I explain this question? I think it's a little bit complicated. Okay, I'll just explain this briefly. See, forward cover, no need. 3 months forward cover is there. 1.9726. Since it's the entire quote, you will take 1.9726. See, very simple. Now, the forward itself, think like this. What is the forward rate? Yes, 5 lakh payable. You want to buy Japanese yen to settle the payable. If you want to buy Japanese yen, what will you do? Okay, rupee quotation is given. Rupee quotation is given. Okay, if you want to buy Japanese yen, generally you will take off a rate if you are given direct quote. It is indirect quote. Now what rate? Let me check what rate. Okay, this 1.5995. Say what is that? Is 3 months first. Okay. Option forward cover. Okay, forward cover. Now, which rate you will take? Okay, if direct quote is given, you will buy at offer rate, but this is bid rate. So 1 divided by 1.9726. 1 by 1.9726 into, okay, this amount, whatever is the exposure amount, 5 lakhs. Okay, you will get 5 lakhs into 1 by 1.9726. Okay, this you will get as 2,53,500. This is the payment under forward cover. Now come to option cover. Option cover, to purchase 5 lakh Japanese yen. Okay, he will enter to put option at strike price of 2.125 INR, because put option strike, yes, anyway, strike price is same for call and put here. Anyway, the previous question it was different. It may vary. Okay, in this case it is same, but anyway, strike price is 2.125. 2.125. Okay, now 2.125 per INR. Accordingly, what is the outflow in INR? Very simple. 5 lakh the yen, Japanese yen, divided by 2.125, you will assume that option is exercised. You will assume the option is exercised. Exercise price will become your outflow. So how much is the rupee outflow? 2,25,294 really you need to pay. Apart from that, premium is there. That also you will pay. How much is the premium? Okay, 2,25,294. This is in INR into 0.098 when you convert. What will happen? This will be the premium amount. How much is the premium amount? It will be in Japanese yen. How much is that? 2,25,294 into 0.098. How much is the amount? 22,078. 22,078. This will become yen. This will become in yen. Now again you need to convert in rupee. Now what you should do? Divided by 1.9518. Sir, why you took 1.9518? This is spot rate. This is spot rate. When you want to convert the premium amount, you should convert using spot rate because premium is paid at the beginning of the year, which means beginning of the transaction. Premium is paid at initial day. Okay, which means the spot rate should be taken for conversion. Tell me, children, what is the premium amount? Premium amount you need to pay. How much is that? 2 lakhs here. Take to the quotation itself. Premium amount is Japanese yen 0.098. The premium is given in INR or Japanese yen. Japanese yen. Are you all understanding? So Japanese yen, you have to pay premium. Okay, Japanese yen 0.098 per INR. Per INR. Are you all understanding? So for every INR, this much is the Japanese yen you need to pay. So for how much total contract value is 2,25,294. For this much, how much in Japanese yen you need to pay into 0.098? How much it is coming? 25 into 0.098. That 22,078. Okay, 22,078. Okay, 9 rounding off. This is yen. This is in yen amount of premium. This quote is indirect quote. This quote is indirect quote. Okay, you want to, what do you want to do? You want to sell yen, you want to buy yen, you want to buy yen to pay premium. Generally, premium you paid in yen, you want to buy the yen, which means sell the rupee, buy the yen. Sell the rupee and buy the yen. If you want to buy the yen, quote is direct now. What rate you will take? Offer rate. But quote is for rupee. Okay, you want to buy the yen. What rate you will take? Okay, bid rate. Okay, 1 by offer, which is what effectively 1.9516. Okay, or this will be converted into 1.95, 1 divided by 1.9516 into this amount. How much is the amount? 22,078. This you calculate. Divided by 0.951 to 11,313. Are you all comfortable? Okay, this is 15 now. 18 is printing mistake. I think this is printing mistake. Okay, 1519. This, I think the error is there. See, either this should be, see, 1 second. Yes, either this should be 18 or that should be 18. Okay, I think this, make it as 18. Okay, 1.9518. Since the outflow is correctly coming, if you do 1.1518, answer is telling. See, 22,079 divided by 1.9518. 11,001. Okay, how they are getting 11,815? I don't know. Okay, anyway, so this is also mistake. 315 or 315. It should be 315. Okay, the total, the small typographical error. I think the 8, it is 3 and it is typed as 8. Okay, you can go through. Okay, that is the total. So which means outflow, I will have the strike price as outflow. Apart from that, premium, the amount premium you will pay in Japanese yen, but converted to INR, this is the converted amount in terms of rupee. This will be a total rupee outflow under options contract. Okay. Okay, the last question you can simply go through, just given for understanding. Here, I have given you to make you understand that in under option, see, just to call option you take, what they say, interest on premium. They have considered the interest on premium apart from the outflow. So they have taken the expected value, and apart from that, the strike price they have considered. Apart from that, they've also taken the interest value, okay, interest portion. Here 660 interest, this 5.5% interest into 12,000 total amount. Okay, and for respective months, this is 3 months contract. Now 3 months interest will be considered, 660 will be the interest. Are you all understanding? Go through the question, you will understand. So outflow, option outflow, there will be 3 things. One is exercise price, other option, the outflow under option contract will be there. Then add the premium amount, premium in terms of local currency. Okay, you will get the premium amount. Then apart from that, interest on premium will be there. Are you all understanding? In futures question, okay, there was no premium amount, which means the initial margin amount. Only interest on initial margin will be controlled. Why? The margin will be refundable margin. Yeah, margin amount is belong to you. Okay, premium is a sunk cost, which means you paid enough, gone. Premium, okay, see, insurance contract. If you pay the premium for the insurance contract, will they give you? If you have no alignment, health insurance premium you paid, will they give back the premium? They will never give back. It's a sunk cost. Are you understanding? So therefore, in option contract, premium should be considered. Premium is different from the margin money. This is the difference between currency options and currency futures. This question you can go through. Shall we move on to the next question? Okay, investment decision. 1 second, I'll just Visible? Okay. Okay. AMK Limited, an Indian-based company, has subsidiaries in US and UK. Forecast of surplus funds for the next 30 days from two subsidiaries are as follows: US dollar 12,500, UK pound 6,000. Following exchange rate is obtained. Now, what is this question? Now, investment decision. See, very simple. A company, assume multinational company, head office in US. It has branches in UK, Germany, okay, assuming Japan, etc. Like this, it will have various subsidiaries, correct? What they say is that, very simple, sometimes what they happen. Okay, either you can see what they're asking really. Okay, pooling of cash method or acting independent method. Very simple, what they say. Assume one head office US is there. It will have this UK amount will this UK branch will have some balance. This will have some cash balance. This will have some cash balance. It needs to invest. This is investment decision. What it is? Investment decision. What they say, there are two options available for the what is that, head office. It can, okay, what it can do, the head office in the sense, okay, the holding company, it has two options. What they say, you can bring the surplus UK cash, this is a pound cash. You have the, what is this, Germany, na, Deutschmark or Euro. Okay, you, at the end of the period, give all the pound to US branch, Euro to US branch, and this Japanese yen also to US branch. The US branch will deposit in US bank, US based bank. It will have some interest, it will fetch me some interest rate. That I will, this value will be there, maturity value of this investment. This is one option. This I call it as pooling of investment method. Pooling of investment method. I just bring all the cash from all the subsidiaries, pool of the fund, then I invest in my own bank, which means my country. I earn the interest income. This is one possibility. Second way of investing the cash, okay, treasury management. This is about treasury management question. Okay. What I do, I let the UK subsidiary, I let you all invest on your own, which means UK bank, there will be some pound balance. You deposit in UK based Barclays Bank or some other bank. Are you all understanding? UK based bank, you deposit. Same way, German subsidiary is there, and that subsidiary will also have surplus funds, euro. This euro also you deposit in euro based bank itself, localized bank. This also you deposit in bank. Everything you deposit on the date of maturity, you will convert. Here also there will be some euro, here also pound, here euro, here yen, correct? After the maturity period, they will be given in the question. Okay, they will give in the question 3 months or 6 months. After the maturity period, what I do, after the maturity period, I try to convert all this into US dollar by spot rate, convert the dollar into spot rate, forward rate, which means forward rate, okay, and bring it back to US. Are you all understanding? Comparatively, which option is giving me highest inflow? Deposit will have maturity, highest maturity value. I will select that option. Are you listening? So this is what is the question all about. Let us solve quickly. Following exchange rate given, okay, spot rate given, dollar per rupiah and pound per rupee they have given. Okay, now Indian based company. Okay, this is Indian based company and has subsidiary in US and UK. So Indian company, US subsidiary, UK subsidiary. So this is Indian company. Okay, it has US based subsidiary and UK based subsidiary. Got it? Now spot rate is given, exchange for rupee. Okay, US exchange rate, UK exchange rate. Pound per rupee is also given. Dollar per rupee is also given. If you note, in India, all these are indirect quote. Okay, pound per rupee, rupee per pound. 0.0215, all these are given. Okay, annual borrowing deposit rate, rupee deposit rate, dollar deposit rate, pound deposit rate. Now, that also borrowing deposit. Higher rate will be borrowing rate, lower rate will be deposit rate. Okay, I would ideally prefer it to be 6.2% and 6.4%, and I will call it as deposit rate, borrowing rate. That would be the quotation given. Anyway, this is given inversely. 6.4 is the borrowing rate, deposit rate is 6.2. Okay, 1.6, 1.5, 390.3. Now, Indian operations forecasting cash deficit of 5 lakh. Indian operation forecasting cash. It is assumed that interest rates are based on year of 360 days. That is the interest rate you have to take. Okay, shall we? Now, calculate the cash balance at the end of 30 days period in rupee, because Indian company ultimately will find out. For each company under each of the following scenario, ignoring transaction cost, each company finances its own cash balances deficit in local currency independently. Cash balance are pooled immediately in India and the net balance are invested or borrowed for the 30-day period. Are you understanding? First option, what I say, you, all these companies, UK and US based subsidiary, you invest on your own. I leave you alone. Okay. And on the maturity date, I will convert using forward rate and convert it into rupee. That is for first option. Second, B, what they are asking. All the cash balance of US and UK will be pooled immediately, will be clubbed and will be converted. UK based will be converted using UK based rate, spot rate. US based cash balance will be converted into US based spot rate, which means dollar per rupee. I will convert it. I will make it in INR. Then I will make the Indian bank deposit. I'll make the deposit in Indian bank. Then I'll find the maturity. These are two options. Just to compare it, whichever is giving you highest inflow, you will select that. Which method do you think is preferable from the parent company's point of view? Shall we say acting independently? What do you say? Acting independently. Now, Indian company has minus 5 lakhs. Minus 5 lakhs because cash deficit. Now, OD. Assume it to be overdraft. 5 lakhs cash deficit. Interest you have to pay. You will receive you have to pay interest. Are you all comfortable? Which means very simple. 5 lakh is there. How much is the 30 days period? Borrowed for the 30 days period. See, tell me, this is 360 days assumed. Okay, interest. See, in India, borrowing rate, you have to pay interest because of the OD balance. Okay, you don't have a surplus cash so that you will receive. You have to pay. If you have to pay, how much you have to pay? 6.4%. So, into 6.4%, much 32,000. This 32,000 is for whole year, which means into 30 by, I will do the amount 2,666. Are you all getting this? This 2,666 negative. Why? Because negative interest you have to pay. So total 5 lakhs already you have to pay plus interest portion minus 5 lakh 2,667. In 30 days, this is will be the amount 5 lakh 2,666. Next, US. Okay, acting independently na 12,500. US, if you deposit the surplus in US, I should take rupee interest or dollar interest and dollar interest. How much is the dollar interest rate? See here. Dollar interest rate is given. Okay, dollar deposit rate to 1.5%. That only you should take because surplus, no borrowing, this is surplus. So 1.5% you will consider. There we consider 6.4, here 1.5. You tell me children, 1.5%. Now what is the amount to be deposited here? What is the surplus? 12,500 into what is the rate? 5%. What is that? 1.5%. 1.5% into 30 by 360. Are you all getting 12,500 into 1.5%? 30 divided by 360. I get 15.63. 625 rounded off to 15.63. Total 12,500 plus 15.63. 12,515.33. Conversion. This is okay. This total will be what? In US dollar. This I need to convert. For conversion, I'll use spot rate. Forward rate. 0.0217 is forward rate. Are you all understanding? The forward rate I'll use because the conversion will happen after 30. You deposit in your bank. After 30 days, I will convert. Okay, this is what is happening. Next, come to the third one. UK based company 6,000. It will have 18.5. UK deposit rate you should consider. What rate you should consider? Pound deposit rate. What is the pound deposit rate? Lower rate 3.7%. Can you calculate this? Okay, 6,000 into 6,000 into what is the which is the rate? 3.7. 3.7% into 30 by 360. 18.5. You're getting the 18.5. Yes. Okay. 6,000, 18.5. Now, this is 12,515.63 US dollar. I need to convert. I take this. Again, this is pound. I need to convert. I'll convert everything. And in INR, what is the total? Minus up Indian head office negative balance. There we have surplus in US and UK. You add it in terms of INR. This is the total maturity value of my deposit. Maturity value of deposit in the sense, okay, here I am not depositing US dollar, I am depositing in their own country. Later on, I am converting. Are you listening? This is acting independently option, which means I leave the autonomy to the branch, okay, the subsidiaries. Immediate cash pooling system, what I do, I'll tell you don't need to do anything. Okay, just give me the money. So US dollar 12,500, UK dollar surplus there na. I convert using spot rate. Respective spot rate. What I will get? Okay, this is the total amount. Then I will get the total amount as what? Minus 5 lakh plus 5 lakh 81 plus 4 lakh 2,680. Will get you 4 lakh 84,080. Yeah. This you convert today. This is the spot. What I will do? I'll put it in pocket. I'll deposit in bank. I'll deposit in bank for what rate? Okay, local rupee interest deposit rate, which is 6.2% for 30 days. I'll earn an interest of 2,501. Total along with the principal along with the interest comes to 4,86,581. Which option is preferable? You tell me. Surplus cash. Na cash balance should be highest in which option? This option. So pooling of interest method is better. Immediate cash pooling is preferable as it maximizes the interest earnings. Are you all understanding? This is all about question number 60. Next. Okay, question number 61. Same way, can you try it on your own? Okay, spot rate given, bid rate and offer rate. Here also the same drill. 91 days points, swap points is given. And see, here spot rate, swap points. You already know how to compute forward rate. Same way here also spot rate, swap points. Like this, they have given for, okay, Czech francs. Okay, here also they have given, and interest rate for the deposits is given, amount of currency, 91 days interest rate. You can go through similar question I've given for practice. Both this question, any one question can be tested, I feel. That is why I've given. Okay, here also individual basis, you will see what is this, Amsterdam, okay, Swiss franc, and you have UK based brank. Okay, next swap to sterling. Okay, independent GDP amount just much. Okay, this is Czech franc. This is the total in terms of Great Britain, because the country origin is what is the country is based on UK. The XYZ PLC is in UK. Are you understanding? UK based company, pound realized, just like we did in India. Okay, here you do. Okay, swap GDP 91 days. This much is this, and you convert in sterling. I get the this is 10 lakh 13,000. This is 10 lakh 10,000. Which is the good option? Whichever is giving you highest. Okay, this individual basis. Okay, this is the correct option. 10 lakh 13. So 10 lakh 13,674, which means pooling of interest, immediately pooling is a better option, I feel. Okay, this is what is given. And you go through the question. Okay, not discussing because lack of time. We need to cover a lot of things. The same ditto question, you can go through. Either one of these questions will be asked. Only be careful about the bid and offer rate while you convert. That is the only adjustment. Apart from that, one more thing is that they're given 91 days interest rate per annum. Sir, what is this? Given 91 days, then again per annum, not like this. Even if they don't mention this per annum, it always means per annum. You are understanding? 91 days interest rate per annum they have mentioned, which means this is the 91 days interest. This is per annum annualized interest rate. If you want to say, for example, pound interest rate is given. If it more than 5 lakh up to 10 lakh, interest rate will be 4%. Okay, all these are in percentage terms. Okay, the 1.5%. Okay, 1.5% here. Okay, 1/4 percentage. All these are in percentage terms. Now, say, tell me. 4% means it is 4% per annum. If you want to convert into respective period into 91 days and 360 days, you should assume. So 91 divided by 360. Okay, wherever they have given the date correctly, you should take that date only from the question. If not given, you will assume it to be 365 or 3 based on the situation. You will assume. Okay, 91 divided by 360 only you should do. So what I will get? 4 into 91 divided by 365. I'll get 0.972% or 0.99%. Are you all having the clarity? Like this, you should solve. Okay, convert it for 91 days and then solve, because interest will be annualized. Can you do it? Okay, next. Question number 62. I think this is the last question in Forex. Okay, we'll try to cover it. Last question. Okay, question number 62. A Limited currently operates from 4 different buildings and wants to consolidate its operations, which is expected to cost 90 crores. Board of K Limited had approved the above plan, to avail an external commercial borrowing, Great Britain bond 10. The following: the loan will be availed on 1st April 2022, just payable on half-yearly rest, 6 months. Average loan maturity life will be 3.4 years. This topic is miscellaneous. 3.4 years with an overall tenure of upfront fee of 1.2%. Then interest cost is a Great Britain 0.6 or plus of 2.3%. The 6 months LIBOR is expected to be 1.5. A Limited also entered into INR hedge at 1 GBP INR 9. The forward rate entered for the exposure on account of the above loan, and cost of the hedge is coming 4% per annum. Hence 4. As a finance manager, given the above information, taking the 1 GBP exchange rate as this. First, calculate the overall cost both in percentage terms and an annual basis. annual cost in terms of percentage, and very simple. You tell me what is the interest cost? Okay, LIBOR of 6 months LIBOR plus 2.5%. LIBOR is how much? 1.05. 0.05% plus 2.5, 3.55%. The cost of the real cost of the borrowing. What is that? Calculation of overall cost. Interest margin is how much? 3.55. 1.05% plus and what? 5, yeah. 5%. Next, hedging cost 4%. This is the cost which you need to borrow. The 4% is the hedging cost, because when you borrow, okay, and you hedge, this is the total 1.55% in terms of percent. Okay. Now, this is not the only cost. What will happen? You have this 1.2 percentage cost. 0.2 percentage. Okay. See here, upfront fee you have to pay to the extent of 1.2. This upfront fee which you are paying to loan will be amount of the 3.4 years now. Yes, it will be 3.4 years. This amount is the upfront fee of 1.2. So originally 7.55 will be there. Apart from that, upfront fee also should be there. There is also, okay, the cost is incurred due to the borrowing. So 1.2 I'll amortize over a period of 3.4 years. What will be the yearly? The 1.2 divided by 3.4. Okay, it comes 0.35. So 7.55 plus 0.3, 7.9 is the overall, which means annual overall cost in terms of percentage, in terms of annual percentage. Are you all understanding now? What is the overall cost in rupee terms? That also they have asked. First part, what they have asked, calculate the overall cost both in percentage terms and rupee terms on an annual basis. Rupee terms, how to find out? Very simple. What is the borrowing amount? 100 lakhs, 100 into 7.9% is a cost. That 711. Understanding, this is the 711 lakhs in terms of rupees. Okay, what is that? No, into, see, this is, that is okay. This is at 1 GB pound 90 rupees. See what is happening. Tax, the calculator. Tax is there. This is the Great Britain pound. 100 lakhs. Great Britain. The 10 million is nothing but 100. This is 10 million Great Britain pound. GBP. If you write in Indian rupees, it is 100 lakhs. Okay, 10 million. Agreed. This 10 million, if you want to convert it in INR, what is the rate? 90 rupees you want to convert. Correct? Into cost of hedging, 7.9%. 100 lakhs in 10%. 711 lakhs. 711 lakhs. Understand? How you need to do this? 711 lakhs. Okay, overall cost of rupee. Now, next, what they're asking. What is the cost of hedging in terms of rupees? Now, cost of hedging in terms of percentage comes to 4%. Very simple. What is the exposure amount? 100 lakhs into 90. Conversion rate, you should take as 90 they have given. Okay, into 4%. So 360 lakhs is the hedging, okay, cost, annual hedging cost. Now, this is annual hedging cost. Why? Because I've taken 4% annual hedging rate and I applied it to this amount. I got the annual hedging. If you want to calculate that overall total hedging cost for this period, 0.4 years is the borrowing period for which I need to take hedge. 3.4 into 360 lakhs comes to, see here, lakhs into 3.4. Yes, 3.4 years it comes to total. What is the cost? 12 crore 24 lakh, 4 lakh rupees. Last, what is they asking? If K Limited wants to pursue an aggressive approach, what is this aggressive approach? Very simple. No hedge approach. Hedge approach. See, if you hedge the position, you are taking a defensive position. You don't want to keep the position open. Hedge. You don't want to keep the position open. You go for hedging. This is conservative approach, which means you are not care about the loss incurred by the hedging. Sometimes by doing hedging, you don't know what will be. Maybe incurring loss also. But I don't want uncertainty. That is why I go for hedging. That is conservative approach. Aggressive approach means I not at all hedge. Are you understanding? I leave my position open. Okay, God will take care. Whatever happen, exchange rate will. Okay, what would be the net gain or loss for K Limited if INR depreciates or appreciates? Both are options. INR depreciates against GGB or INR depreciates by against GBP by 10% at the end of 5 years, assuming the loan period is repaid in the GBP at the end of 5 years. Are you understanding what they're saying? Yes. Now you have calculated all the hedge calculations of what I do. Okay, you take no hedge position, you take no hedge option, don't hedge at all, then calculate what is the cash outflow or inflow if INR depreciates, if INR appreciates. Both the cases you need to calculate. Okay, ignore time value and taxation, calculate to 2 decimals. Anyway, now see. First, okay, see what happens if K Limited pursue an aggressive approach, then gain or loss in INR depreciation application shall be computed as follows. If INR depreciates by 10%, very simple. If INR depreciates by 10%, what will happen? See, you hold loss per Great Britain pound is how much? 90 was the exchange rate earlier. If INR depreciates, you tell me what will happen? Okay, the 90 rupees which you had, the exchange rate, it will increase, decrease, 1 GBP is equal to 90 rupees. Earlier it was 90 rupees. Now tell me, if INR depreciates, what is the understanding? You tell me. It will require more GBP, which means 10%. 9%, 99. 90 plus 10 per 110%. 90 into 110. 90 110%. How much is that? 99. Upon 1 GBP will become 99 rupees. If 1 GBP becomes 99 rupees, then you need to repay the loan amount. Very simple. If you have taken GBP loan of 100 lakhs, okay, which means 100 lakhs pound, what will happen? Okay, there will be loss per pound. How much? 9 rupees. Loss per pound, 9 rupees. Why? Okay, you have to, very simple, you have to pay how much? Great Britain pound, 10 million. If you have to pay Great Britain 10 million, for every 1 pound, 9 rupees is the increase. Now, total 10 million pound. What is the increase? 90 million extra you need to pay. Extra you need to pay as repayment, which means loss. Are you understanding? If that is it. Less savings in cost of hedging. But this is, yes, if I don't hedge, since the spot market, the currency depreciates, rupee depreciates, INR depreciates, hence I need to pay extra 90 million. That is fine. But you will avoid the hedging cost. You did the hedging. Okay, you had the cost saved. Now you don't do the hedging, you will incur the loss in the spot market. Yes, I will incur the loss, but I will save also the hedging. I don't need to take, I did not take a hedge, hence I saved. How much I saved earlier, whatever I computed, what was the cost of hedging? Very simple. You see, cost of hedging, total cost of hedging given 122.4. Yes, this. Okay, 12 crore, 24 lakhs I save. This I will add. You're understanding? 122.4 million I will save. So therefore, you tell me, children, if INR depreciates by 10%, I will have savings, I will have loss, net savings, net cost, net savings, net gain, because I lose from the currency depreciation, but I'll gain from non-hedge. Hedging cost is more than the profit. Okay, the hedging cost is more than the profit. Hence, if I don't hedge, I will get the gain of 32.4. Are you all understanding in terms of rupee? So this is nothing but 324 lakhs, so 3.24 crore. Okay, I can also. Next, if INR appreciates by 10%, you tell me what will be the exchange rate? Very simple. If INR appreciates by 10%, really speaking, what will happen? 1 GBP is equal to 90 was there earlier. Okay, 90 into 90%. Why appreciates by 10%? It will be reduced. So less amount of INR you require to purchase a GBP, Great Britain pound. How much will be that? 81. So again, the gain per INR will be 9 rupees. The gain per INR will be 9 rupees. Total gain upon repayment is 90 million. But add a savings in cost. Add a savings in cost of hedging. Very simple. Apart from that, this is 90 million gain. Apart from that, you don't take any hedging. If you don't hedge, okay, you will also save this 122.4 crore. Million, which means 12.24 crores. Hence total 12 plus 9, 12 plus 90 million. Okay, how much is that? 12.4 million. This is the total gain. My gain will be magnified. But if the problem is not rupee appreciation or depreciation alone, there might be a different situation also here possible, but they have asked say 10%, they have asked us to compute. Hence, okay, we are getting this. Okay, whatever they have asked, we have computed net gain. Are you all understanding? And okay, therefore, it is recommended not to hedge at all. It is recommended not to hedge at all in this case, if the gain will be 10%. But the beauty, What will be the gain? You don't know, na? That is the beauty. Uncertainty is the beauty. Are you understanding? So hedging always, okay, if you do hedging now, you can be peaceful. I know what is the real outflow. My cash flow will be certain. But if you don't take hedge, I don't know what will be the outcome. Are you understanding? Okay, with this, we are through with the chapter Forex exposure and risk management. Now we'll start with a new chapter, International Financial Management. Even though I can call it as a Forex, just like your portfolio management and mutual fund, these are inextricably linked, which means mutual fund is an extension of portfolio management. Same way here also, international financial management, this chapter is just an extension of the Forex exposure. Okay, more or less everything will be same apart from few adjustments here. Okay, we'll solve one question here. Incidentally, we'll solve this. Okay, while we're discussing this question, I explain one concept. See, right, before that, I don't need to explain the concept. First, I'll explain the concept, then I will go to the question. See, what I'll do, there is a segment called as International Capital Budgeting, or Overseas Capital Budgeting. See, very simple. What you did in the local capital budgeting, till now you learned that capital budgeting, NPV is what ultimately you need to compute. NPV is equal to discounted cash inflow minus discounted cash outflow. Here you computed NPV, first cash flows will be given. Okay, that you discount and bring it to present value terms, reduce the discounted cash outflow, you'll get the NPV. If NPV is positive, invest in the project or accept the project. NPV negative, to reject the project. This is how you do the capital budgeting decision. Now we have international capital budgeting, which means assume the Reliance Limited company, Indian company, wants to invest in US, and it wants to evaluate a US-based project. I need to find NPV. Very simple. Here you tell me, a US-based project, I undertake the project by paying 50 lakhs or 50,000 USD. This is my cash outflow. Like this, okay, cash outflow will be there. Inflow will also be year 1, 2, 3, 4, 5. Inflow will be there, na? This inflow will be also in USD. Are you all understanding why the project is undertaken in US, na? Other country, na? The inflow will be the US dollar, correct? There will be inflows in US dollar. Outflow will also be in US dollar. Are you all understanding? You need to find the NPV. How to find an NPV? Okay, of a project abroad, of a project undertaken abroad. Are you all understanding? Is the subject matter of discussion. Very simple. We have two approaches. I call it as home currency approach and foreign currency approach. Okay, the international capital budgeting, overseas capital budgeting, overseas capital budgeting. I have two approaches. One is foreign currency approach. Then there is local currency approach or home currency approach. Currency approach. Are you understanding what is happening? Tell me, children. Foreign currency approach. Look, what I will do. Very simple. You invest in foreign currency. Okay, this is the easiest approach. What you do, I'll tell you. You will have year 0, 1, 2, 3, 4. Okay, 1, 2, 3, 4. You will have inflows, series of inflows. Now you tell me, for any US-based project, inflow will be in USD. So year 1, 2, 3, 4. Assume there is a 4-year project. Total you will get in USD. Yes. So here cash flow will be there in USD. Present value factor, when you discount these cash flows, use the dollar cost of capital. I call it as dollar cost of capital, which means foreign countries cost of capital you will use. Discount the cash flows at foreign currency cost of capital. Arrive at present value of this discounted cash flow. Are you all understanding? This will be total will be in USD. So discounted cash inflow, present value of all the future cash flows will be in USD. Are you understanding? Minus discounted cash outflow. Okay, in USD, you will find out NPV in USD. First in a NPV in US dollar itself. Are you all understanding? Now, this NPV is a present value. This is nothing but present value. Agreed? If you use this, you get the USD, discounted cash inflow, outflow also USD. Okay, net present value you found out. What do you do? Convert into spot rate. Convert using spot rates. Convert this NPV using spot rate. You will get rupee NPV, rupee equivalent NPV. Are you all understanding? This I call it as foreign currency approach. Simple and straightforward approach. Are you all understanding? Next, I'll come back to home currency approach. Very interesting. See what happens. Under home currency approach, what I do? The year cash flow present value factor at okay, some rate, discounting rate, and the present value or PV of the cash flow, present value of this cash flow. Agreed up. Here what I say, PV or discounted cash flow. See, here what I say, year 1, 2, 3, 4, assume 4-year project is there. Cash flow will be in USD. Agreed. This cash flow originally will be USD. Na? Convert the respective year's cash flow. Convert the respective year's cash flow. I convert it into Indian rupees. Okay, I convert into INR. Sir, year 1 cash flow, how I convert in INR? Forward rate. Forward rate. Are you all understanding? So first year forward rate I will use to convert the first year cash flow. Second year forward rate I use to convert the second year cash flow. Like this, every year I convert the USD cash flows into INR cash flows using forward rate. Sir, forward rate, which forward you will take? Quoted forward or today quoted forward rates will be given on? No, IRPT forward. Interest rate parity forward. You already know how to compute IRPT. We did a lot of question, correct? IRPT forward rate, which means spot into 1 plus interest rate of home currency divided by 1 plus interest rate of foreign currency. This you will apply this formula and find out spot forward rate for first year, second year, third year, fourth year. Are you understanding, sir? 1 year I know how to find it. For 2, 3, and 4 years, how should I find? Very simple. How should I find spot into 1 plus interest rate of home currency? Okay, the whole square divided by 1 plus interest rate of foreign currency, the whole square will give you second year forward rate. Are you all understanding? Third year forward rate, spot into 1 plus interest rate raised to the power 3 divided by 1 plus interest rate of foreign currency raised to the power 3. Fourth year 4 raised to the power 4. Like this you will find out. Or simply, first year you have spot rate. From spot you find out the first year forward rate, this one. From here, again you use this one from this forward rate. So spot, you replace it with first year forward into 1 plus interest rate of home currency divided by 1 plus interest rate of foreign currency. No need to, okay, take two square and all. You just do this 1 plus interest rate of home currency plus foreign currency. You will get the second year forward. Second year forward, put it as spot rate. So second year forward into 1 plus interest rate of home currency divided by 1 plus interest rate of foreign currency. You will get third year forward. Like this, you convert the US dollar cash flows into INR cash flows using IRPT forward, trade parity forward, pair forward. Are you understanding? Now, discount the cash flows using what rate? Discount the cash flows using, okay, Indian cost of capital or local cost of capital or home currency cost of home country cost of capital. Are you all understanding? Earlier, foreign currency approach, you used a foreign currency cost of capital. Here, home currency cost of capital, you will convert and use. Are you all understanding? It depends on question how they are asking. You need to convert the data, right? Sir, how to convert foreign currency cost of capital to home currency cost of capital? Question arises, na? Okay, they will mention. Are you all understanding? They will give you the data. They will give you should convert. Either conversion, like what? Okay, international Fisher effect also you can take it. 1 plus real rate. Okay, well, the 1 plus nominal rate is equal to 1 plus real rate plus 1 plus inflation rate, like this. Okay, the project rate risk factor will be given. The risk of the project will be given. That you can consider and find out. We'll see in the question. Okay, 1 plus nominal rate is equal to 1 plus real rate plus interest rate into 1 plus interest rate. This you will find out. Okay, using this is called as international Fisher effect. Using this we can find out, okay, how to find the localized cost of capital. Mostly will be given in the question. Are you all understanding? Now, next, present value we will find out the total NPV or discounted cash inflow. You tell me discounted cash inflow you will get in what? INR. Get it in INR. This is discounted cash inflow. Discounted cash inflow minus discounted cash outflow. How you will find? You need to convert again dollar today water using spot rate. Using spot rate. I mean, the inflows you converted using forward rate, IRPT forward, because those are happening over a period of time. First year and second year and third year, time value of money. Okay, you cannot use the spot rate. Here you should convert it using spot rate. Why? Discounted cash outflow happens initial outlay happens year 0 today itself. So convert it using spot rate. Get the NPV. NPV in INR straight away. Are you all understanding? Okay, this is how we need to solve. Shall we solve the question? Okay, one or two questions if you solve, we will easily understand. XY is XY limited. This question may be asked. This question and another Nepal-based question too. So then you study that. Both are important. You can go through that question. You understand. This is a little bit complicated. Hence, I took this. Anyway, XY Limited is engaged in retail, large retail business in India. It is contemplating for expansion into country of Africa by acquiring a group of stores having the same line of operation in that of India. The exchange rate for the currency of the proposed African country is extremely volatile. Rate of interest is presently 40% per year, which means Africa's rate of interest is 40%. Inflation in India is currently 10%. Inflation given. Okay, see, very simple. I told you use the IRPT forward for what is that? IRPT forward for finding the converting the USD cash flows into INR. Under home currency approach, what do you do? Okay, either you use IRPT forward, or if inflation data given, interest rate given, IRPT forward, inflation data given, what you will do? You will use PP, purchasing power parity forward, purchase PPT theorem, or your PPP theorem, or your understanding. Using PPPT, you will convert this. What is the exchange rate? Okay, next, inflation in India is currently 10% a year. Management of XY Limited expects these likely to continue for the foreseeable future. Every year the inflation will be in Africa will be 40%, in India will be 10%. That is the understanding. Estimated projected cash flows in real terms in India as well as in African country for the first 3 years of the project are as follows. Very simple. Year 0, 1, 2, 3 in India, which means the project is also undertaken in India. Simultaneously, the project is also undertaken in US. Okay, both we have to consider and find out the cumulative NPV. Are you understanding? Both will be done. So cash flows in India in terms of rupees 50,000, 1,500, 2,000 and 2,500. Anyway, next, cash flows in African rand. Okay, 2 lakhs minus 2 lakhs is outflow initially. Then for first year 50,000, 70,000 and 90,000. XY Limited assumes the 3 nominal cash flows will continue to be earned each year indefinitely, which means this is year 1 cash flow, year 2 cash flow, year 3 cash flow. Okay. This year 3 nominal cash flow, what they say, assumes the year 3 nominal cash flow. What is the year 3 cash flow? 90,000. Okay, this will continue forever, which means I don't know what will happen for first 2 years, but I know that whatever is the cash flow, okay, at the end of the 3rd year, that will continue for the 4th, 5th, 6th, like this. It will continue till infinity. Are you understanding? This is what is given. Why? Very simple. They will use to value the entire project. Okay, present value of future cash flow counted using dividend discount model. I believe that is the case. We will see that. It evaluates all investment using nominal cash flows and nominal discounting rate. The present exchange rate is African rand 6 to 1. Okay, 6 to 1. Now, one more concept is involved. I'll explain before starting this. Okay, this is the exchange rate given. You are required to calculate the net present value, NPV of the proposed investment. Considering the following: African rand cash flows are converted into rupees and discounted at risk adjusted rate, which means, what is the approach they are using? See, you want to invest in Africa. They are saying, if you find out NPV in foreign currency approach and convert it to USD using spot rate, it will be foreign currency approach. But they want you to test the harder thing. They want you to do this under home currency approach. What you should do, every year African rand cash flows will be in African rand. Convert it using PPT, purchasing power parity forward. Convert it using the purchasing power forward. Okay, then you will get into rupees. Thereafter, rupee discounted, okay, risk adjusted discount rate you will consider, cost of capital of Indian rupee, consider and discount the cash flows, find out the NPV. Are you understanding? To put it simply, NPV under home currency approach they are testing. Next, all cash flows for these projects will be discounted at rate of 20%, reflects his high risk. So given straight away given, okay, if nothing told specifically, now you will assume that, okay, it is given for the country, okay, home currency, which means the 20% rate is not African discounting rate, it is Indian discounting rate. Indian cost of capital, you will take 20. Ignore taxation. Present value factor also given as 20%. This is given. Okay, that itself is an indicator. What is given as present value factor will be an indicator of what rate you should use for discounting. Anyway, here you will take 20% for discounting. Can we see the solution? Before moving on to solution, one important point I'll just briefly discuss here. See, what I wanted to communicate. There are 2 types of cash flows. Real cash flows, nominal cash flow. Nominal cash flows. Okay. See, real cash flows. When the cash flows does not have any inflation element in it, I call it as real cash flow. Are you all understanding? Which means in terms of real terms, so they will say, really speaking, what is the cash flow? For example, assume there are 2. You take some books. Okay, Year 1, the book cost is 100. Year 2, the book cost is 150. Year 3, 200. Year 4, 250. Like this, it is keep on going. Are you understanding? So first year, anyway, this is certain. So this is L and will discounted cash flow. No issue. 100 is there. Value of it will be 100. Here in second year, it is 150. Now, this 150 will have some inflation element as well as the real cash flow. It will have some real cash flow as well as inflation, as well as some inflation, which means the 150, if I say this is okay, inclusive of inflation as well as the real cash flow. What I do, I remove the inflation portion, I'll get the real cash flows. Are you all understanding? Real GDP, nominal GDP, you would have studied in economics. Say nominal cash flows. Now, a cash flow which is inclusive of inflation is called as what is that? A nominal cash flow. Now, only one point. How to what is the equation? Very simple. 1 plus nominal rate is equal to 1 plus real rate into 1 plus inflation rate. This is the relationship between real rate, nominal rate, and inflation rate. It is called as international Fisher effect. To put it simply, see, nominal rate given in the question. You want inflated rate given. You want to find out real rate. How to find out? Very simple. Nominal rate given na 1 plus nominal rate will be there. Apo you want to find out real rate. So 1 plus real rate is equal to, what will you get? 1 second. I'll just show you here what happens. Nominal rate is given. You want to convert into real rate. Okay. The equation is as follows. 1 plus nominal rate is equal to 1 plus real rate into 1 plus inflation rate. Now what they say, if real rate is to be calculated, real rate they have asked, inflation rate given, nominal rate given. What you should do? Upper 1 plus real rate is equal to, what you should do? 1 plus nominal rate divided by 1 plus inflation rate. Therefore, real rate is equal to 1 plus nominal rate divided by 1 plus inflation rate minus 1. You all having the clarity. This, if you do, you will get some decimal, say 0.86. Okay, so 0.08 you are getting now. 8% is the real rate. Are you all having the clarity? This is how you will compute real rate. Now, you want to compute nominal rate. Now, what you should do? 1 plus real rate is given. Multiply it with 1 plus inflation rate. You will get 1 plus nominal rate. Correct? Now, nominal rate is equal to, this is equal to, nominal rate is equal to 1 plus real rate into 1 plus inflation rate minus 1. This, if you do, get the nominal rate. Are you all comfortable? Okay. Anyway, this all the formulas you can use. This will be used. Shall I proceed? Now you will understand the question easy. Okay. Okay. See, inflation factor in India. First they have computed. Okay, the inflation factor 1 plus interest rate, inflation rate. Now this 1 plus inflation rate only they have considered together, which means today I start with 1. Next year inflation is 10%. So 1.110. 1 into 110%. Just to multiply it, they have used a factor. Okay, you can also cash flow will be there. You can every year you can add 10% and calculate. That is not an issue. This is factor they have straight away computed. For every 1 rupee, what will be the inflation adjustment? Okay, 1 into 1.1. 1.1 into 1.1, 1.21, 1.21 into 1.1. Like that, they have added 10%. Are you all understanding inflation factor for India? Same way, inflation factor for Africa, 1 rupee you start into 140% or 1.4. Why? Africa interest rate is inflation is 40%. Indian inflation is 10%. So 1.4, then 1.96, then 2.744. 3 years inflation is given. Next, exchange rate as per PPP. Now you want exchange rate. Exchange rate, what is the exchange rate? Spot into 1 plus inflation of home currency. What is home currency for you? Very simple. What is 1 plus inflation of foreign currency? To put it simply, spot rate is there. Okay. Now you tell me this here, if you notice, the company is in India. Yes, the company is in India. Okay. The rate is African Rand to 1 rupee. So what is this? African rand divided per rupee. This is indirect quote. Indirect quote. Are you all understanding? For indirect quote, what I told you, exchange purchasing for parity, spot into 1 plus interest rate of home currency divided by 1 plus into foreign currency, provided the quote is direct. But here indirect quota, what you should do, spot into 1 plus inflation of foreign currency divided by 1 plus inflation of home currency. This if you solve, you will get this number. 6 is equal to 6 African rand, na? 6 is 6 into, okay, 1 rupee is equal to African rand 6 into 1 plus instead of foreign currency inflation is how much? 1.4, 40% divided by 1.1, 10%. Like this, you will keep on solving. So 6 into 1.4, like this, you will keep the exchange rate, you will keep on finding. See, 6 into 0.4 divided by 1.1, that's 7.6364. Now 7.6364 into 1 plus inflation of African country divided by 1 plus inflation of home currency into 1.4 divided by 1.1, that 9.7190. The third year is also required. 9.71 into 0.4 divided by 1.1, that 12.369. I just write it here, 12.369. Okay, required or not, that is a different issue. Just write it. Shall we move on? Okay, this is the inflation factor you already considered. Next, cash flows in, okay, rupees in real term, because this is African cash flow. Now I am discussing the cash flow. Now I have considered, I know the exchange rate. You can put it as separate exchange rate computation. Some question they will put it as separate working note. Okay, forward rate, exchange rate as per the PPP forward or IRPT forward, they would have computed. Okay, see the further questions in study mat, they have given that. You can also working note separately, working note you can give, or you can solve like this. Okay, now cash flows in real terms in India. See, in the question, this question they mentions you to do under nominal approach. First I will note down the real cash flow, then I will convert using the inflation adjustment. Are you understanding? So what happens? 50,000 minus 1,500 minus 2,000 minus 2,500 real terms in India. Nominal cash flow in India, how much would be there? 50,000, because today's cash flow, year 0, nominal and real will be one and same. Next year onwards only inflation comes into picture. Are you understanding? This is the real cash flow. You will add inflation. What is the inflation rate in India? 10%. So 1,500, 10% inflation rate. If you apply directly, you will get 1,160. Okay, next year again 10 more percentage. If you apply 2,420. What is the real cash flow? See, okay, 2,000. If you apply the inflation. Okay, if you apply the inflation, very simple. 2,000 is there. What happens? 2,000 into 1.1. For the first year into 1.1. Again, if you apply, how much is that? 2,420. Are you understanding? 2 years nominal, not 2 years inflation will be hidden. Okay, you should add. Next, okay, 2,500 is there. Okay, 3 years inflation, you need to do 2,500 into 1.1. That 337.5. Are you all understanding this? This is Indian cash flows in terms of nominal value. Now you need to convert the African cash flows, real cash flows, then nominal cash flow. Are you all comfortable? Now, African cash flow, real terms, 2 lakh, 50,000, 70,000, 90,000. This is in real terms. You want to convert in nominal, now apply the inflation rate. 2 lakhs real and nominal. Present year 0, nominal and real will be one and same. Are you all listening? Okay, 2 lakhs. Because inflation will happen next year only, not from this year. So 50,000 inflation, 40% inflation. 1,000.4, 70,000, like this. Okay, 70,000, 2 years inflation you will apply. 70,000 into 1.1, 1.1, how much? 70, 1.4, the African inflation, 70,000 into 1.4 into 1.4. How much is that? 1,37,200, 2 years inflation. Like this, you will apply and find out the nominal cash flows for year 1, 2, 3. Okay, nominal cash flows in terms of African rand, because you have considered the inflation. Now, this nominal cash flow is in African rand. You need to convert in India in INR. You need to convert now. Yes. This conversion, what rate I will use? I just know calculators working note here now. Exchange rate as per PP, purchasing power parity. This I will convert. So 6 into 33. Okay, here divided by 6. Why? You are converting African rand into Indian rupees. These are all African rand. Convert into Indian rupees divided by 6, because 1 rupee is equal to 6 African. So what you should do, divided by 2 lakh divided by 6, 3 lakh, 33,000, 333, 70,000 divided by 6, this much, and this much. Are you all understanding? 70,000 divided by 6 is 7.36, I think, 7.634, and 12.36 is missing, but it should be there. Okay, this is 12.369. What you should do, 2,46,000 divided by point is that 19,965. Are you all understanding this? How you got? Okay, that is missing, hence I added. Net cash flow in terms of rupees, how much is that? 83, because this 33,333 converted African rand rupee minus 50,000, 50,000 minus 50,000 minus 33,000 minus 83,883 total outflow, initial cash outflow. Next, year one inflow, this is minus 1650. Here this is positive, hence total positive 7517, 11,697. This and this and this you will add. Are you all understanding? Okay, you will get the net cash flow in terms of rupees. Now, this is nominal cash flow, as well as I combined the African rand, converted the African rand into INR, combined both the project total cumulative cash flow. Now, I need to discount this using present value terms. I will discount this using present value terms. But apart from that, what they have given, the last year cash flow, whatever is the last year cash flow, what is the cash flow? Last year cash flow 16,637 cumulative cash flow. 16, this will forever continue like that they have given. Now, if forever continue, constant dividend model, I told you what will be the formula. Okay, D dividend divided by KE. Like that, we found out the valuation. Like that, here also constant dividend model, whenever it is constant, so 16,637 divided by KE 20%. If I do this, okay, I'll get the terminal value. Okay, all the future cash flows, I'll discount it, which means what is the terminal value? 16,637 divided by 20%. Get 83,185. 83,185 as terminal value. This is nothing but this is D1, D2, D3, and this is P3. Price of the value at the end of year 3. P3 is nothing but D4 to D infinity. I discount and bring it to present value terms. This 83,185, sorry. This 83,183, what I should do? Okay, I should discount again using the third year discounting rate, which is 0.579, because this is P3. Okay, price at the end of year 3, terminal value, which will be at the end of year 3. Again, discount using 0.579. How much you will get? 48,164. 48,164 plus 6,262 plus first year discounted cash flow. 8,118 plus 9,633 minus 83,333. You will get a negative NPV. Are you understanding here? 48,164 minus 59. 83 plus 6 plus 8 plus 9 will give you minus 59, plus the discounted value of the terminal value will get minus 11,156. Are you understanding? If you are getting confused, what are all the discounted cash inflow? 6262 plus 8118 plus 9633 plus discounted value of terminal value. What is that? 48,164. These are all the discounted cash inflow minus discounted cash outflow of 83,333. You will get the value. You just verify 6,002 plus 8118 8 You're understanding the way you need to solve under home currency and nominal and real rate. Okay, international Fisher effect is also involved, and home currency and foreign currency approach is also involved. Hence, it's a comprehensive question, small question, but very, very comprehensive. Now, question number 64. Take question number 64. A proposed foreign investment involves creation of a plant with an annual output of 1 million units. The entire production will be exported at a selling price of USD 10 per unit. At the current rate of exchange dollar, cost of local production equals to USD 6 per unit. Okay, at the current rate of exchange, dollar cost of, this should be there, okay, comma, dollar cost of local production will be equal to US dollar 6 per unit. Dollar is expected current level, okay, dollar is expected current level, dollars expected current level is as follows. Okay, current level, decline level or depreciation. Anyway, dollar is expected. Some mistake is there. Anyway, some typographical error is there. No issue. Decline in value of USD given, reduction in cost of probability is given. Very simple. What they say in this table, I'll tell you briefly explain. When the value of US dollar currency value, when it depreciates 0%, cost of production will not be reduced anyway. No issue. But probability of this occurring, probability of declining in value of USD is 40% chance. There is a 40% chance that the currency will depreciate by 0%. Then there is a 40% chance that, see here, I have 0.4, 0.4, 0.4. This will not happen because the probability total should be 1. 1 second. This is 1 mistake. Yes, 2. This is 0.2. Last one is 0.2. Okay. That is what I was thinking. This is 0.2. It is not 0.4. Last one is 0.2. Make a correction. 0.2. Now, then decline in value of USD. Now, when USD value, okay, currency value depreciates by 10%, what happens to production cost? Production cost is reduced by 0.30. Understanding? At present, what is the production cost? 6 rupees. Okay. If it is 10% declining, what will be the cost for 6 minus 0.3 or 5.7? Are you understanding? That's what they've given now. Yes, 5.7. Next, okay, if there is depreciation of 15%, which means into 85%. 5. So these are the three scenarios. When the cost is 6 rupee per unit, $6 per unit, $5.7 per unit, and $5.1 per unit. If this is the case, okay, what will happen to the cash flows? You need to do 0.5 additional reduction will be there, which means reduction in the cost 0.3 plus 0.15 plus 0.15. If there is 15% okay, there will be cost reduction 0.3 additional 0.15, which means how much is the total? 0.45, which means 6 minus 0.45 is the cost. Anyway, reduction in cost of production. Okay, now yes, 5.7 and 5.55. Additional. Okay, there will be increase 0.45. 6 minus 0.45. Okay, 6 minus 0.45 plus 5.1 I have given. This is 85%. If it is dropped, okay, the currency drops by 85%. Sorry, the currency dropped by 85%. Now the price will become how much? 5.55, because 5.7 minus additional 15.15. That is dollar depreciation, not this one. Okay. This is unit cost reduction. Shall we move on? Okay, the plan at the current rate of exchange will have a depreciation USD 1 million annual depreciation given. Already given, you don't need to compute 1 million annually. Assume local tax rate is 30%. USD tax rate. This question is all about USD. Okay, the cash flow will be taken in USD, depreciation in USD, everything in USD. You don't need to do anything. Are you understanding now? You are required to find out annual cash flow after tax under all the different scenarios of exchange rate. Very simple. Exchange rate. What does exchange rate do to cash flow? Now, very simple. Exchange rate will reduce the cost of production. Cost will be reduced, now profit will be increased. That is the only thing. Are you all understanding? So first we will try to solve annual cash flow after tax under all different scenario. Three scenario. Scenario 1, 2, and 3. Okay, annual sales units, 10 lakh units will be same under all the scenario, no doubt. But yes, selling price also will be same under all the scenario. Cost per unit will change as the exchange rate changes, which means originally 6 rupees is the cost per USD at present. If 10% is depreciating, what is the cost? 5.7. If 15% is depreciating, what will the cost? 5.55. Are you understanding? So profit will increase. At present, profit is 4 per unit because selling price is 10 per unit, cost is 6 per unit, profit is 4 per unit. Agreed? Here 4.3 per unit and 4.45 unit. Tax, how much is the total profit? 40 lakhs, 43 lakhs, and 44 lakh 50,000 you will get. Now, this tax is equal as EBITDA, EBITDA, which means before tax, before depreciation, before tax, profit. Correct? This is operating profit before tax, before depreciation adjustment. Now, you will remove the depreciation, reduce the depreciation. See, depreciation, I told you the C fact itself, there you can listen. Depreciation used for computing the tax benefit. Thereafter, you will add back the depreciation to arrive at the cash flow after tax. Okay, so depreciation, you will reduce 10 lakh, 9 lakhs, 8 lakh 50,000. Why depreciation is getting reduced? See, very simple. Okay, you can see here. The plant at the current rate of exchange will have a depreciation of USD 1 million annual, which means plant if depreciates, see the current rate of exchange rate will have depreciation, which means depreciation exchange rate if depreciates by 10%, depreciation also will depreciate by 10%. Are you all understanding? Next to 15%. Now that 15% you will consider. So 10 lakh, what is that? 10 lakh depreciation. If it reduces by 10%, it will be 9 lakhs. Again, if it reduces originally from 10 lakhs by 15%, now what is that? 8 lakh 50,000. Are you all understanding? The depreciation is linked to the, okay, the exchange rate. Exchange rate declines now. Okay, the depreciation also declines. Okay, PBT. What is the PBT? Profit before tax and profit. Actually, it should be IT anyway, because interest is not given as one thing, but this computing PAT is nothing but no PAT, net operating profit after tax. I told you EBIT minus I. So this is like EBIT 30 lakhs because interest is not there anyway. So they have, okay, they have mentioned EBIT is equal to ABT because there is no interest involved. Anyway, 30 lakhs, 34 lakhs, 36 lakhs. Agreed. Next, tax, reduce the tax. You will get the PAT or no PAT. Add back depreciation, the original 10 lakhs and 9 lakhs and 8 lakh 50,000. Okay, here add back, you will get the expected cash flow after tax for the three scenarios. Each scenario, you have different cash flows. Just like we did in Hiller's model, we have three different expected CFAT. Are you understanding? That's what they are asking in the first stage. Okay, annual cash flow after tax under all the three different scenarios of the exchange. Next, expected value of the CFAT, assuming no repatriation of expected value means mean value, weighted average value, which means you have the probability, apply the probability to the respective scenario, you will find out the total it, you will find out the mean CFAT. So expected CFAT is nothing but 31 lakhs first scenario into 0.4, probability 0.4. The second scenario 3280, probability is 0.4. Third scenario 3370, probability is 0.2. Okay, add it totally, you will get 32 lakhs 26,000. Mean CFAT, average CFAT. Are you all comfortable? You have viability of the project. Last segment, they have asked about the project here. Viability of the investment proposal, assuming an initial investment of USD 25 million on plant with a required rate of return of 11% on investment and on the basis of CFAT arrived in the option 2, assuming it a CFAT of 0 point of time, the CFAT will grow 3% per annum perpetually. Understand? How much is the initial investment? Three things are there. Initial investment 25 million. This is nothing but discounted cash outflow. You will, so NPV you need to compute. NPV is equal to discounted cash inflow minus discounted cash outflow. Discounted cash outflow given as 25 million. Everything is in USD. So USD 25 million. Discounted cash inflow, what they say. Okay, what you do? Required rate of return for this project is 11%. Okay, you take the CFAT on an average CFAT you computed in second part option, you computed in option 2. How much you computed? Average NPV CFAT 3226. Are you all understanding? So this is the cash flow after tax arrived, average cash flow after tax this is the expected cash flow after tax. You assume it to be growing at 3% forever. That's what they have given. Are you all understanding? Constant dividend growth model they need to apply. You need to apply. The CFAT will grow at 3% per annum perpetually. D1 by KE minus G you can apply. Okay, here CFAT 1 divided by KE minus G you need to apply. KO required rate of return here is KO because your capital budgeting question. KO you will use back minus G. Here CFAT 1 you know why, you don't know why, you don't know. You have CFAT 0. CFAT 0. Okay, and you need to find CFAT 1. How do you find CFAT 0 into 1 plus G? Already I told you, free cash flow approach, dividend approach, everything I discussed. Okay, so CFAT 0 into 1 plus G divided by KO minus G, you have to apply and find out 3% you will apply. So expected growth cash flow today. This is nothing but CFAT 0 cash flow today. It will grow at 3% forever. Now, what is the value? 3226 into 1.03. This is D0. This is 1 plus G. G is 3%. So 1 plus G 1.03 divided by KO minus G. KO 11% given in the question. 0.11 minus 3%. If you solve it, okay, you will get how much? 415 lakhs 34,000. 150 as the total value of the proposal, value of the project. If this is the case, this is the value of the project. If it continues forever and constantly growing at 3%. Now, what is the value of inflow? Just now we computed 415 lakhs 34,750 less initial cash outlay. How much is the given in the question? I told you 20. See here, 225 million is 250 lakh USD, 250 lakh USD, 250 lakhs in US dollar. Are you understanding? Reduce it, you will get the NPV of the project. 5 lakhs 34,750. Since NPV is project positive, project is able to win. Well, understanding. Two more questions are there. Quickly, we'll try to solve and finish it. Okay. Mr. Mammon, an Indian investor, invests in a listed bond in USA. If the price of the bond at the beginning of the year is USD 100 and it is USD 103 at the end of the year, the coupon rate is 3% payable annually. Find out the return on investment in terms of home currency. If this was asked in MCQ, okay, 1 or 2 times asked it. First time they asked in May 24. Second time, I think in Jan or May 25 attempt. I don't remember, but they asked it 2 times. Okay, this very, very important. Mr. Mammon, an Indian investor, okay, listed bond in USA. See, Indian investor, this person, Indian investor investing in US. And US based bond, like he invested 100 rupees today, he invested 100 rupees. This bond appreciated to 103. Are you understanding? I told you there are two income sources of the bond. The bond will pay you interest as well as there will be capital gain, which means 100 rupees he invested, that became 103. How much is the capital gain? 103 minus 100. 3 rupees is the capital gain. Apart from that, coupon rate annually 3%, okay, will be payable. This coupon rate you should apply on the face value. Anyway, these are all the things. Find out the return on investment in terms of home country. This is just a calculation oriented question. Straightforward. Quickly we can finish. USD is flat. USD is flat, which means there is no currency. There's no currency appreciation. Your real return will be the actual return. Are you understanding? To test the international Fisher effect, this question is you're listening. So what is the real return? 103, this is the capital gain. 103 minus 100 divided by 100 plus the 3% coupon rate. This will be the real return. Are you understanding? So 3 plus 3, you have 6%. Here you have 3% plus the 3 by 100. Okay, 6% with the return. If there is no currency appreciation or depreciation. Important adjustment. If there is currency appreciation, okay, dollar appreciation, that you will consider into multiply it by 1 plus dollar return. Okay, you will do. No issue. If USD appreciates by 3%, very simple. If USD appreciates by 3%, you should use the return formula. Very simple. See, 6% is the normal return. I call it as real return. 6% is the real return. Now, the dollar also appreciates. That also you should consider. Are you all understanding? The real return means, okay, the instrument is giving you 6% return. By 3%, 3 rupees is capital gain, 3 rupees is 3% is the coupon. Totally 6% you will gain. Okay, this is the normal gain, real return from the instrument. Apart from that, okay, this is the investment gain, but you will have some return from the currency market. Currency exchange gain is also there. Why? Because, okay, you have 3 rupees exchange here, you invested in dollar. The dollar appreciates by 3%. What will happen? Very simple. Your real return is 6 na. Apo, what do you do? Okay, 1.06. This is real return na. 1.06 into 1.03. It appreciates by 3% minus 1. This will give you, okay, the total return, which means return from the USD appreciation, return from the normal instrument will give you total return of 9.18. Are you all understanding for Indian investor? Okay, next. USD depreciates by 3%. Very simple. This formula again you will use. Okay, real return is what? Okay, real return is 1.6%. Now, this 1 plus inflation rate, or you use now like this, here 1 minus you should use. Why? Because this is depreciation. When there is appreciation, you will consider the currency appreciation rate, but here it is depreciation. So 1 minus 1 is equal to how much? 1 plus 0.6 or 1.6, 1.06 is 6%, 1.06 into 1 minus 1. What is that? 97%. 0.02 here. 0.06 the number. 1 minus 0.03. I can also call it as, how much is that? This is 3%. 1 minus 3%, 97%. 0.06 to 97%. That 1.0282. 0.02 minus 1 will give you 0.0282, which is nothing but 2.82%. Are you all comfortable? Next, if Indian rupees appreciated by 5%, again tell me, this is not USD, this is Indian rupee. Now what will you do? Indian rupee appreciated by 5%, which means dollar depreciated by 5%. Like this you will consider. So 1 plus 0.06, which is 1.06. What you should do here? 1 plus a minus a minus, because dollar depreciated, Indian rupee appreciated, same as dollar depreciated, minus 0.05. Okay, minus 1. How much is that? 1.06 into 95%. 5% minus 1. How much is that? 0.007 or 0.7%. 0.7%. Your health gets eroded. Are you understanding? That's the point. Last, okay, what is that? Will your answer differ if Mammon invest in the bond just before the interest payable? That is not an issue, because even if you invest in the bond just before payable, okay, that will be paid. This, okay, I explained the clean versus dirty bond concept. Okay, there in fixed income security, I put a revision video there. I will discuss it. Okay, the clean bond versus dirty price versus clean price. How to this? Okay, because if you invest in a bond just before the interest and coupon payment period, they will anyway pay you full interest. Whoever is the owner, okay, on that date they will pay the interest. An issue. Shall we move on to the last question? Okay, in this regard, international finance. Last question. Okay. A US investor choose to invest in Sensex for a period of 1 year. The relevant information is given below. Size of investment 20 lakhs. Okay, these questions have been asked in RTP 22. I think RTP 21 or 22. I think RTP May 22. They have put these two questions. Last question and this question. And subsequently, they have tested in MCQ also. May 24 MCQ they have tested. So MCQ, yes, the main examination MCQ. So anyway, I'm discussing. Okay, it can be tested in MCQ. Size of even these questions can even be asked for 8 marks in the descriptive portion also. Size of investment 20 lakhs. Spot rate 1 year ago 42.5 and 42.6. Spot rate now is 43.85. And Sensex 1 year ago given, Sensex now given, US inflation, Indian inflation rate given. All the data given. Understanding Sensex appreciation rate given. Then spot rate and forward rate is given. Forward rate, I should not say, it is real spot rate on the previous day, real spot rate in the current day, like this real spot rate. Okay, you should not get confused with forward rate. This is not forward. The 43.85 is not forward rate. It is a real rate, but they are telling you the previous year picture and current year picture so that you can calculate. Anyway, we will see. Compute the nominal rate of return to the US investor. Compute the nominal rate of return to the US. Step by step, try to visualize what happened. Now, this person is US investor. Last question, Indian investor. This question is US investor. Now, size of investment in dollar. He had 20 lakh dollar originally in hand. How much he had? 20 lakhs dollar in hand. What he does now, he comes to Indian market and invest in Sensex. Sensex is, okay, the index of India. He comes up with 20 lakh rupees in a bag carrying 20 lakh rupees, tries to convert it, and then, okay, he tries to invest in rupee instruments or Indian market. What happened? You want to convert now, what rate you will use? 1 year ago, there would be a spot rate for conversion, 20 lakh rupees. He will sell dollar, buy dollar. He has dollar in hand. He will sell dollar and buy rupee. If you want to sell dollar, okay, in the dealer will give him what rate? At what rate you can sell your dollar? 42.5. Understanding? So 20 lakhs into 42.5 bid rate. Okay, this is the size of the investment. Okay, into 42.5, 850 lakhs INR he will have amount for investment is INR. Are you understanding? 850 lakhs is the amount of investment he can do in Indian market. Now, what he does, Sensex at T0, which means when he converted 1 year ago and he invested at what price? 3256. That is the Sensex 1 year back now. What is the Sensex 1 year back? 3256. At that time he invested. So how many units you would have got? Okay, Sensex, how many units you would have purchased? Number of units. 850 lakhs divided by 3256. Okay, it's nothing but 26,000. There's an alignment error. It should be space. Okay, that is alignment error. No worries. When 850 lakhs divided by 3256 is 26,105. You're clear with this? Okay. Next, Sensex at T1. What is the Sensex value today? This 26 lakh units he purchased, which means using the 20 lakh dollar, he converted the dollar into rupee. Okay, purchased the Sensex and got 26 lakhs, 26,105 Sensex units. Are you understanding? Today, what is the Sensex? 3765. Today, what is the Sensex? 3765. And he sold, okay, today, what is the 26,105 at current price? He sold, his sale value comes to 9,82. 982 85 325 9 crore 82 lakhs 85,325. And this I convert back in USD. This is convert back in USD because what they ask nominal rate of return to the US investor. You're understanding? Not real rate, nominal rate, not total rate. Whatever rate is given, you will consider without the inflation or any other data. Inflation is given in the question. You will not consider the inflation. Is the nominal, which will be inclusive of inflation. Anyway, you not to consider. You should not remove the inflation. Okay, because anyway, what is the amount? 982 lakhs 85,325. This should need to reconvert in terms of dollar. I have rupee in hand. What I will do? I need to purchase on a buy dollar. Buy dollar at what rate? Offer rate. Offer rate is what? This is US dollar at T1, which means spot rate prevailing at the end of the year. Offer rate I'll consider 43.9. Can you see the quotation? 43.85, 43.9. I will take 43.90. Okay, equivalent amount of USD comes to this much. Gain in USD is this much. Gain percentage terms to 2,38,846 divided by capital. What is the capital initially invested? 20 lakhs. So I get 11.94% return in terms of USD, in terms of nominal value. Are you all understanding? Now the second question, very interesting. Real appreciation or depreciation of rupee. Real appreciation or depreciation of rupee. How this is being computed? Now very simple. See what happened. See, the 43.85 is there. You forget about this. This is the 43.85 is what is the 43.85? This is the bid rate prevailing today, spot bid rate today, not 1 year back spot. This is current spot, which means what they say, this spot, if you see 1 year back, what is the spot? 42.5. Agreed. 1 year back, the spot would have been 42.5. Understanding? But the beauty, this is 1 year back quoted price. This is 1 year back quoted price. Okay, are you all understanding? Now 43.85 you have, inflation rate you have. Okay, this would have been included, which means the inflation adjustment would have been included in the currency rate. Agreed? I need to remove it. That is what they are asking. Compute the real depreciation or appreciation of rupee. Real depreciation or appreciation of rupee. How I compute? See, very simple. What happens? Okay, see, I'll tell you what happened. In terms of real appreciation of rupee, how will you compute? Very simple. Okay, you do this spot rate into inflation of home currency divided by inflation of, or this is inflation of foreign currency. This is as per PPT theory. You will compute the forward rate. Agreed? A fair forward rate. Agreed? What they say, okay, you don't know what is the spot rate prevailing on that date. You know what is the spot rate prevailing on that date. Okay, you have the inflation of home currency and foreign currency, and you know what is the spot rate prevailing today. You know what is the spot rate prevailing today, which means if I consider this as fair rate, if I rework it, I will get the spot rate, which should have been the spot rate, Are you all understanding? Okay, okay. What I will tell you what you should do. Today, assume this 43.85 is there. This is forward rate. Spot rate, you don't know, you consider it to be X. So X into, okay, X into inflation of home currency. What is the home currency? You tell me, what is the home currency? What is the home currency inflation? Okay, what is the home? 9%? 9. Okay, 9. Yes. 9% is the rupee interest rate, which means Indian inflation of currency is what? 9% divided by 1 plus 1.05. 1.05. Inflation of foreign currency is included. 1.05. Are you understanding? Now what happens? See, X into 1.09 is equal to 43.85 into 1.05. Okay. 43, or X is equal to what? 43.85 into 1.05 divided by 1.09. Are you all understanding? This I get it as 42.24. What is the number? 42.24. Okay, this is that what they have calculated. 42.24. Are you all having that clarity? So what I'm saying is, see what they say. Inflation, if you remove the inflation from the current spot rate, you should get the real rate. Okay, why you should compute the real rate? Now, then only you can compute the real appreciation or depreciation. Are you all understanding? Very simple. From 40, this is 42.5, and from 42.5, okay, this became 42.24. Okay, dollar became 42.24. Hence, real appreciation, rupee has appreciated, which means if for every $1, if rupee is lower, it means it has appreciated. Rupee has appreciated against the dollar. So 42.5 was the dollar last year, but it has appreciated. Really speaking, it has, okay, the real rate should have been 42.24. Without inflation, the real rate became 42.24. Are you all understanding what I'm trying to say? Very simple. Yeah. Last year, this is last year, this is current year. Okay, this is 42.5. Okay, last year exchange rate was 42.5. Yeah, yes, 42.5. This year exchange rate become 43.85. But this exchange rate is loaded with inflation of the countries. Are you all understanding? This exchange rate, okay, the inflation interest rate, that would be okay, inside it, I will try to remove it. I will try to remove the inflation effect. And if I remove it, I'll get 42.24 only. You are understanding what I'm trying to say? In terms of real currency appreciation, really speaking, for my 42.5 in the last year, it became only 42.24 really, real terms. Nominal terms, because of inflation, is additional currency happened. Okay, the additional 43.85, the balance amount happened due to inflation and not the real the currency because of the exchange rate. This is the real exchange appreciation, which means earlier 42.5, it became 42.24. What is the appreciation in terms of percentage? 42.5 minus 42.24 divided by 42.5. Okay, that you will 42.24. Okay, because that is what you should do. 42.24, you will get the, what is the value, appreciation value in terms of percentage, how much you are getting? 0.61 percentage. Really speaking, 0.61 only currency appreciated, but balance is due to inflation, hence you get the additional. Next, exchange rate if relevant, purchasing power parity holds. Okay, this is very simple and straightforward. Buying rate is 42.6, 42.5 and 42.6. This is the spot buying last year. This is the spot rate. What they are asking in the question is exchange rate. Okay, if relevant purchasing power parity holds, which means actual rate, forward rate, okay, real rate, turns out to be the purchasing power parity rate, which means turns out to be forward rate as per PPT, forward rate as per PPP. How much it will be? 42 spot. Here you have bid and offer, so you will consider spot bid, forward bid, spot bid and spot offer. That you will, okay, what you do? You compound using the purchasing power parity theory. So spot into 1 plus inflation of home currency 9% and inflation of foreign currency, you will get 44.12. Again 42.6 offer rate into 1 plus inflation is the same thing, you will get 44.4. So quotation, how much I should quotate? Exchange rate 44.12, 44.22 if purchase power parity holds good. Okay, this is that happened. Now real return to Indian investor in Sensex. Now forget about US. If he was a Indian investor, if he is an Indian investor, forget about US, real, nominal, all this will happen if conversion exchange rate is happening. Now, if it is an Indian investor, tell me what will happen. Very simple. What is the return he is earning? Nominal return, total return. Okay, in terms of total. What is that? 3765 closing Sensex price minus opening. P1 minus P0. I told you now. Okay, divided by P0 will give you 15.63. Are you understanding? Now, this is nominal return, but they're asking real return. This is nominal return, your total return you will get. How much is that? 15.63. How to convert nominal to real return? Inflation. Inflation in what? Inflation in which country? 9%, India. So very simple. 1 plus nominal rate equal to 1 plus real rate and 1 plus inflation rate. Agreed. Now what do you need to find out? Nominal rate you have, you need to find out real rate, real return they have asked. So 1 plus real rate is equal to 1 plus nominal rate divided by 1 plus inflation rate. Okay, is equal to how much? 1 plus nominal rate is how much? Nominal rate, just now we computed. Now what is the rate of return? 15.63. Okay, 15.63, 0.1563 or 1.156. Okay, divided by 1.09. How much? 0.0608. 0.008. This is 1 plus real rate. Okay, what is real rate? Minus 1. 0.0608. This 1 goes to this side, minus 1. Okay, 0.0608 or 6.08 percentage. Are you all understanding? This is the way you compute the international Fisher effect is being tested. Okay, anyway, can be asked for 8 marks. With this, we have okay, revision of international financial management. See, what I wanted to do is that I wanted to include interest rate risk management in the same second part, but due to lack of time, okay, the file is getting too big and not running in the system, in trouble. So what I will do, I will upload now, okay, this second part without having the interest rate risk here. The next part, I will publish the portfolio management, interest rate risk and mutual. Okay, thank you. Okay, if you like our work, okay, if you appreciate, post a comment, okay, and as well as share with your friends. So thank you.